So hello all my dear students of CA Final Direct Tax from South India especially. I hope you all are doing good and I hope your studies are going on great. So as I promised you some days before that I'll be making a full English video also along with a Hindi video. Don't worry about it. On all the past RTPs, that is 6 RTPs, 8 mock test paper and 5 exam paper, total 19 papers. We'll try to revise all of them in what? In a span of around 2.5 hours to 3 hours in full English also along with Hindi. So the time has come for that, and this video will be applicable for your May 23 exams and also for your November 2023 exams. Okay. So without wasting any further time, so let's start with the first RTP, that is November 2022. And in the first RTP, the first key point over here is given in the first line. There is a word manufacturing over here. Whenever the word manufacturing will come, you have to come to one conclusion that there can be an implication of additional depreciation. Apart from that, wherever there is a business of footwear, leather, apparel, footwear, leather, apparel, always remember that there can be an implication of 80 JJAA, that is the employment wala section under chapter 6A. So now this is the normal question on PGBP where you have to compute your total income and then the tax liability. Now the total income has to be computed as per the normal provisions. No 115 BAA, no 115 BAB, nothing has to be followed. It has to be computed as per the normal provisions. Further, no MAT implications have to be applied. Nothing has to be done. Plus, the tax rate would be 25% because the turnover of last year is up to 400 crore. It is less than 400 crore. Therefore, the tax rate over here will be 25%. Okay. Now coming to the computation of income. The very first adjustment over here is depreciation. The depreciation is very simple. You have to add back the company's Aquala depreciation 64 lakhs. Second adjustment, you have purchased some goods of 64 lakhs, out of which 52 lakhs is settled and 12 lakhs is remitted and it is waived off by the other person. If it is remitted by the other person, it is nothing but deemed income under section 41(1). Okay. So if you have purchased goods of 64 lakhs and if the other person has remitted 12 lakh rupees, so that is your income, nothing but deemed income under section 41(1). Next one is employer contribution to employees provident fund. Employer contribution, you can make the payment till the due date of filing of return, that is till the due date of filing of return. This is a company, therefore for company the due date of filing of return is 31st October. So if it is making the payment in 30th June, it is well and fine, it is allowed as a deduction. But employees contribution has to be made as a payment by 15th of the following month. That is given in the last adjustment, in adjustment number 4. And in that case, the employees contribution is made as a payment on what? Is made as a payment on 31st July. That will not be allowed. That will be added back to the income. Employer contribution, you can make the payment till what? Till the due date of filing of return. But employee contribution has to be made as a payment by 15th of the following month. So here they have made a mistake, and in case of employer contribution, they are not making any mistake over there. They are absolutely fine over here. Now, the most important adjustment and the crux of this question is given in adjustment number 4. Here you are making an interest payment of 60 lakhs. Out of that interest payment, there is a loan of 50 lakhs which you have taken for the purpose of purchasing of machinery, and that machinery is not put to use. That machinery is put to use in November. So till 31st October, you have to what? Capitalize the interest. So interest will come to how much? 50 lakhs is the loan for machinery, multiplied by 12% is the rate of interest, multiplied by 7 months, divided by 12. So that much, that will come to 3.5 lakhs. So that 3.5 lakhs you have to add back to the cost of this new machinery, which is given in adjustment number 2 below. So 60 lakhs plus 3.5 lakh you have to add back to the cost of the machinery. Now there are multiple adjustments in this particular point. First, this 3.5 lakh will be added to the cost of machinery. At the same time, you also have to add back that to the P&L back because it is also debited to the P&L. You cannot take both the benefit now, that you will add to the asset and claim depreciation also, and you will claim as a revenue expense also. You have to add back to the P&L account. Okay, so that interest, which is a pre-use interest, that has to be added back to the P&L. Okay, so first effect is you have to add back to P&L. Second effect is you have to add back to the asset. Now you can claim normal depreciation. How much? 7.5%. Why? Because the asset is used for less than 180 days, and you will also compute what? Additional depreciation, because it is a new machinery and the assessee is engaged in manufacturing. Therefore, you will also compute additional depreciation at the rate of 10%. Okay, so you have to think all these things in your mind. So normal depreciation will be half and additional depreciation will also be half, and this is the effect of this particular machinery. Now the balance machinery, 340 minus 60 lakhs, the balance is 280 lakhs. The 280 lakhs machinery will be depreciated at normal rate of 15%. That is your opening WDV. Okay, now building will be depreciated at 10%, as we all know. Computer will be depreciated at 40%, as we all know. These are all opening WDV of the assets. Okay, next is you have made some payment of 20 lakhs without deduction of TDS. So in that case, you have to disallow 30% of that. That is 6 lakhs will be disallowed in that particular case for not deducting the TDS of payment made to residents. Okay, next. Adjustment number 3 is about what? Adjustment number 3 is about the 80 JJAA deduction. You have employed 24 additional employees. Now, out of these 24 additional employees, how many of them will be allowed as deduction? Now, first of all, you have to keep it in mind that in 80 JJAA, it is only allowed if the emolument per month is more than up to 25,000 rupees per month. So if the emolument per month is more than 25,000 rupees, then it is not allowed as deduction. So out of 24 employees, 12 employees are employed on 1st June and their emoluments is 23,000. So they will be eligible for 80 JJAA. But out of those 12, 2 employees who have joined are settled by bearer check. You cannot make the payment by bearer check. You have to make the payment by account pay check, account pay draft, ECS or such an electronic mode. Bearer check is not allowed. So out of this 10 employees also, 2 employees are disqualified. So out of this 12 employees also, 2 employees are disqualified. qualified. They are not eligible for ATJJAA. So out of this first lot of 12 employees, how many employees will be eligible? Only 10. Into 23,000 is their salary per month, multiplied by, from June to March, it will come to 10 months. This is the first lot of employee. Okay. Second lot of employee. These 4 employees who are joined on 1st July, their emolument is more than 25,000. So they will not be eligible for deduction under ATJJAA. Next 8 employees who have joined on November, that is in the month of 1st November 2022, their salary is less than 25,000. They will be eligible for ATJJAA. So there are only 2 lots of employee. These 10 employees are eligible, and then these 8 employees are also eligible. These 8 employees are eligible for 20,000 into 8 into 5 months from November to March. So that will come to whatever amount comes to, you have to take 30% deduction of that. Okay. And last but not least, which I have already told you, that employees contribution has to be paid by the 15th of the following month, and you are making the payment in 31st July. That is not allowed, not allowed, not allowed. Okay. Forget about it. Now, what is the total income of the assessee? The total income of the assessee is more than 1 crore rupees. Now, because it is more than 1 crore rupees, the assessee would also be liable for what? Surcharge of 7% on the total income. You can check it over here. Okay. So this is your first question, which is very, very, very important question. The next question is based on what? Is based on accredited income. And in accredited income, what happens in exit tax? What happens? Your aggregate of all assets minus aggregate of all liability will be subject to 34.944% tax. Do you remember that? 34.944% tax. Now, what should be the value of the asset? For land, you have to take the stamp duty value or market value, whichever is higher. So we are taking market value because market value is higher. For equity shares which are listed in a stock exchange, you have to take the average of the higher of the price. Average. So 150 is the lower, 170 is the higher. So divide by 2, average will come to 160. 160 into 75,000. You have to take the average of the price of these shares. Okay. In case of preference shares, you have to take what? FMV of the preference shares. So the FMV of the preference shares is how much? It is 88 lakhs. So you have to take 88 lakhs over there. Now, corpus fund you are not supposed to consider. Assets are over. Only 3 assets are there. Corpus fund you are not supposed to take because capital and reserves are not part of what? Exit tax. Then outside liability you are supposed to consider. Provision for tax is not allowed to be taken in the list of liabilities. Then the other utility bills which you have paid for electricity, for rent, etc., that outstanding bills also you can take in the list of liabilities. Okay. After you do all these things, you will get your accredited income. On that apply 34.944% tax. Okay. The third question is a theory question, which is based on a person who is a resident, whose age is 60 years. He is resident and ordinary resident, and his total income is what? His total income is 3 lakh rupees. Now he is asking, am I supposed to file the return? By default, if a person whose age is 60 years, for him the basic exemption limit is 3 lakh and he is not liable to file the return. But if he has a foreign asset, or if he is a signing authority in foreign country in a bank account, then he is liable to file the return. This Mr. Suresh is having a foreign asset and he is also having a bank account in foreign country where he is a signing authority. Therefore, Mr. Suresh is liable to file the return as per the 4th proviso to section 139(1). I hope you all know that. That is a very, very important provision. Next question is based on what? Is based on, there was one assessee who has filed the return. After filing the return, assessments are done. In the assessment, there are 2 mistakes. There are 2 additions made by the assessing officer, out of which one addition is some unexplained investment that AO has added back, and second is excess remuneration paid to the partners as per 40B that AO has added back. So these are the 2 additions that AO has added back. Out of that, the first mistake, assessee has challenged. Assessee has challenged the first mistake in the court. Okay, and the matter has gone to CIT appeal, and CIT appeal has decided that matter. Now the assessee wants to challenge the second matter also. So the assessee has 2 options. The given in the question. Can the assessee go for 264 revision, or it should go for 154? 264 is close, close, close. Why? Because their doctrine of complete merger is applicable. Once a particular matter of an order is subject matter of appeal or revision, then the entire order is not subject to revision under 264. 264 door is closed. Yes, you can go for 154 provided the second mistake is a mistake apparent from record. If it is a mistake apparent from record, you can go for the second one. Okay. Now, next. Question number 5 is on section 292BB. 292BB is attracted in 3 circumstances. First, if the department has given a late notice, or if the department has given an improper notice, or if the department has not given the notice only. These are the 3 circumstances which are mentioned in 292BB, whereby if the assessee cooperates, then the notice is deemed to be valid. But the Supreme Court in the case of Lakshman Das Khandelwal has held that the 292BB cannot be attracted if the notice is not given to the assessee. If you want to attract 292BB, the notice has to be given to the assessee, and in that case, the notice can be late, the notice can be improper. But if you have not given the notice and then you want to attract 292BB and say that the assessment is deemed to be valid, you cannot say that. To attract 292BB, the department has to send the notice. Without sending the notice, 292BB cannot be made applicable. Next question, question number 6. What is question number 6, sir? Question number 6 is on transfer pricing provisions, whereby we need to say whether the transfer pricing provisions will be applicable or not. And to make the transfer pricing provision applicable, there has to be a relationship of associate enterprise between 2 entities. Unless and until there is a relationship of associate enterprise between 2 entities, you cannot say that the transfer pricing is applicable. Now, in the first case, what is happening? One entity is giving more than 10% guarantee of the total borrowings of the other entity. Therefore, both of them are deemed to be associate enterprise. Second one is not relevant because 115BBD is removed from this financial year, therefore second one is not relevant. Third one is based on domestic transfer pricing. One entity, one unit of the entity is in ATIA, highway projects are eligible for ATIA deduction, and other unit of the SSC is in other than ATIA, it is a non-eligible unit. So do you remember that if there is a transaction between ATIA SSC and non-ATIA SSC within India also, then also domestic transfer pricing is applicable if the aggregate value of transaction is exceeding 20 crore rupees, otherwise not. Okay, and the last one is if there is a holding and subsidiary, then the relationship of holding and subsidiary is deemed to be a social enterprise, and therefore transfer pricing provisions will be applicable in that case also. So can you see this? Just in 10 minutes we have completed one RTP. In this way, in 190 minutes we'll try to complete the entire 19 papers. Okay. So let's move on to the next RTP, that is May 21 RTP, in which the first question itself is based on non-resident taxation, your favorite topic. Okay. Now, the first question over here is based on non-NR taxation, in which there is a foreign company who is providing some fees for technical services to an Indian company, and there is an agreement between both of them, and the agreement is also approved by the central government. Now, if all these conditions are fulfilled, then either of the two sections will be applicable. Either 115A will be applicable or 44DA will be applicable. Now, 115A will be applicable if there is no P of the foreign company, and 44DA will be applicable if the foreign company has a permanent establishment in India. So the first part is about that only, that is there is no, assume that there is the foreign company does not have a P in India, and compute the income and compute the tax. So if the foreign company does not have a P in India, the income will be directly 3.2 crore. And the deduction of expenses will not be allowed to the SSC. No deduction of expenses will be allowed under 115A. The tax rate will be 10% plus surcharge will be 2%. Why 2%? Because the income is more than 1 crore and up to 10 crore. It is 3.2 crore. No, it is more than 1 crore up to 10 crore. Then the surcharge to foreign company is 2%, and about 10 crore the surcharge to foreign company is 5%. So therefore the surcharge over here will be 2% plus 4% cess will be applied to the SSC. Now one more question is asked over here. Second thing is they will not get any deduction of any expenses over here. Directly 3.2 crore will be taxed at 10% plus 2% plus 4%. Now the second question asked in this particular point number 1 is the SSC liable to file the return? No, SSC is not liable to file the return. SSC is not liable to file the return because the SSC does not earn any other income, and the tax is not deducted at the rate lower than the rate mentioned in 115A. If there would have been a rate mentioned under DTAA, suppose if the DTAA says that the FTS would be charged at 5%, and if the SSC would have paid the tax at 5%, which is lower than the rate mentioned in 115A, then the SSC would have been liable to file the income tax return. In this case, if the SSC does not earn any other income and it is taxed at the rate mentioned in 115A, which is taxed over here as per the rate of 115A, therefore there is no need to what? File the return over here. In the second case, we have to follow 44DA because the SSC has a P in India, therefore you have to follow 44DA. And as per 44DA, there are two incomes which are going to come over here. First is 3.2 crore is the revenue FTS, and another FTS which is earned of 2 crore. These are the total income, total revenue which has been earned by the SSC. Now, in 44DA, you get expenses, deduction of expenses. You will first of all get this deduction of 28 lakhs incurred for earning such income, then this 21 lakhs incurred for earning such income, but you will not get this 8 lakh rupees deduction. Why? Because in 44DA, it is very clearly written, if an expense is incurred not wholly and exclusively for this branch, for this P, then it is not allowed. If it is commonly incurred for this branch and for HO and for other branches, then it is not allowed. The expense should be exclusively incurred for the Indian branch, then only it is allowed. Now this is not allowed because this is not wholly exclusively incurred for the Indian branch. Second one, this 14 lakhs will also be not allowed. It is very clearly written in 44DA, you can check. If the SSC, if the Indian branch is making payment to its HO or to any other branch, then it is not allowed as deduction. Yes, if it would have been a reimbursement of expense, then it would have been allowed. But this is not a reimbursement of expense. This is the direct expense paid to what? HO. This is considered to be a payment to self, and therefore this is not allowed as deduction, not allowed as deduction. If this would have been reimbursement, then this would have been allowed under 44DA. Okay. Now, one last thing. What would be the tax rate? The tax rate will be the normal rate which is applicable to a foreign company, that is 40%. Okay. Now, is the foreign company liable to file the return? Yes, they are liable to file the return. They are liable to maintain books of account. They are liable to do the tax audit as per 44AB, and also they are supposed to submit the tax audit report 1 month prior to the due date of filing of return. Okay. So these are the other requirements which are asked in this particular question. Let's move on to the next question. The next question is a very traditional question of what? Of computation of penalty. First of all, this is an LLP, therefore the tax rate would be 30%. Second thing, this is not a case of misreporting, therefore the penalty would be 50%. If it would have been a case of misreporting, then the penalty would have been 200%. Now, how penalty is computed? Here you have to compute penalty at two stages. First, when you are doing a regular assessment, at that time you have to compute the penalty, and then you have to compute the penalty when you are doing the income escaping assessment. To compute penalty, first of all, you have to compute the underreported income. Underreported income is nothing but what? Your income assessed, which is 35 lakhs, minus income processed, which is 22 lakhs. So 13 lakhs will become your underreported income, and now you will not directly compute tax on 13 lakhs. Be very careful. First of all, you will compute tax on underreported income plus income process minus, then you will compute tax on income process. You have to compute the tax in this step. Okay. Similarly, when you are doing a reassessment, at that time your underreported income will be income reassessed, that is 45 lakhs, minus income now previously assessed, that is 35 lakhs. Therefore 7 lakh will become what? Your underreported income. Again, you are not going to compute tax on 7 lakhs directly. You are going to compute tax on what? Underreported income plus previously assessed. First compute tax on underreported income, that is 7 lakhs, plus previously assessed, that is 35 lakhs. First compute tax on 42 lakhs, minus then compute tax on what? tax on previously assessed. You are not going to compute tax directly on 7 lakh. Be very careful, otherwise your answer might go wrong in some cases. Okay. After that, you will compute the tax, and tax is 30% for LLP, 4% cess. If surcharge is applicable, apply surcharge also. Then you will compute penalty at the rate of what? 50%, because this is not a case of misreporting, it is a case of underreporting. Question number 9 is based on MAT, book profit, book profit, book profit. We are supposed to compute the book profit, and after computing the book profit, we are supposed to compute the MAT liability. So they have given us the net profit. The net profit is 52 lakhs. You will write down that first, and you will add less all the items which are added in explanation 1 to section 115 JB. Now, provision for loss of subsidiary, yes, it is added back. Provision for doubtful debts, yes, it is added back. Income tax, yes, it is added back. Provision for gratuity based on actual valuation, no, it is not added back in MAT, because it is a certain liability. What is added back in MAT is a provision for that liability which is unascertained. Gratuity liability determined by what? Actually is an uncertain liability. Do not add in MAT. In normal provision back, it will be added back. Do not add over here. Be very careful. This is an important point. Depreciation you have to add back, and then you have to reduce the depreciation other than revaluation. And now your revaluation is 80,000. Therefore, your other than revaluation is 2,28,000. So out of 3,08,000, 80,000 is depreciation because of revaluation. You cannot reduce that. So remove that much. And therefore, depreciation other than revaluation is 2,28,000. You can reduce 2,28,000. So for depreciation, add back 3,08,000 and then reduce 2,28,000. Okay, very simple. Next two items are not added back in MAT. Those two items are added back in the normal provision. Not in MAT, not in MAT, not in MAT. Okay. Now, 15,20,000 SEZ deduction. 10 AA deductions are not reduced in MAT. Let it be part of book profit. Let it bear the burden of MAT. 10 AA deductions are not subject to deduction from MAT. They are liable for MAT liable. Do not reduce this. Do not reduce this. Okay. Next, share of income from AOP as a member. Now, this company is a member in an AOP. And if it is earning some share of income from that AOP, then that has to be reduced from MAT, reduced from MAT, reduced from MAT. The way the share of profit from a firm is reduced from MAT, same way the share of profit from an AOP is also reduced from MAT when the AOP has paid tax at MMR. And it is written in the question that AOP has paid tax at MMR. If the AOP has already paid the tax at 42.744, then on that share, the income is exempt under section 86 under the normal provision. And in MAT also, it is not liable to tax, not liable to tax, not liable to tax. Long-term capital gains are subject to MAT, subject to MAT, subject to MAT. They will be liable to MAT. Then the UID is 18 lakhs and unabsorbed depreciation and the loss is 14 lakhs. So whichever is lower will be reduced from the book profit. So the lower amount is what? 14 lakhs. You can reduce 14 lakhs from your book profit. Okay. Your provision for tax includes interest also. Let it be part of, because interest is also added back in MAT and provision for tax is also added back in MAT. So there is not going to be any adjustment regarding this, because provision for tax is also added back, interest is also added back on income tax. So let it be part of that. Don't worry about it. After doing all these things, you are going to compute 15% tax, 4% cess, no surcharge because the income does not exceed 1 crore rupees. Second part, would your answer change if Ganga is a unit located in IFSC? Yes. If the Ganga is a unit located in IFSC, then the MAT liability will be 9% instead of 15%. Do you remember that? In IFSC, the MAT liability and the AMT liability is 9% and not 15%. Okay. Last but not least, if Ganga is a unit located in IFSC and derives income solely in convertible foreign exchange, what will be the tax distributed by it in the hands of the Ganga and shareholder? So if the Ganga is distributing some dividend, then no DDT on Ganga, because DDT is removed from Fund 4 2020, and no income tax to the shareholders also. If the IFSC unit is distributing dividends, that dividend is exempt in the hands of shareholder. Be very careful. If an IFSC unit is distributing shareholder, that dividend is exempt in the hands of shareholder. So this is what this question is all about. Let's move on to the next question, question number 10, which is almost similar to the question which we have done in the previous RTP. That is based on what? Charitable trust, which is converted into a business trust, into a business now. Therefore, we have to apply the exit tax, accredited income tax at 34.944%. Now, one important point in this question is, in 2013, the trust was set up, the trust was started, but it was registered in 2016. So from this date to this date, whatever assets are purchased by the trust, that will not be subject to accredited income. Be very careful, because there is an exclusion. There is an exclusion in the law which says that if the asset is purchased from the date of setup of the trust till the date of registration, then that asset will not be subject to accredited income. Therefore, this Surat land will not be subject to accredited income because it was purchased before the date of registration. Therefore, this land will not be subject to accredited income. Yes, this Baroda land will be subject to accredited income, and for the purpose of accredited income, you have to take the stamp duty value or market value, whichever is higher, and therefore here the market value is higher. Therefore, we are taking 105 lakhs for land of Baroda. Surat land we are not going to take. For equity shares which are listed, you are going to take the highest price and the lowest price average divided by 2 multiplied by 3,000 shares. For preference shares, you are going to take the market value multiplied by number of shares. And for liabilities, you are going to take the total liabilities, but in that you cannot take corpus fund, you cannot take provision for tax, as we have seen in the previous question also. You cannot tax reserves and surplus. All these things are not part of what? Liability for the purpose of computation of accredited income. And one last question, question number 11 in this particular RTP is based on DDAA. There is an assessee, Mr. Sham, who is having an age of 47 years and he's a resident individual. Now, this assessee is what is computing his income, and he is trying to take some unilateral relief because the India does not have DTAA with the foreign country. So we have to compute a unilateral relief. The first income which he is earning is he is earning some profit from business in Noida. So that is 50 lakhs. Second, he is earning some share of profit from a partnership firm in Gurgaon. That is exempt under 10(2)(a), because if your partnership firm is in India and you are earning some profit out of it, that is exempt under 10(2)(a). Third one is he is earning some agriculture income from what? Country A. So that you have to write over here. Agriculture income will be chargeable under income from other source. So the dollar rate is given at 60 rupees. So 32,000 into 60. Fourth is there is some loss of business which is not allowed to set off in country A. So in country A it is not allowed now, but in India it is allowed now. So you can take the deduction of that loss against the Indian business. In India it is allowed. In country A it is not allowed. But in India the loss is allowed now. Business loss is allowed. In country A it is not allowed. Forget about that. Don't reduce against this income, but against Indian income you can reduce now. You reduce that. After that, he has paid some PPF, 1,50,000 he will get. He has paid some 30,000 to ensure his health in ATD, but he will not get 30,000 because his age is less than 60. He will get only 25,000. Plus, he has paid some 55,000 insurance premium for his parents. So for that also, he will get only how much? Only 50,000. Plus, there is one sister who is dependent on him, and the sister is not claiming ATU. Therefore, he can claim, and that sister is disabled. Therefore, he can claim what? ATDD, 75,000 flat deduction. He can claim in ATDD, and therefore he will get 75,000 flat deduction under ATDD. After doing all these things, he have to compute what? He have to compute his tax. He will also apply surcharge over here because his total income exceeds what? Exceeds 50 lakh rupees. So he has to apply 10% surcharge over here, and then he will compute the tax rate. The Indian tax rate is 30%, 31% approximately, and the foreign tax rate is 25%. Whichever is lower will be allowed as benefits. Therefore, 25% will be the relief. On how much income? On doubly taxed income. How much is doubly taxed income? This is your foreign income, but out of that you have to reduce 2,40,000 because that much is not doubly taxed. That much you are taking benefit in India. Therefore, out of that amount you have to reduce 2,40,000, and therefore the remaining amount will be your doubly taxed income. On that you will apply 25%. That will be your relief. That's it. This is your RTP May 2021. So let's move on to the next RTP, that is RTP November 21, question number 12. It's a beautiful question. It's a question on two companies, company X Limited and company Y Limited. And we are supposed to compute three different parts are there over here. First part is compute tax liability of X and Y as per the beneficial rate, that is 115BAA or 115BAB for previous year 2021, assessment year 21-22. Be careful, this question is for previous year 2021, assessment year 21-22. So accordingly, you have to compute the answers. Okay. So first of all, we have to compute the tax liability of both the companies as per the special rates. So which special rates will be applicable? There are two special rates. One is 115BAA, 115BAB. Now 115BAB is not applicable to both of them. Why? Because this company was formed in 2018. So therefore 115BAB is out of question. 115BAB is applicable if the company is formed from 1st October 2019 to 31st March 2024, and it should be a manufacturing company. Therefore, this company is out of question. Even the second company is out of question because 115BAB is not applicable to second company also. Why, sir? Because, sir, this company is formed after 1st October 2019. Why this company is not eligible for 115BAB? It is not eligible because of some other reason. That is because of printing of books. If an assessee is engaged in printing of books, software development, if an assessee is engaged in marble blocks, etc., there are certain 4 or 5 businesses for which 115BAB is not applicable. So, moral of the story, both the companies are not liable for 115BAB. Both of them will be liable for 115BAA, and in which the tax rate is 22%, surcharge is 10% always, and 4% cess. Now, we need to be very careful how to compute the income. In 115BAA, you do not get any deductions of Chapter 6A except some, like 80JJAA you get, 80M also you get. 80JJAA and 80M you are supposed to take. Additional depreciation, not allowed, not allowed, not allowed. Okay. So therefore, the first thing is we have to write the gross total income of both the company, and then we have to take 80JJAA and 80M for both the company if it is available. So for the first company, the employees are 150 employees are there, 18,000 per month, multiply by 12, then 22,000 rupees, 150 employees into 12. For this 26,000 rupees, you are not going to get the deduction because again and again it is repeating now. If the emolument is more than 25,000 rupees, you are not eligible for deduction under 80JJAA. So you are eligible for the first two category of income, not for the third one. Okay. Secondly, this company is also eligible for what? It's also eligible for 60 lakh rupees deduction on ATM. Do you remember that? If you receive dividend from domestic company and if you distribute dividend to another to your shareholders 1 month prior to the due date of filing of return, then you are eligible to claim deduction under ATM for whichever is lower. So you are receiving dividend of how much? 60 lakh. You are distributing 1 month prior to the due date of filing of return, how much? 72 lakhs. You will be eligible for deduction of how much? 60 lakhs over here. Now, the second company, Y Limited, is not eligible for deduction under 80JJAA. Why? Because the company is formed in the current year, that is 2021, and the company is formed in October 2020, and therefore the employees who have been employed during the year, that is the 200 employees who are employed during the year and employed for less than employed for less than 240 days, and therefore they will not be eligible for what? 80JJAA. 80JJAA will not be allowed to this company in the current year. Plus, ATM is also not applicable because this company is not distributing any dividend nor receiving any dividend. Therefore, the total income of the first company is this, second company is this. and on that you have to apply 22% flat tax, 10% surcharge. Always in 115BAA surcharge is not based on income, it is always applicable for plus 4% cess always. Okay, that is your tax liability. This is the first part. What is the second part? Compute the total income as per the regular provision. Now in regular provision there is only one extra thing that you are going to get. That is, in this question you are going to get what? Additional depreciation. Now additional depreciation is only available if you follow what? WDV. So the company is following WDV from financial year 18-19. Earlier it used to follow what? SLM, but now they want to, because the company is engaged in the business of generation of electricity. Now they have both the options. They can follow SLM also, they can follow WDV also, but this company has now been following what? WDV. Therefore they are eligible for what? Additional depreciation. Therefore the company X has purchased new plant and machinery of 9 crore on 1st October 2020 and it has used immediately. Therefore it is eligible for full additional depreciation because it is used for more than 180 days. Similarly, company Y is also purchasing what? Is also purchasing a plant and machinery of 2 crore rupees. You can see over here, which is also put to use from 1st October 2020. They are also eligible for full depreciation because it is both the machineries are used for more than 180 days. Therefore, this machinery 9 crore into 20%, 1 crore 80 lakhs, and 2 crore into 20%, it will come to 40 lakhs. Therefore, you will get this deduction. Rest of the deductions are same only. This is your total income. This is your part 2. And in part 3, they are saying that part 3 is only for X, it is not for Y. They are saying that whether it should opt for special provision or it should go for normal provision. Now remember, if you opt for special provision, your tax liability is 96,64,510. I am talking about X because part 3 is not for Y. And in special provision, you are not liable for MAT. No MAT is applicable when you follow 115BAA. Assessee opting for 115BAA are not liable for MAT. Therefore, your final tax liability will be 96 lakhs, 97 lakhs approximately. But if you follow the general provision, what is the advantage over there? The advantage over there will be that you will be, what is the disadvantage? Sorry, not advantage. You also have to follow what? MAT. Then for that, you need to compute the book profit. The book profit is given in the question as 4.2 crore. So now we will compute tax liability as per both the provision and then we'll see which is more beneficial. So as per 115BAA, we know that the tax liability is approximately 97 lakhs. So let's compute the tax liability as per the general provisions. As per the general provision, your income is how much? Your income is how much? 61,20,000 that we have computed here. Okay, that we have computed here. As per the general provision, your income is 2 crore 4 lakh. On 2 crore 4 lakh, your tax rate will be 30% because your turnover of last year is exceeding 400 crore. You can see in this question over here, your turnover of last year. For you, the last year is 2018-19, and in 18-19, your turnover is how much? 402 crore. And because your turnover is exceeding 400 crore, you will be liable for 30% tax. So you will be liable for how much tax? 30% tax over here. 30% tax plus 7% surcharge because your income is more than 1 crore and 4% cess. Therefore, as per the normal provision, the tax liability is coming to approximately 68 lakh. The book profit is directly given in the question as 4.2 crore. 15% tax, 7% surcharge because the income is more than 1 crore, 4% cess. The book profit tax is coming to 70 lakh. Whichever is higher is this. So therefore, as per MAT, you are supposed to pay tax as per 70 lakhs. Therefore, it is beneficial to go for this particular thing rather than to go for what? Special provision and pay 96 lakhs. What sense does it make to pay 96 lakhs? Rather than that, go for the normal provision and pay tax as per 70 lakhs, 10,640. Check it, please. And further, you will also get a MAT credit of 2 lakhs over here, which you are not going to get over there. You can carry forward this MAT credit and set off against subsequent year's income. So it is better you go for the normal provision rather than what? The 115BAA. Okay. Now, let's come to the next question. The next question is based on trust. In this, there are 3 parts. First part says that the trust is registered as what? Any other object of general public utility. Now you remember that if the trust is registered as any other object of general public utility, then the commercial receipt cannot exceed 20% of total receipt. Now this trust commercial receipt is how much? 44 lakhs. The total receipt is how much? 200 lakhs. Therefore the commercial receipt is exceeding 20% of total receipt. Therefore the trust will lose its exemption for the current year. It is not going to get the exemption in the current year. Second question is based on what? Some rent paid by the trust. Now if a trust is paying some rent, then they are liable to deduct TDS. If they don't deduct the TDS, 30% of the expenditure will be disallowed. Now the trust is paying 12 lakhs in the current year and 15 lakhs in the next year. Okay, 12 lakhs rent is paid in the current year, 15 lakhs rent is paid in the next year, and for both the rent they are deducting TDS in the next year. So if for both the rent they are deducting TDS and making payment in the next year, so in that case the 12 lakhs rent, for that you have to disallow 30% in the current year, because for 12 lakh you are making payment in the next year. So for on 12 lakhs 30% comes to 3,60,000. That 3,60,000 will be disallowed in the current year, and because it is paid in the next year, it will be allowed in the next year. And for next year rent, you are making the payment in the next year before the due date of filing of return. So for next year rent, you will get the deduction of next year rent directly in the next year itself. Okay, so for next year rent there will not be any disallowance. Third case, a trust was there which was registered as a relief of poor. Now suddenly they change their object to any other object of general public utility. So if you are changing your object, or if you are adopting a new object, then you have to make an application to the Commissioner of Income Tax within 30 days. If you don't do that, your trust will lose its exemption. Okay, and your registration certificate will go, and therefore on you a credited income concept will be applicable, because you are no longer a trust now. You are losing to be a part of trust now. So now you will be liable for what? Accredited income as per the provisions of section 115 TD as per this question. Okay, next question. Question number 14 is based on a case law of Supreme Court of Bombay High Court, of 2016, which says that there was an assessee who was claiming deduction under ATIA, and suppose the deduction under ATIA was 50 lakh rupees. Okay, the gross total income was 50 lakhs and the deduction under ATIA was also 50 lakhs. Now suppose AO disallowed certain expenses and made it 70 lakhs. So suppose the AO added 20 lakh rupees. So the whatever income the AO is adding, will that also be liable for what deduction under ATIA? The Bombay High Court said that yes. Even the CBDT circular said that whatever income is added by AO in the form of disallowance, that will also be liable for what? That will also be eligible for what? Deduction under what? ATIA. Don't worry. Next question number 15 is based on transfer pricing provision, and in this there are 4 parts. The first part says that whether transfer pricing provision is applicable or not. Definitely it is applicable. One entity is Indian company, another entity is non-resident. Indian company has an asset of 60,000 crore and the non-resident has given a loan of 30,800 crore. How 30,800 crore? 350 crore into 88 rupees. That will come to 30,800 crore. So out of the total asset, 51.33% is financed by a non-resident. So both of them are deemed to be associate enterprise, and if both of them are deemed to be associate enterprise, both of them will be liable for what? Transfer pricing provision. The second part is, what is the primary adjustment to be made over here? Now, you are taking loan from your associate enterprise at 9%, whereas others give you loan at what? At 7%. So you are making payment of 2% extra. Therefore, 2% extra has to be added back. So how to compute 2% extra? 30,008 crore is the loan you have taken. Multiply by 2% extra. That will come to 616 crore. That will be added back to your book. That will be added back to your transfer pricing provisions. Okay. Now, third part. You need to identify the secondary adjustment over here. You need to elaborate on secondary adjustment, assuming that the primary adjustment is made suo motu by the assessee. Now, if the primary adjustment is made suo motu by the assessee, then the secondary adjustment will not be made if the amount is brought back to India within 90 days from the due date of filing of return. If the assessee does not bring back the money to India within 90 days from the due date of filing of return, that is till 20th Feb of the next year. Suppose if you are making the suo motu disallowance, if the due date of filing of return is 30th November 2022, then you have to bring back the money to India till 20th of Feb 2023. If you do not bring back the money to India till 20th of Feb 2023, you will be liable for what? Transfer pricing provision over here. How much provision, how much tax will be imposed over here? How much will be the secondary adjustment? It will be nothing but that is the 616 crore. That is the secondary primary adjustment multiplied by LIBOR. Why LIBOR? Why LIBOR? Because the transaction is in foreign currency. Therefore, multiply by LIBOR plus what? Apart from LIBOR, plus what? 3% extra will be imposed, and the interest will be charged from 30th November 2022 and not from 20th Feb 2023. Be very careful. Can I make one-time settlement with the government? That is part 4. Yes. On this primary adjustment, you can make a payment of 18% tax, 12% surcharge, 4% cess, and that will be one-time settlement. That one-time settlement, 20.9664% if you pay, then the government will not do secondary adjustment on that transaction. Okay. Next question number 16 is on transfer pricing. Sorry, is on non-resident taxation. There is a non-resident over here who's providing some FTS services to an Indian company, and there is an agreement, and that agreement is approved by central government. And there are multiple parts in that. In first part, it is said that India does not have DTAA with that country. So in that case, the FTS will be charged at how much? FTS will be charged at how much? It will be charged at 10% as per 115A plus surcharge if applicable, and 4% cess will be applicable always. Okay. Now, is the non-resident liable to file the return? Non-resident is not liable to file the return if the TDS is deducted. If the TDS is deducted, non-resident is not liable to file return because non-resident does not earn any other income apart from this FTS income, and the TDS is also deducted at the tax rate is also 115A. If the tax rate is lower than 115A, then the non-resident is liable to file the return. In this case, the non-resident is not liable to file the return over here. Okay. Second part, what if the FTS is 8%? Then the TDS will be deducted as per 8%. Then in that case, the non-resident has to prove that, because now you are applying the DTAA rate. The non-resident has to produce what? The tax residency certificate, TRC. Along with that, other documents and information will also be asked by the Indian tax authority. You have to give all that tax information to the tax authority. Then only you will get the benefit of 8%. Is the non-resident liable to file the return? Yes. Because the tax rate is lower than the rate mentioned in 115A, the non-resident is now liable to file what? Return under this case. In third case also, the third case is same as the first case only. First case and third case, there is no difference between third case and first case. And the last thing over here is, assume that if the non-resident has what? Assume that if the non-resident has a fixed place of business in India, then what will happen? If the non-resident has a fixed place of business in India, then 115A will not be applicable, then 44DA will be applicable, and all the provisions of 44DA shall apply because it has a fixed place in India. Therefore, all the expense will be allowed, but certain expenses will not be allowed. Suppose if an expense is not incurred only and exclusively for Indian branch, then it will not be allowed, and there are certain other expenses which will not be allowed to compute the total income. Are they liable to file the return? Yes, they are liable to file the return. They have to maintain books of account. They also have to conduct tax audit as per the provisions of 44AB. Okay. So let's go on to the next RTP, that is May 2022 RTP. This is the fourth RTP which we are doing over here. Now the first question is based on slum sale, and in slum sale you are selling one of the unit, that is Delta Limited. That is, you are selling your Omega unit to someone. Okay, at what price? You are selling at 600 lakhs, and this unit is a long-term unit because this unit was formed in 2010. Therefore, the unit is long-term. But it doesn't matter whether the unit is long-term or short-term. Indexation benefit is not going to be available in slum sale. I hope you know that. In slum sale, you have to compute your sale consideration and your cost. Your sale consideration is FMV1, FMV2, whichever is higher, and your cost is your net worth. First I am computing the cost. In cost, what all things will come? First of all, fixed asset, land will be valued at book value as per the net worth calculation. Okay, then comes the other fixed asset, that is your tangible fixed assets like plant machinery, that will be valued at WDV as per income tax law. So I will take 155 lakhs. Then for debtors I will take book value, that is the balance sheet value, and for liabilities also I will take book value, that is 45 lakhs. I will get my net worth. Okay, now while computing the FMV1, you have to be very careful. File FMV1 is nothing but the assets which you have transferred to the other person, that is which you have transferred to Delta. Okay, that is the buyer. Now for land you have to take, now while taking the FMV, while taking the net worth, the land is taken at book value, but while computing the FMV, the land will be taken at stamp duty value. Okay, the machineries will be taken at, other assets will be taken at what? Book values, that is 230 lakhs while computing the FMV. Rest of the things will be same, that is debtors will be valued at book value, and your your liabilities will also be valued at book value. Okay, now that will give you what your sale consideration number 1. What is FMV number 2? FMV number 2 is nothing but what you have received. How much you have received? You have received 600 lakhs. Therefore you will compare with your FMV1 with your FMV2. Your FMV1 is 627, FMV2 is 600, whichever is higher, that will become your FMV, and your cost is 540 lakhs. Then we'll compute your long-term capital gains. Long-term capital gains will be charged at 20% tax, no surcharge, because the income does not exceed 1 crore. 4% cess you will apply, and that will become your tax rate. Okay, you can check it over here. Now coming to the next question. Next question is a beautiful question. Assassi is a manufacturer which was set up in 2020, and Assassi is opting for 115 BAB. So be very careful. If the Assassi is opting for 115 BAB, the tax rate is 15% in some cases, 22% in some cases, 30% in some cases, and special tax rates in some cases. Now we have to compute the total income and tax liability of this particular Assassi. First of all, Assassi is purchasing some intangible asset of 22 lakhs, and it is debited to the PNL. So add back that, and then you compute 25 and you reduce 25% depreciation as per the block method. Okay, so add 22 lakhs and reduce 22% depreciation, 25% depreciation. Next, you are making some payment in cash to goods transporter of 32,000 rupees. Can you make a payment of 32,000 in cash to a goods transporter? Yes, you can. You can make payment up to 35,000 to them. It is allowed. Okay, for others it is 10,000. For these people it is 35,000. Next is a very intelligent adjustment. You have let out your part of your office at 60,000 rupees per month. That will make your total rent as 7,20,000. First of all, reduce this rent from your PNL account. You have to reduce this. This is not a part of PNL. This is not a part of profit. It will go to house property. You have also paid a municipal tax of 8,000. You have to add back this 8,000 rupees as municipal tax to your PNL account. Okay, in your PGPP you have to add it back. And now when you go to 115 BAB, you will show rent as 7,20,000. That's it. You will not take deduction of 8,000. You will not take 30% standard deduction, because 115 BAB Assassi does not get all these deductions. Be very careful. 115 BAB Assassi does not get these deductions. These deductions are not allowed for 115 BAB Assassi. Be very careful. Next, scientific research contribution you have made, that is also not allowed. 3512, 3513, 352AA, all of them are not allowed to 115 BAB Assassis. Next, you have made some payment but you have not deducted TDS, so 30% will be disallowed. Okay. Next, you have received some dividend from Gamma Limited, so reduce that dividend from PGPP and show under IFRS, and that dividend will also be taxable at 22% as per 115 BAB. The general income is taxed at 22% without any deductions. That will be subject to 22% tax. Okay. Next, you have purchased some shares of 100 rupees and then you sold for 280, and the whatever profit came, you have credited that to the books of accounts. So 100 rupees shares sold for 280, therefore your profit is 180 rupees per share into 1000 shares, therefore your profit as per accounts is 1,80,000. So that profit you have to reduce from your book profit accounts. Okay, from your net profit you have to reduce your accounting profit, and you have to show under capital gains. How much you will show as a cost under capital gains? You have to follow the grandfathering rule over here. What is the grandfathering rule? The FMV as on 31st Jan 2018, compare with the sale consideration whichever is lower, and then compare with the actual cost whichever is higher, and with that your cost comes to 110. That will be your cost. So therefore your cost is 110 and your sale consideration is 280, therefore your capital gains will be 170 rupees per share. That will come to 170 into 1000, that will be 1,70,000, and this will be taxed under 112A, and in 112A 1,70,000 will be taxed as how? 1 lakh will be reduced and 70,000 will be taxed at 10%. Okay. Next, tangible fixed asset depreciation, you have to add it back, and depreciation as per accounts, as per tax you have to reduce. Okay, as per tax you have to reduce. Then you have purchased some machinery, new machinery of 20 lakhs on 15th of November. You will get normal depreciation, that to half, because it is put to use for less than 180 days. You are not going to get any additional depreciation, because in 115 BAB, be careful, additional depreciation is not allowed, not allowed, not allowed. Last but not least, some employees you have hired over here, and because you have hired some employees, you will be getting 80 JJAA deduction. You will get the 80 JJAA deduction for the first category of employees, not for the second and the third category, because the emoluments is more than 25,000, and not for the fourth category also, because the number of days the employees were employed is less than 240 days. So fourth category also you are not going to get. For the first category you will get the deduction of what? 80 JJAA. After doing all these things, you are going to compute the tax liability. As I have told you, your dividend will be taxed at 20%, 22%. Your rental income will be taxed at 7,20,000 without any deductions, no municipal tax, no 30% deduction. Your LTCG will be taxed in excess of 1 lakh rupees, that is 70,000, will be taxed at 10%, and your other incomes will be taxed at 15%. 1115 EAB, 10% surcharge is always imposed, and 4% cess is always imposed. This is your tax liability. Okay, now coming to the next question, question number 19, which is based on MAT with Ind AS. So in MAT with Ind AS, you have to compute your book profit in two steps. First of all, compute book profit normally, and then compute book profit as per the OCI, that is other comprehensive income. First of all, what is your net profit as per PNL? Net profit as per PNL is 97 lakh 45 to 54,000. I will write that. Then second thing is, you have business loss, you have depreciation as per books of accounts. Generally, you have to take whichever is lower, but here you are going to take both. Why? Because the assessee has made an application to IBC. So if an assessee makes an application for IBC, very important point, then you get the deduction of both, what UAD also and brought forward loss also. Both you get if you make an application to IBC. So in this case, you are going to get the deduction of all of them. Okay. Now. There are certain items which will never be classified to P&L account. So items which are never be classified to P&L account, you have to add back and you have to reduce with some exceptions. Some items will be added back and reduced in the year of sale. Okay, that which are those items that I will tell you. So first of all, there is a deferred cost of hedging. You have to add this back because this will never be classified to P&L. Second, there is a changes in the fair value of equity instrument. Do not add this back because this is an exception which is given in the MAT with Ind AS concept, which says that this will be added back in the year in which it will be sold. So whenever it will be sold in that year, we have to add this back. Next, revaluation surplus of asset. Do not add this back. Do not reduce this because this is in the credit, so we have to reduce if we want to reduce it. You are not reduce this because this is also an exception. This will be reduced in the year in which you will sell that particular asset. In that year you are going to reduce. And the last two things does not come in exception, that will come in the general provision. And then for the last two things you are going to add it. You are going to reduce it from the book profit. Okay. So which item I am not going to reduce? The changes in the fair value of instrument I am not going to add, and changes in the revaluation surplus of asset I am not going to reduce because these two items will be adjusted in the year in which the asset will be sold. Okay. Now apart from this, the assessee also has some transition amount of 68 lakh rupees, but this transition amount is also including 8 lakhs of capital reserve, that is not included in the transition amount, and 6 lakhs of translation difference in foreign operation, that is also not included in the transition amount. So reduce these two items. After reducing these two items, your transition amount comes to 54 lakhs. After that, you have to divide that by 5 lakhs, and that will be allowed as deduction. That will be added back to your net profit, to your book profit for 5 years, for the next 5 years. Every year 10.8 lakhs will be added for the next 5 years. Okay. So add this 10.8 lakhs also. After you do this, you have to compute your what? You have to compute your book profit. Your book profit is 89 lakh 54. On that 15% tax, no surcharge because income does not exceed 1 crore. 4% cess. Your tax liability will come to 13 lakh 96,824. Your tax as per the normal provision is 12 lakh 80. Therefore, the difference between the two will be considered to be MAT credit, which you can credit in the subsequent years. Okay. Question number 20 is on trust. There is an assessee who is saying that they are engaged in educational purpose and hospital purpose, and they have received a gross receipt of 3 crore rupees each for both of them. That is for hospital 3 crore rupees they have received, and for education also they have received 3 crore. Now, because the total is exceeding 5 crore rupees, they cannot claim exemption without making application to CIT. They have to make an application to principal CIT or CIT, then only they can claim exemption under section 1023C. Otherwise, they are not eligible to claim exemption under 1023C. Next question is what? The assessee has some excess application in the last year. They want to set off that excess application in the current year. Is it allowed? Not allowed, not allowed, not allowed. In trust, excess application cannot be carried forward and set off in the subsequent year. That is not allowed. Okay. Next, the assessee has borrowed some 40 lakh rupees from a bank and has incurred that money and has used that money for the purpose of purchasing some building, etc. Will I get the deduction? No. This will not be considered as an application. If you take a loan and then apply, it is not considered an application. Yes, whenever you will repay the loan, at that time we will give you the deduction. Therefore, the assessee has repaid loan of 5 lakh rupees. Therefore, the assessee would be eligible for deduction of how much? 5 lakh rupees in the current year. Okay. Next, question number 21. In question number 21, this question is based on TCS and TDS. In the first question is based on TCS. The second question is based on TDS. The first question says that the assessee is remitting some 5,80,000 outside India for maintenance expenses of his son because his son is doing some education outside India in some university. So on that, he will be liable for what? TCS. Okay. Apart from that, he has also taken a loan from his employer. That is a mistake he has done. He should have taken a loan from a financial institution, because if he take a loan from a financial institution and then he remit outside India for education purpose, in that case he will get 7 lakh exemption also, and he will also get 0.5% relax rate also. But here he is not going to get 0.5% relax rate. He is doing both the things from the same person only. The authorized dealer is same. Therefore, 5.8 lakhs plus 7.8 lakhs, both of them will come into the same category only. If this 7.8 lakhs is taken from a financial institution in India, then this would have come in a separate category. Then 7 lakh exemption for 5.8 lakhs would have been separate, and 7 lakh exemption for 7.8 lakhs would have been separate. But here there will be only one time 7 lakh exemption considering both the amounts. Okay, 5.8 lakhs plus 7.8 lakhs minus 7 lakhs will be subject to 5% TCS. Second is a case of 194O, that is Amazon wala case. Amazon, and there is a resident seller. The resident seller has sold goods worth rupees 84 lakhs through Amazon, but the resident seller is not ready to give what? PAN and Aadhaar. So in case the PAN and Aadhaar is not given, in that case you are liable to deduct TDS generally at 20%. But in this case and in 194Q, these are the two sections in which if the PAN or Aadhaar is not given, you are supposed to deduct TDS only at 5%, 5%, 5%. So here the e-commerce operator, that is high sale, will deduct TDS at the rate of 5% of 84 lakhs, that whatever amount that comes to. Okay. Next one, question number 22 is the question which is based on NR taxation. Beautiful question. This is the foreign company. It is earning some incomes in India. The first income which is earned in India is income from technical know-how. That foreign company is providing some services to Indian company, and then Indian company is not making the payment in money. That Indian company is giving debentures to the foreign company of 30 lakh rupees. So this debenture is a consideration for the foreign company. So that debenture which is given to the foreign company, that Indian company will be taxed under which section? It will not be taxed under 115A. 115A is not applicable because for 115A to apply, the foreign company should have an agreement with the Indian company, and that agreement should be approved by central government. Then only 115A is applicable. Therefore, this 30 lakh rupees will be taxed at 40% normal rate. Okay. Now, that debenture which is given to the foreign company is also earning interest on that debenture. That is 2,85,000 rupees. That will be subject to what tax rate? Will that be covered in 115A? That interest also cannot be covered in 115A because again that loan is not in foreign currency, that is in Indian currency. That will also be taxable at what? 40%, 40%, 40%. So this first point is very, very, very intelligent point. Okay. Second one, the foreign company is invested in some GDR and they are earning 6,50,000 as dividend, and the GDR is also purchased to foreign currency. So this will be covered in 115AC and it will be taxed at 10%. Okay. Next, that foreign company has invested in some Indian company's equity shares. They are earning some dividend from Indian company, that will be liable to tax at 20% and under section 115A. Non-resident or foreign company investing into companies, Indian companies and earning dividend will be subject to 20% tax. Next one is also an intelligent point. That foreign company is giving some services to Indian company, and in return the Indian company is making the payment for royalty, and that royalty is now approved by central government, and there is an agreement between both of them. So this will come under 115A definitely. But the catch over here is this is the amount received by the foreign company. And if this is the amount received by the foreign company, this is not the income which is earned by the foreign company. This is the net amount. How much will be the tax rate? 10% will be the tax rate as per 115A. 4% will be the cess as per 115A. Therefore, the tax rate over here will come to how much? 10.4%. Therefore, this amount of 12,56,000 is received amount. And this received amount will be 89.6%. You have to gross it up. Gross it up. Be very careful. Whenever the word receive will come, you have to gross it up. You have to gross it up. So when you gross it up, it will come to somewhere around 14 lakhs, and then you will compute tax at the rate of 10.4%. Next is you have some business in Delhi on which you are earning 8,50,000 profit, that will be subject to 40% tax. Next is a mistake done by ICI. The long-term capital gains with indexation benefit comes to 132, without indexation benefit comes to 232. Now you have an option, you can take either of the two. So you can take, now what ICI has done, while computing the income they have taken 132, but while computing the tax they have taken 232. Now they cannot take two different amounts now. So you take one of the amounts here. Let's take 232, that would be more beneficial. Paying 10% tax on 232 is beneficial as compared to paying what 20% tax on 132. Therefore we are paying 10% tax on 232, and therefore this is what the question is all about. Now one last question is there over here. I am not doing that. You also don't do that before exam because it's a copy paste question of DTAA. DTAA questions are going to repeat again and again with same format. Same deductions, everything is same. Don't waste your time. Whenever a different kind of DTAA question will come, I will definitely address that. Otherwise, I'm not going to touch a unilateral relief question. Whenever a different question will come, I will definitely touch. If you want, if you have time, you can go through it on the day of exam. Don't waste time. Okay. So let's move on to the next RTP, that is RTP November 2022, and the first question over here is based on section 35AD and AMT and also on partnership firm. So there is a partnership firm over here who is starting with a new business of 3-star hotel. Therefore, there is an implication of 35AD. Now, there are two working partners over here, but there is no information of remuneration to partners. There is only interest to partners, no remuneration to partners. So let us compute the net profit and total income and tax liability of this particular partnership firm. First of all, the depreciation will be added back. The interest which they are paying is 15%. Therefore, you have to add back 3%. So I'm computing 50 lakhs into 3 divided by 15. I'll get the 3% interest. I will add that. Okay. And then the some amount is paid to some person on which TDS is not deducted. So 30% that will be disallowed. Okay. Now apart from that, they have also purchased some motor car of 7 lakh. On that they will get 35AD full 100% deduction. They have also purchased some land and building. Land will not be eligible for deduction, but building will be eligible for 50 lakhs full deduction 100%. And they have also purchased some air condition that will also be eligible for full 100% deduction. After doing all those things, you will get a profit, you will get a loss of 6,60,000 from this particular hotel, but they have also one more 4-star hotel in Mumbai in which there is a profit. So you can set off this loss against the 4-star hotel of Mumbai, and then the net profit finally after that will come to how much? 34,78,000. On that 34,78,000 you will be paying 30% tax because it is a partnership firm, 4% cess, and then there will be the tax liability which will come as follows. But this is not the final tax liability. In case of other than company, if they claim 35AD deduction, 10AA or other profit link deduction, they are liable for AMT. So now we are supposed to compute the AMT for this particular company, for this particular partnership firm. How the AMT will be computed? AMT is nothing but total income plus whatever deductions you have claimed in 35AD minus whatever depreciation you can get on those three assets. So on building, I will take 10% depreciation. On motor car, I will take 15% depreciation. And on air condition, I will take 15% depreciation, which is the normal rate. Because in AMT, you get the deduction for the depreciation on 35 AD assets. After doing all those things, I will get the adjusted total income, and then I will apply AMT of 18.5% compared with my actual normal tax rate. Normal tax is 10 lakh 85. AMT is 17 lakh, and therefore the differential amount will be considered to be what? The AMT credit, as you can see over here. Okay. So next question is based on a PGBP question where we are supposed to compute the total income and tax liability, and very important point, we have to follow here 115 BAA. So be very careful. This is an Indian company and engage in manufacturing, but because it is following 115 BAA, it will not be eligible for additional depreciation. The very first adjustment is depreciation 2 crore 80 lakhs you will add back. Second one is donation to political party, you will add this back to PGBP income, and while computing the total income from chapter 6A, you will not reduce because in 115 BAA you do not get the deduction of 80 GGB. 80 GGB is not available. In 115 BAA, only 80 JJAA is available and 80 M is available. 80 GGB is not available, so you will not take the deduction of this particular adjustment, okay, in chapter 6A. Next, donation to a certain scientific research association not available in 115 BAA, so you have to add this back. It is not allowed under 115 BAA. Next, you have received some dividend of 15 lakh rupees from a foreign company. So that dividend will be reduced from PGBP and it will be shown under IFOS. And on that deduction, you will get a deduction of 80M because you have declared a dividend of 12 lakh rupees before the due date. Before the due date, you have declared and distributed the dividend. So in 80M, you are going to get the deduction of what? 12 lakh rupees or actual dividend received, whichever is lower. So 80M is allowed with 115 BAA. Yes, as I have told you earlier, in 115 BAA, you get the deduction of 80 JJAA 80M. Okay. Next, you have some long-term capital gains on listed shares on which STT is paid. So this will be reduced from PGBP and it will be shown under capital gains, and it will be subject to 10% tax on 3 lakhs because in 112A you get an exemption of 1 lakh rupees. Okay. Next one is a very important adjustment. You have taken some loan for purchase of machinery. The loan is taken on 1st of June. It means you have to pay interest for 10 months from June to March. So interest of 10 months will come to how much? 35 lakhs. Now out of that, this machinery is put to use in January. The machinery is put to use in January. So from June to January, 7-month interest will be capitalized to the machinery. So out of this 35 lakhs, this 35 lakhs is interest of 10 months. So out of that, 7-month interest will be added to the machinery, and 3-month interest should be allowed as P&L account as a revenue expense, but that will also not be allowed because the 3-month interest is outstanding. It is not paid. Therefore, section 43B will come into picture, and 43B says that interest has to be allowed if it is paid, if it is taken from a scheduled bank, and SBI is the scheduled bank, and therefore this 3 months interest will be what? Disallowed. This 7 months interest will be what? Added to the cost of the machinery. Okay. Next one is you are selling some asset to your 100% subsidiary, and if you sell some asset to your 100% subsidiary, then capital gains is not attracted in respect of such asset. Okay. Therefore, this 8 lakh rupees will be reduced from PGBP and it will not be chargeable as a PGBP income. Okay, it will not be chargeable as a capital gains income. Forget about it. Next one is you are paying some salary of 1 lakh rupees for installation of machinery. That should be added to the cost of asset. So add to the P&L account, add to the net profit, and add to the machinery and claim depreciation on that. Okay. Next one is you have sold some goods of 22 lakh rupees, out of which 12 lakh rupees is written off in the books of accounts, and then remaining 10 lakh rupees is recoverable. Now suddenly the debtor died. He expired. Therefore, the remaining 10 lakhs should also be what? Claimed as a deduction under bad debts, because that is not going to be received now. Earlier you sold 22 lakhs, out of which 12 lakhs is written off. Now the remaining 10 lakhs will also not be received because the other person is dead. Therefore, reduce 10 lakh rupees. That is the adjustment for this particular adjustment. Next one is you can claim 1 crore 50 lakhs as your depreciation as per income tax law, and then you can claim 5% depreciation on office building because it is used for less than 180 days. You can claim 40% depreciation on computer because it is used for more than 180 days. And on machinery, you have to be very careful. 50 lakhs is the basic cost of the machinery. Plus 100 lakhs, you have to add back what? 50 crores is the basic. 50 crore is the basic cost of the machinery. Plus you have to add this 1 crore rupees as a foreign technician, which you have to capitalize. Plus you also have to add the interest, pre-use interest, that is 24.5 lakhs, which you have computed. And on that amount, you are going to claim depreciation at the rate of what? 7.5%, because it is used for less than 180 days. You are not going to get deduction of what? Additional depreciation. Forget about it. Okay. Now this is what this question is all about. And once you do this, you will apply what? The tax rate on 112A income on 3 lakh, as I have told you earlier, 1 lakh exemption, you are going to get 10% tax, and balance income 112A 22% tax, 10% surcharge, flat always on 112A income. Okay, and 4% cess. Now next question. Question number 26 is based on a question of REIT as well as AIF. There is one person, Mr. Rajesh, who is holding 10% equity in a REIT. Shipra is REIT and PQR is AIF. Now we need to compute the taxability of this particular income in the hands of Mr. Rajesh. And one important thing, Mr. Rajesh is following what? Mr. Rajesh is following 115 BAC. So we have to compute his tax liability as per the alternative tax regime 115 BAC. Be very careful. Now Shipra is a REIT. And now, if you receive a dividend income, one more important thing. In case of REIT, the income is taxable in the hands of investor on payment basis. Whatever REIT has distributed, that will be taxable in the hands of investor. In case of AIF, the income is taxable on accrual basis. Whether REIT has distributed or REIT has not distributed, whether the AIF has distributed or AIF has not distributed, it doesn't matter. It will always be taxable in the hands of AIF. Always be taxable in the hands of the investor. So in case of REIT, if the REIT is earning 100 rupees and distributing 90, then 90 is taxable in the hands of investor. In case of AIF, if the AIF is earning 100 and distributing 90, still 100 will be taxable in the case of AIF. Now, first thing is, we'll talk about the REIT implication. The first is dividend from GPL. GPL is SPV and SPV is not following 115BAA. If SPV is not following 115BAA, then the investor is not liable to tax. If SPV would have followed 115BAA, then investor would have paid tax on that dividend income. Okay. Next, interest income. Interest income, the SPV, the investor will be liable to tax on how much amount? Total interest is 3 crore. Out of which how much is distributed? Only 90% is distributed, that is 2.7 crore. Out of that, I am only 10% shareholder. Therefore, only 27 lakhs will be taxable in my hand. Then the company and the REIT will also deduct TDS at the rate of 10% on that under 194 LBA, and therefore I will get the credit of 2,70,000 over here. Okay. Next. What about the short-term capital gains? On short-term capital gains on sale of development properties, the REIT will pay tax at MMR. Investor is not liable to pay tax. Let's talk about AIF now. Business income, AIF will pay tax, investor will not pay tax. Losses of 27 lakhs will be carried forward by the investor because investor is holding the shares for more than what? 12 months. If the investors are holding the shares for at least 12 months or more, then the investor will carry forward. But in this question, there is no long-term capital gains. Therefore, we are not able to set off this 27 lakhs of long-term capital loss. If there would have been a long-term capital gains, we would have set off this 27 lakhs against that long-term capital gains. Okay. Now, this 52 lakhs. This 52 lakhs will be what? This 52 lakhs is interest income. Now, this interest income will be taxable in the hands of the investor on the basis of what? Not on the basis of distribution. 10% directly, whether distributed or not distributed, directly 10% of that will be taxable in the hands of the investor. Therefore, 5,20,000 will be taxable in the hands of the investor, and 10% TDS will also be deducted by the company. Okay. And therefore, then you have to compute the total income. On that, you have to apply 115 BSC. 115 BSC is applicable in this particular case, and you will take the credit of these two TDS, and net income will be, net tax will be payable by the assessee. Okay. Question number 27 is based on what? Is based on TDS and TCS provisions of the income tax law. Now, the very first question over here is about what? There is an Indian citizen, and if you compute the residential state of this status of this person, then this person is a non-resident. Now, remember, if a non-resident is coming to India on a visit, and if he is making some payment to tour operator, etc., then 2061G is not applicable. There is a specific CBDT circular. You can go and check in our easy notes also. It is mentioned in the easy notes. So, if a non-resident is coming to India for a visit, then 2061G is not applicable for that non-resident. Okay. Second question is what? Second question is based on 194Q and 2061H. Always remember, between 194Q and 2061H, always give preference to 194Q first and then 2061H. But in this question, 194Q is not applicable because the buyer is the first year of business. Buyer has a first year of business, therefore the last year's turnover is 0. Therefore, for buyer, 194Q is not applicable. For seller, 2061H may be applicable. How? The seller's last year turnover is more than 10 crore. Yes. And seller is purchasing the goods in the current year seller is selling the goods in the current year of more than 50 lakhs. So, seller will be liable for what? Collecting TCS. Now, in TCS under 2061H, TCS is not collected on accrual basis. TCS is collected under 2061H on receipt basis. And the receipt is happening 1 month after the sale. So, the sale is happening on 1st of August, receipt is happening 1 month after, sale is happening on 15th of September, receipt is happening after 1 month, after 1 month. So, on this 25 lakhs is not liable to collect TCS because TCS is applicable above 50 lakhs. So, now on the second sale, the 50 lakh limit is crossing. So, how much limit is crossing? 5 lakh is crossing. So, on the second sale, on 5 lakhs, he will collect TCS at the rate of 5%. So, when he will collect, when he is liable to pay, he is liable to pay 1 month after the date of sale. Okay, because the payment is received 1 month after the date of sale. It is written in the question in the last line. Okay, now last question, last point. 15 lakhs is the sale on 15th of December, but the payment is not received on 15th of December. The payment of receipt is 1 month after that. That is on 15th of Jan. So, on 15th of Jan, he will collect 0.1%. That is 1500 rupees. So, on 15th of October, 5 lakhs 0.1%. On 15th of Jan, 15 lakhs 0.1%. TCS will be liable for the seller in this particular question. Okay. Now, the next question is also a very good question. Question number 28. Mr. Ravi Prakash is a person whose wife, Mr. Sudha. Mr. Sudha does not have any great income. Her income is less than 2,50,000 rupees if you compute the total income of Mr. Sudha. So, Mr. Sudha is saying that I am not liable for what? Filing the return. Absolutely correct. But Mr. Sudha has done one transaction. She has purchased one car of approximately 26 lakh rupees. Okay, ex-showroom price. On ex-showroom price, TCS is collected. So, if you purchase a car of more than 10 lakh rupees, then you are liable for TCS. So, if a person is purchasing a car of 26 lakh rupees, how much TCS will be collected? TCS of 25 lakhs will be collected. TCS of 25,000 will be collected. That is 1% TCS under 2061F. So, do you remember that there is a specific provision made through a circular and through a separate rule, which says that if any person who is not liable to file the return, but his TDS or TCS is 25,000 or more in a financial year, then that person is also liable for what? That person is also liable for what? Filing the income tax return. As you can see over here, If a person's TDS or TCS is greater than or equal to 25,000 rupees, then that person is also liable for what? Filing the return. So that is what they have tested over here. That small circular, that small rule is tested over here. Therefore, Ms. Sudha has to file the income tax return because her TDS and is exceeding 25,000 rupees. If it is 25,000 or more, you are liable for what? Filing the income tax return. Now, question number 29 is same as what we have done earlier. That is of Lakshman Das Khandelwal case law, which we have done earlier also in the previous RTP. So, I'm not repeating. Question number 30. In question number 30, what is happening? There is an assessee whose total income is 28 lakhs. And in the assessment order, the AO has increased the assessment by 5 lakh rupees. Now, he wants to go to DRP. Can he go to DRP? Against him, there is no order of detention. There is no prosecution made. There is just a penalty which is imposed under 271D. That is all fine. Okay. That is all fine. There is nothing wrong in that in imposing the penalty. Now, there is one provision of DRC, Dispute Resolution Committee. Can he go to Dispute Resolution Committee? Who can go to Dispute Resolution Committee? A person whose total income is up to 50 lakhs. Tick. And the AO does not increase the income more than 10 lakhs. Tick. AO is increasing only 5 lakhs. And there is no order of detention against him. There is no prosecution against him. Tick. There is no need for penalty. If penalty is imposed, that is all fine. No imposition of penalty is not a condition mentioned in DRC. So he can go to DRC. Within how much time? He can go to DRC within 1 month. Within 1 month from the date of the specified order. So 26 November 2023 was the date of order. So within 1 month means he can go till 25th of December 2023. Now, once the DRC has passed the order, can he appeal against the DRC order? Against the DRC order, appeal is not possible, not possible, not possible. Last question but not least. If the assessment order is based on the information received with DTAA with country X, can he go to DRP? Then he cannot go to DRP. Very specifically, it is mentioned in 245 MA that if the assessment order is based on the information from DTAA from foreign country, then the DRC provisions are not applicable, not applicable, not applicable. Okay. Next question, question number 31 is a very beautiful question which is based on equalization levy. Now, there is an equalization levy section 165A, which says that if there is an e-commerce operator who is providing some services and he does not have a P in India and his turnover from India is 2 crore rupees or more, then he is liable for what? Equalization levy. So we need to check all these things. And the services which he is providing should not be in the nature of royalty and FTS. If it is in the nature of royalty and FTS, equalization levy is not applicable. Be very careful. Now, .inc is a non-resident? Yes. Does he have a website? Yes. Does his turnover is 2 crore or more? Yes. Is he having a P in India? No, he does not have a P in India. Condition number 4 is also fulfilled. And is he providing a services in the nature of royalty and FTS? He is not providing the services in the nature of royalty and FTS. The reason is, if you purchase a license of computer as an end user, the Supreme Court has said that in the case of engineering analysis center of excellence, that if you purchase the license in the form of an end user or to resale, then it is not a royalty, not a royalty, not a royalty. And because it is not a royalty, the non-resident is an e-commerce operator, his turnover is 2 crore or more, and he does not have a P in India, therefore he is liable for equalization levy at the rate of 2%. Okay. The next question is not something which I am going to do. That is based on DTAA question, so I am not much interested in that particular question. It is similar to what we have done in the previous questions. You can see the previous question once. You do not see DTAA question again and again. Anyways, you do not have time on the day of examination. Okay. And the last question in this particular RTP is, you are entering into a DTAA with country X, and in that case you are saying that you are entering into force on 1st of Jan 2019. In that case you are saying that DTAA, as per DTAA with country X, the dividend will be taxable at 15%. Okay. And that country is a country with OECD member. Who is an OECD member? Now, the next country with which you are entering into DTAA, after that you are saying that it is subject to 10% tax. Now this is wrong. Initially you entered into DTAA with country X and then at 15% DTAA rate, dividend rate, and then you entering into a DTAA with another country and giving a further relaxed rate of 10%. So both the countries are most favored nation and both the countries are OECD members since the very beginning, and therefore you have to give this benefit of 10% to the first country also. This is what the concept of most favored nation is all about. Now, in this question, if it is said that the second country, the first country became the member of OECD, the second country became the member of OECD in 2021, then this benefit will not be given because that particular country is not a member on the date on which we gave the benefit of 10% to the first country. Okay, so this is what this question is all about. Nothing great as such, as you can go through it once. Okay, now this question is more relevant in paper 60 rather than paper 7. So let's move on to the RTP May 2023, and in this RTP the first 15 questions are MCQ, which I have already discussed and put on YouTube. You can check in full English also. So I'm interested in explaining and revising the descriptive questions over here. First question is question number 16, which is a question which is based on Finance Act 2022 amendment. If you realize that this is an amendment, there is an amendment which came in Finance Act 2022 which says that if you have taken a loan from someone and if you are not able to explain the source of the loan in the hands of the lender, then it will be taxable in your hand in the form of cash credit. So in this case, a partnership firm has taken a loan from what? Its partner. Now it is the duty of the partnership firm to explain the nature and the source in the hands of the partner also. If the firm is not able to explain the nature and source in the hands of partner, then the firm will be liable for tax under section 115 BBE, and 115 BBE is liable for how much tax? 78% tax, and therefore the assessing officer is attracting 78% tax because the partnership firm is not able to explain the source in the hands of the partners, from where the partner has got the money to give the money to the firm. Okay, so this is what this first question is all about. Let's move on to the second question. Question number 17. This is also based on what? Finance Act 2022 amendment, very important amendment. It is very clearly written in the provision of section 43B, which says that if you take a loan from a financial institution and if there is an outstanding interest, then that outstanding interest is not allowed as deduction unless and until you make the actual payment. Now, can I convert that outstanding interest into a new loan and take the deduction? The answer is no. Can I convert that outstanding interest into a debenture or any other security and take the deduction? The answer is no. This is the amendment which is made by Finance Act 2022. So in this question, the assessee is taking a loan from a financial institution and converting the outstanding interest into a new debenture. That will not be allowed as deduction unless and until it is actually paid to the bank or financial institution. It will not be allowed as deduction. Okay, so this is what this question is all about. Now question number 18 has 5 different parts, which says that you have to identify whether the assessee is liable to file the return or not. So let's see whether the assessee is liable to file the return or not. Mr. Albert is there, his age is 31 years and his total income is just 2 lakh rupees. So by default, he is not liable to file the return. But because his turnover of business is more than 60 lakh rupees, he is liable to file the return. Do you remember that there is a separate amendment made by Rule 12BA or something like that? A circular was introduced by CBDT. It is also given in our easy notes. You can go and check over there that if your business turnover is more than 60 lakhs, you are liable to file the return. So because of that, the assessee is liable to file the return. Second, Mr. Ashish, age 42 years. Now he is liable to file the return by default because his PGBP income is 2.5 lakhs and his interest income is 4,50,000 rupees. So his gross total income is 7 lakh, and any person whose gross total income is 7 lakhs is liable to file the income tax return. Now the third and fourth case is also very simple. Third case, there is a partnership firm, and in fourth case, there is an XYZ private limited company. And we all know that for a partnership firm and for a company, it is always mandatory to file the return irrespective of the total income. So these two assessees are liable to file the return. Now the fifth case is a very intelligent case. In this, there is a person, Mr. Valish, whose age is 58 years. He has deposited 50 lakhs in saving bank account. Do you remember that? If a person deposits 50 lakh rupees in saving bank account, then he is liable to file the return. If he is depositing 50 lakhs or more in the saving bank account, he is liable to file the return irrespective of whether his total income exceeds what? Exceeds 2,50,000 or not, it doesn't matter. Okay, so by that default, by that logic, he is liable to file the return. Is he liable to file the return under the normal provision? No, under the normal provision he is not liable to file the return because his total income is less than the basic exemption limit. But as per the special provision, he is liable to file the return. Okay, now next question, question number 19 is based on search and seizure, and it is a very intelligent question. On 17th of April 2022, there is a search, okay, and the assessing officer found for 16-17 PY 23 lakh shares and for 17-18 PY 25 lakh shares. Now, for how many years he can send the notice? He can send the notice 3 years from the end of the relevant AY in normal cases. In special cases where the escaped income is 50 lakh rupees or more and it is represented in the form of assets like shares, land and building, advances, deposits, then it can issue notice up to 10 years. So now this does not come in the special case. Why? Because the total income which he has found does not exceed what? Does not exceed 50 lakhs. It is only 48 lakhs. Therefore, he cannot issue notice beyond 3 years. Now, what if this 23 lakhs is not 23 but it is 30 lakhs? This is part 2. If this 23 lakhs is 30 lakhs, then his escaped income will be more than 50 lakhs. Then in that case, he can issue notice even beyond 3 years. Okay, he can issue notice up to 10 years. Next, part 3 says that what if the AO has found that there was some expenditure of 52 lakhs incurred on the marriage of the daughter in previous year 16-17? Can he issue notice up to 10 years in that case? Yes. If there is an expenses or if there is an entry in the books of account, this is also a very latest amendment which was made in the last year only, that if there is an asset or if there is an expense or if there is an entry in the books of account, in either of the case, if it is of 50 lakhs or more, you can issue notice up to 10 years. This is what this question is all about. Okay. Now, next question is a very intelligent question and there are multiple parts in this question. If you go and see the solution, you will go mad that there are so many parts in this question. Question number 20. Now, let me give you a synopsis of this question. This question is on cooperative society, and cooperative society is engaged in marketing of agricultural produce grown by its member. Therefore, it is eligible for what? ATP. And a cooperative society which is engaged in the marketing of agricultural produce is eligible for ATP. Now, there are multiple provisions which we have to follow. First thing is there is a 10 new employees are employed by cooperative society of 20,000 salary, so they will be eligible for 80JJAA deduction. Okay, now all the employees are paid by account paycheck, therefore they are eligible for 80JJAA. there is no issue in that. Apart from that, the profit from agricultural income is 60 lakhs and profit and the interest on fixed deposit is 32 lakhs. Now be very careful. They have asked us to compute tax as per the normal provision, as per 115 BAD also. They have told us to do everything. So the first possibility is compute tax as per normal provision, and And if you're computing tax as per normal provision, you also have to compute AMT. When you compute tax as per normal provision, the first thing which you will take is PGBP 60 lakhs. And second thing is interest on fixed deposit 32 lakhs. And what deduction you will get? You will get deduction under 80 JJAA and you will get deduction under ATP of 60 lakh rupees. Compute tax as per the normal provision. Okay. And as per the normal provision, the slab rates, you all know that up to 10,000 no tax, above 10,000 10%, then 20%, then 30%, so on and so forth. Okay. Up to 10,000 10%, sorry, above 10% to above 10,000 20%, and above 20,000 it is 30%. Okay. Now, when you will compute the AMT, at the time of computing the AMT, you have to compute the adjusted total income. While computing the adjusted total income, you will add back 80 JJAA, but you will not add back ATP. Why? Because ATP is not liable for MAT. ATP incomes are not liable for MAT. Therefore, you will not add back ATP while computing AMT. One more thing to be kept in mind while computing AMT is now chargeable at 15% for cooperative society. By Finance Act 2022 amendment, cooperative society will be liable for AMT at how much rate? 15%. Be very careful. That is also an important issue over here. Okay. Next. Then you will compute tax as per 115 BAD. When you will compute tax as per 115 BAD, be very careful. You will not compute AMT because an assessee opting for 115 BAD are not liable for AMT. 115 BAD tax rate is 20%, 22%, 10% surcharge, 4% cess. Okay. Now, when you will compute tax as per what? 115 BAD. When you will compute income as per 115 BAD, in 115 BAD, you will get 80 JJAA, but ATP is not allowed. Only one chapter 6 deduction is allowed in 115 BAD, that is 80 JJAA. ATP is not allowed in 115 BAD. Now, the third possibility is we are supposed to assume that it is not an agricultural cooperative society, but it is a banking business. Suppose it is a banking business. That too, it is not an agricultural banking, not a primary agriculture credit society or primary cooperative. You are supposed to assume that it is not a banking company which is eligible for ATP. It is a normal banking company. So again, you have to make two computation. First as per normal provision and then AMT. When you will compute as per normal provision, you will take 80 JJAA. ATP is not now available only. Not available only. It is only available to primary credit society or for these kind of banking industries and not to others. Normal banking industries are not eligible for ATP. So compute normal computation. Take 60 lakhs, take 32 lakhs and take 80 JJAA. Do not take ATP. While computing AMT also, you will add back 80 JJAA. ATP is not there only. Anyways, it would have been then. Even then in AMT, we do not add ATP. ATP is not added back in AMT. Then compute your tax. Okay. Now, the fourth possibility, now assume it is 115 BAD. 115 BAD, when you will assume that, again you will add back only 80 JJAA because ATP is not there only, and you will compute 22% tax. And then you have to take a decision which is more beneficial. You can go through the solution. It's a very important question according to me. I can test on this question in your exam. Be very careful. Okay. Next question is based on 10AA. There is a limited liability partnership LLP, and this LLP has two units. Unit 1 is SEZ unit. Unit 2 is a domestic tariff area. Therefore, for unit 1, you will get deduction under 10AA. But while computing the tax liability, you have to compute the tax liability of the entire LLP. Now, therefore, the total income of LLP will be how much? Unit 1 has a profit of 710. Unit 2 has a profit of 840. Now, you have to disallow certain expenses because those are not as per the income tax law. So, in unit 1, you have to disallow 41 lakhs. Therefore, profit will become 751. And in unit 2, you have to disallow 55 lakhs. Therefore, profit will become 840 plus 55. This will be your total income. So, what will be your total income? 710 plus 41, 840 plus 55. This will become your total income. After you are computed with your total income, what are you supposed to do? You are supposed to take deduction under 10AA, and 10AA deduction is available how much? Profit into export turnover divided by total turnover. Now, what is the profit of unit 1? Unit 1 profit is 710 plus 41. Therefore, unit 1 profit is 751. But from profit, you have to remove two things because those two things cannot be part of profit. That is, duty drawback cannot be part of profit, and profit on sale of import entitlement license. We have done all these things in 10AA. You can go and check. You are not eligible for these two things. Okay. Then you have to compute the export turnover. Export turnover includes only those turnover which has received in India in convertible foreign currency. How much is received? 1600 is received. Now, out of 1600, 180 rupees is what? 180 rupees is what? 180 rupees is with respect to what? Out of 1600, 180 rupees is with respect to insurance and freight, and therefore insurance and freight will not form part of what? Export turnover. So out of 1600, I am removing 180, therefore my export turnover is 1420. Similarly, my total turnover is how much? Export turnover is 1800, domestic turnover is 300, total turnover is 2100. Again, out of total turnover, you are not supposed to take what? You are not supposed to take freight and insurance. Therefore, freight and insurance in total turnover is how much? It is 300. So I am removing 300 from here. Therefore, my total turnover is 1800. If I multiply this, I will get my deduction as 525.4. I will take the deduction. I will compute tax at 30%, and then I will apply surcharge also if applicable, because surcharge is applicable according to me over here because the income is more than 1 crore. Now I will also compute AMT now. While computing the AMT, what am I supposed to do? I will add back 525.4 to get the adjusted total income, and then I will apply 18.5% plus surcharge if applicable and cess of 4%. Okay. So this is what this question is all about. Now next question is based on computation of total income and tax liability, that too as per 115BAA. We have to follow 115BAA over here. But in this is the manufacturer assessee, but in 115BAA, even if you are manufacturer, you are not going to get the benefit of what? Additional depreciation. So let's see one by one all the adjustments, assuming that we are supposed to do the question based on 115BAA, not as per the regular provisions of income tax. First thing is the income tax. The opening stock is overvalued by 10%. It means the opening stock is 110%. So divide by 110% and add back to the pre-P&L account. And the closing stock is undervalued by 10%. It means the closing stock is 90%. So divide by 90% and add back closing stock also. So adjust this in your net profit. Okay. Next is you are buying some intangible assets of 65 lakhs on 15th October. So you have to add back this intangible asset and you have to take 25% depreciation on that. That too you have to take what? 50% of that, because it is used for less than 180 days. Intangible assets are subject to depreciation. They cannot be directly deducted from P&L account. Okay. So that's what I'm doing over here. Next one is 112A. You have purchased and shares for 85 rupees and then on 31st Jan the value of the shares is 195. This is the case of what? Listed shares. 112A will be applicable over here, long-term shares. And then when you are selling for 220. So you have to suppose to find out the grandfathering has to be applied over here. So first you will compare the FMV as on 31st Jan 2018 with selling price whichever is lower, and then you will compare with the actual cost whichever is higher, and therefore the cost will come to 195. The cost is 195, the sale consideration is 220, and if I compute the capital gains will come to 55,000. Now because the capital gains is less than 1 lakh rupees, it is not liable to tax, because in 112A you get an exemption up to 1 lakh rupees. Okay. Next, electricity charges of February and March is not paid. It doesn't matter. Electricity charges are not covered in 43B. It will be allowed based on what? Accrual basis also. There is no need to make any payment. Next, there is an hedging loss on purchase of raw material. It will be allowed as a PGBP expense, and PGBP deduction will be allowed on that. Depreciation has to be added back as per books of account. Then dividend from foreign company has to be reduced from PGBP and show under IFOS. Then non-compete fees which you have received is a part of PGBP. Let it be part of PGBP. Non-compete fees is a PGBP income only. Next, you have forfeited some amount on sale of land, on negotiation of transfer of capital asset. You have forfeited some amount. Do you remember that? If the amount is forfeited after 1/4/2000 on or after 1/4/2014, then that is considered to be IFOS. So reduce from PGBP and show under IFOS. And if it is forfeited before 31st March 2014, then you have to reduce from the cost of acquisition. Now, in case of unlisted shares, I'll talk about that in a while. Next, you have purchased some machinery of 70 lakhs and you have put to use in the month of November. And there is also a loss of foreign currency on that machinery. That machinery is imported. So if there is an imported machinery, imported asset on which there is a foreign currency loss, that has to be adjusted in the block of asset as per section 43A. So 70 lakhs is the cost of machinery, 2 lakhs is the exchange loss, and therefore the cost will become 72 lakhs. On that, you will take 50% depreciation, 7.5%, because the machinery is put to use in the month of November, and no additional depreciation will be allowed. Depreciation as per the normal provision will come to 35 lakhs, and then the next one is just an information. The next one is 80JJAA. Do you get 80JJAA in 115BAA? By default, you would have by hearted with this particular thing that in alternative tax regime, you get the benefit of 80JJAA. There are 59 employees, out of which 36 are employed from 1st June 2022 and at 15,000. So they will be eligible. But out of this 36 also, 10 employees are not eligible because their salary is paid by bearer check. If the salary is paid by bearer check, it is not eligible. Therefore, only 26 employees are eligible. The rest of the employees are not eligible. Either their emoluments is more than 25,000 or they are employed for less than 240 days. So only 26 employees are eligible out of 36 employees. The rest of the employees are not eligible only for the purpose of 80JJAA. Next, unlisted shares were acquired at 80 lakhs. Now be very careful. Unlisted shares are acquired at 80 lakhs and you have a profit on sale of 18 lakhs. Therefore, profit is 18 lakhs and purchase price is 80 lakhs. Therefore, the sale consideration will be 98 lakhs. Okay, this is how you have to compute backward. You have to go and compute the sale consideration, and then you have to index the cost of acquisition. The cost of acquisition is 80 lakhs. You have to index that, and that will be chargeable at 20% tax. Okay, and the rest of the income will be chargeable at 22% tax, plus all entire tax will be subject to 10% surcharge and 4% cess as per 115BAA. Next one is the same question which we have done earlier. You can go and check the chapter. Which chapter? Not chapter. One of the RTPs we have done in this session only. You can go and check that it is exactly the same question. I am not interested in doing this question again and again. You also don't do this question now for the second time before the day of exam, because it's a repetition of the entire provision. Okay. Now the next question is question number 24. Question number 24 talks about what? The transfer pricing. There is a non-resident with whom we are doing some transaction. Okay. Now that non-resident who gives us a guarantee of at least 12%. So if one entity gives a guarantee of loan of 10% or more, then both of them are deemed to be associate enterprise. Therefore, this transaction is what is deemed to be international transaction. Why? Because one of the entity is non-resident and the transaction is in the nature of purchase, sale, service, etc., and that one entity is giving guarantee of 12% to the other entity. Therefore, both of them are deemed to be associated. Therefore, transfer pricing is applicable in this transaction. Now, the second part is saying that suppose if the primary adjustment of 310 lakhs is made by the assessing officer on 1/4/2022, then and the assessee has not repatriated that money till 31st March 2023, then what are the possible options that are there with the assessee? The first option is there, he has to pay interest. Secondary adjustment will be applicable, because if on 1st April 2022 AO is doing primary adjustment, assessee should have brought back that money within 90 days from 1st April 2022 in India. If he is not bringing that money, he will be chargeable for interest from 1st April only. For the entire year, interest will be charged. At how much percentage? Because the transaction is in INR, SBI, marginal cost of lending rate plus 3.5%. Therefore, the interest rate will come to 9 plus 3.5, that will come to 12.25%. Therefore, on 310 lakhs primary adjustment, you will be liable for 12.25% interest. Pay that. Second option is what? For the entire year, because the interest will be counted from the date of order and the order is passed on the very first day. The second option which you have is pay additional tax at the rate of 20.9664, that is 18% plus 12% surcharge, 4% cess, and you will be relieved from tax interest. You will be relieved from secondary adjustment from the date of payment of additional tax. Okay. And one last question is over here. This will complete all the RTP. This is based on what? DTAA question. Don't see that. That is a very simple question, a repetition of what we have done earlier in the previous paper. Now, a lot of things will repeat. Whatever will repeat, we are not going to do that. Neither I am going to do that, nor you are going to do that. Okay. It doesn't make sense to repeat the thing because on the day of exam, we are short of time. Okay. So that's it. This is what the RTP is all about. All 6 RTPs, including the latest RTP, May 23, we have done it. For November 2023 attempt students, I will put separately whenever the November 23 RTPs will come. Okay. So I'm just stopping the lecture here, as you all have requested that, sir, give us the lectures in parts, sir. First, give us, sir, what? First, give us the RTP, at least give us the RTP. So today I am uploading the RTP videos. So in 2 days, I'll upload the MTP videos, and in another 2 to 3 days, I will also upload the past papers. If time does not permit, at least see RTPs and MTPs at least, if you're not having a time to see the past paper. Past papers can be ignored, but at least RTPs and MTPs has to be seen, because questions might repeat from this. There are high chances. From past paper, the questions might not repeat in the same form. They might change the portion and then they will ask. Okay. So if you will have liked the lecture, so please share this with all the South Indian students who are struggling to understand the Hindi videos which are there on YouTube. So I am doing my best for you all to put all the videos in English also simultaneously. It's a very difficult task for me also to record same thing twice, again and again. It's a very, very irritating thing. But that irritation I'm ready to take if thousands of students are benefited because of that. I'm here to take that irritation for you all. Don't worry about it. But you also can do that much favor for me, that you can share that with maximum students. And please, even if you like one of the questions of this particular RTP, please have a good and beautiful comment below. Okay. Take care all of you. Bye. See you soon fast with what? With the latest mock test paper. 8 mock test paper we are going to discuss, including May 23. So hello all my dearest students of South India. I hope you all are doing good. So here we have come up with our next video after the RTP super quick revision video. Now we are going to revise the 8 MTPs, 8 mock test papers for you all in full English along with Hindi also. For Hindi people, I have put a separate video. For South Indian, my dearest South Indian students, I am putting a separate English video altogether. So here we are going to cover 8 mock test papers, including the latest one, that is May 23 and November 23 one. Okay. So let us start without wasting any further time. Let's start with the mock test paper series 1, December 2021. The very first question over here is of a total income. We are supposed to compute total income as per the normal provision and the tax liability as per the normal provision. Ignore MAT, ignore 115BAA, etc. Okay. Now the assessee is a manufacturer and the assessee has earned a profit of 450 lakhs. You have to write down that profit in your P&L account and then add depreciation first of all. Now assessee has made some cash payments. Now if you make a cash payment on bank holiday, is it allowed? Not allowed, not allowed, not allowed. It is disallowed. It is disallowed. On a bank holiday, even if it is a bank holiday, public holiday, you cannot make a cash payment. You have to make the payment by account pay check, account pay draft, TCS or such other electronic mode. Second, if you make a payment for purchase of agriculture products, then it is allowed. Then it is allowed to make the payment in cash. Now, can you make the cash payment if it is demanded by the supplier? Not allowed, not allowed, not allowed. Can you make the cash payment to a transporter? Yes, you can make cash payment to a transporter up to 35,000 in a day. So in this case, it will be allowed. In this case, in 40,000 case, it will not be allowed. In 70,000 case, also it will not be allowed. So because for transport, for others, for normal people, the limit is 10,000. But for transporter, the limit is what? 35,000. Up to 35,000, you can make the payment in cash. Next one is, can you claim the deduction of scientific research in-house? Yes, you can claim the revenue expenditure under section 35(2)(ab). There is no harm in that. Okay. The next one is important one. You have received some dividend from foreign company. So you have to reduce this much dividend from your PGBP and you have to show that dividend under what? Under income from other source. Am I going to get this deduction of expenses? No, no, no. Only one expense is allowed against the dividend. That is interest expense. That too, if it is up to 20% of your gross dividend. It cannot be more than 20% of gross dividend. So this is not an interest expense. Therefore, this expenditure will be disallowed. It will not be allowed as a deduction in IFOs. Add back in PGBP. The next question is, you have made some payment of professional charges and in that professional charges, you have shown GST separately and on GST portion, you have not deducted TDS. So there is nothing wrong wrong that you have done. On GST portion, TDS is never deducted, and therefore you have not done anything wrong. Nothing will be disallowed over here. On GST portion, you have not deducted the TDS now. So in case of payment is made, and if the payment in the invoice, if the GST is mentioned separately, there is no need to deduct GST. There is no need to deduct TDS on the GST portion. So you have done absolutely correct. There is nothing wrong. Now you are purchasing some good from your related party, and you are making excess payment of 5 lakh rupees. So you have to add it back. Why related party? You are purchasing from a company in which the directors have substantial interest. So if there is a company in which your directors have substantial interest, then that company will also be considered to be your related party. You cannot make excess payment to them. Next, you are making some employer contribution. So employer contribution to PF can be paid till the due date of filing of return. This we have seen earlier also in RTP video. So you have made the payment before the due date of filing of return. This will be allowed. Secondly, employees contribution can be made as a payment up to 15th of the following month, that is before the due date of the specified fund, and you have made that payment also on time, so it will be allowed. That both the deductions will be allowed because employer payment is made before the due date and employees payment is made before the 15th of the following month. Next one, you have made some payment to electoral trust by cash. Now this will be disallowed in PGBP and it will not be allowed in chapter 6 also, because in 80 GGB if you want a deduction, the deduction has to be made in payment should be made by other than cash. If you make the payment by cash, then it is not allowed in 80 GGB. Now this one which is made as a payment to political party, it will be disallowed in PGBP, but it will be allowed in chapter 6A 80 GGB because this one is made in what? Check, not in cash. Then there is some normal depreciation which you can claim. Now there is some second hand machinery which you have purchased over here for 50 lakhs. On this second hand machinery you have purchased, unfortunately, this second hand machinery by bearer check, not allowed. If you are purchasing any asset and if you are making a payment of more than 10,000 rupees in a day to a person, then it has to be made by account pay check, account pay draft, ECS, and such as electronic mode. You cannot make the payment by bearer check or cash or by any other mode other than these 4 modes. If you do so, you are not going to get the depreciation. The question of additional depreciation does not arise only. Additional depreciation anyways is not allowed because it is a second hand plant and machinery. Even normal depreciation will not be allowed because the payment is made in what? Bearer check. Bearer check is not accepted. Next one, you have recovered some bad debts. Out of 3 lakhs, you have recovered 1.5 lakhs. So 1.5 lakhs which you have recovered, you should have credited that bad debts to this P&L account. But unfortunately, you have credited that bad debts to reserve account. So add that to PGBP. It is chargeable as a PGBP income. And the tax rate of this assessee would be what? It will be 25%, because the last year's turnover does not exceed how much? Does not exceed 400 crore. Therefore, the tax rate will come to how much? The tax rate will come to 25%. Will it be liable for surcharge? Yes. The surcharge will be at 7% because the income is more than 1 crore but not exceeding 10 crore. Therefore, the surcharge of 7% will be applicable to the assessee. You can check this over here. Okay. Now, coming to the next question. That next question is based on what? MAT. So you are supposed to compute the book profit over here and also the minimum alternate tax. So the net profit is 95 lakhs and now the following are the credits. The first credit is ATIA income. ATIA is subject to MAT, therefore do not adjust. Let it be part of book profit, let it bear the burden of MAT. Next, dividend from Indian companies are subject to MAT, let it be part of book profit. Next, agriculture income are not subject to MAT, therefore reduced from book profit. Next, depreciation you have to add back and then you have to reduce the depreciation other than revaluation. Now, how much is the depreciation on revaluation? Depreciation on revaluation is 1,90,000. Therefore, how much is other than revaluation? Other than revaluation will be 10 lakhs minus 1.9 lakhs. Therefore, other than revaluation would be 8.1 lakh. Therefore, what is the effect that you are going to give? Add 10 lakhs, which is debited to P&L, and then reduce other than revaluation depreciation. Other than revaluation is 8.1 lakh, so you have to reduce that. Okay. Penalty for infraction of law, do not add. In MAT, penalties and all are not added back. Interest on income tax is added back in MAT, but not penalty. Okay, but in normal provision, yes, it is added back. Provision for GST, in MAT, whether the GST is provided or paid, it doesn't matter. In MAT, it doesn't matter. In normal provision, it matters. So do not add, do not add, do not add. Provision for doubtful debts, yes, add back that, because this is considered to be what? Provision for doubtful debts is added back in MAT because it is considered to be what? There is a particular term used in MAT. Provision for doubtful debts. Yes, that is diminution in the value of asset. This is considered to be diminution in the value of asset, so add back. Next, interest which is unpaid, doesn't matter. In MAT, 43B is not applicable. Do not add back, let it be part of MAT. Okay, let it be part of MAT. Do not add back, do not add back. Now, reserves of currency for foreign fluctuation. Yes, that has to be added back because any transfer to reserve has to be added back in MAT. After doing all these things, what are you supposed to do? You are supposed to compute the tax liability. Now, what is the tax liability of this assessee? The tax liability of this assessee will come to 15% MAT. Surcharge will not be applicable because the book profit is less than 1 crore. Therefore, no surcharge. 4% cess you will apply and you will get the minimum alternate tax. Okay. Now, the next question number 2B. Now, question number 2B is a simple question on DTAA. Very simple question. So, I will just address some important points which are there in this question. Otherwise, it's a routine question which I have said you while solving MTP also. Just do 1 or 2 DTAA questions. Most of them are same only. Now, the important points over here is the assessee is 60 years old. He is a citizen of India and he is resident. Now, be very careful. So he will be taking these two incomes, income from rifle shooting in country X, income from rifle shooting in country India. Then he will get the deduction of LIC 1,10,000 and PPF 1,50,000, but the total of these two cannot exceed how much? 1.5 lakhs, because both of them are covered in what? ATC. This is the first important thing that you have to keep it in your mind. The second important thing, he is making some payment of medical insurance premium for his father, whose age is 82 years. So we are assuming that his father is a resident. If we are assuming that his father is a resident, then we can get the deduction of entire 32 lakhs. Because if the parents are resident senior citizen, then you get an updated limit of 50,000 rupees as deduction under 80D. But if we assume that the father is a non-resident, then we can get a deduction of only up to 25,000 rupees. Apart from that, the question is very simple. You're not supposed to follow what? 115 BSc, compute tax as per the normal provisions of the income tax law. Okay. So this is what question number 2B is all about. Let's come to question number 3. Now this question number 3 is a very important question. This is a very favorite question of ICI. I don't know why they are asking this question again and again. Now what is this question? This question is on transfer pricing method, that is cost plus method. Now there's one company, Infotech, which is in India, and there is one company, Rida, which is outside India. Both of them are associate entity, because one entity holds 45% shares of the other entity, therefore both of them are associate. Now what happens in cost plus method? In cost plus method, first of all, you are supposed to find out the cost, direct and indirect cost of the services and the goods which are provided to the associate enterprise, and therefore the direct and indirect cost of the service and the goods which are provided to the associate enterprise is 25 lakhs. Okay. Now you are supposed to compute the second step is the profit margin, GP margin of the services which are provided to uncontrolled transaction, which are provided to unrelated party, and therefore the unrelated party over here is Mira Industry. To Mira Industry, we are providing services, same services, similar services at 50% on cost. Now what are you supposed to do? You are supposed to adjust this GP. Now for that we need to find out the functional differences between both the transactions. Now when you are providing services to Rida, in return Rida is also providing you some services. Okay, and if Rida is also providing you some services, I am giving you some services, so I am doing one favor on you, but in return you are also doing some favor on me, so I should charge more profit or less profit? I should charge less profit, because you are also giving in return something to me. Okay, suppose if I am teaching to you something, so I am taking 14,000, but in return you are also teaching something to me, so I should not take 14,000, I should take 10,000, 12,000, 8,000, lesser amount, because you are also teaching something to me for free. So this is what it is happening in point number 1. Rida is giving technical support which may be valued at 10% of normal GP. Now normal GP is 50%. What is 10% of 50%? 10% of 50% is 5%. So that much 5% you have to reduce from what? From your GP margin of 50%. Okay. Similarly, when you are providing services to Rida, Rida is giving you some discount. You are giving some discount to Rida. So if you are giving some discount to Rida, the profit margin has to be lower. So in that case, how much lower? It is 15% of normal GP. If it is 15% of normal GP, it will come to 7.5%. The normal GP is 50%. 15% of 50% comes to 7.5%. So that much has to be reduced from here. Okay, from 50%. Then you are giving a credit of 90 days to Rida. If you are giving credit of 90 days to Rida, you are not giving that credit to Mira. If you are giving that credit to your associate enterprise and not to others, obviously you will charge more profit to your associate enterprise. So now while computing the credit, you are going to add this back. Okay, so while computing the credit, you are going to add this back. Now how much you are going to add back? That is also written over it, which is measured at 15% of now normal billing rate. Now it is not written 15% of GP, 15% of GP, 10% of GP, 5%. Now they are not writing that. Now they are writing 15% of normal billing. Normal billing is of 100%, 100 rupees. So 15% of 100 will come to how much? 100%, 15%. So you have to add back 15%. So there are 3 adjustments that you are going to make. 5% you are going to reduce from 50, 7.5% you are going to reduce from 50, and then you are going to add 15%. Once you do that, you will get your arm's length GP as 52.5%. Once you get 52.5% as your arm's length GP, you are going to add that arm's length GP to your cost, and then you will get your arm's length price. And then you will compare with your actual transaction, and then you will see how much is the difference between the two. It's a very important question and very famous question asked by ICI again and again, time and again. Lot of time they have asked this particular question in the exam. Okay, with the same adjustments. Example number 4, question number 4. We are supposed to, there are 2 parts in this question, and we are supposed to find out whether the tax deduction will be done or not. First one is, there is a commission agent. There is a consignee who is retaining his commission. Am I supposed to deduct TDS on retention of commission? Yes. 194H very clearly says that the TDS provisions will be applicable even on retention of commission. Suppose if I tell the consignee that sell goods on my behalf for 1,50,000 and then give me 1,30,000, 20,000 you can keep as your commission. So if he is retaining his commission, I am not paying him commission. He is retaining himself. On that also TDS is applicable under the income tax law. Okay. Next. If I am giving a contract to some person, okay, suppose if I am giving a contract to you, and if I am giving a contract to you and I am telling you, design, make a product for me, you will definitely ask me, who will give the material? I said, I will give you the material. So if I am giving you the material and you are making the product for me, then you are doing a service for me. And if you are doing a service for me, I am supposed to deduct the TDS. And if I am supposed to deduct the TDS, the question will be on how much amount I will deduct the TDS. That depends upon how you raise the invoice. If you raise the invoice by giving the breakup, this much is for goods, this much is for service, then I will deduct TDS only on the service portion. But if you give me a consolidated invoice without any breakup, then I have to, under pressure, I have to deduct TDS on the entire amount. You might not like that, but I have a pressure from the government of India that you have to deduct TDS on the entire amount. Okay, so this is what this question is all about. I put an example over here. I used to give an example of a tailor who is making some, who is stitching some clothes for you, and you are giving the cloth, so he will deduct TDS. You will deduct TDS only on the stitching charges, not on the entire amount if the breakup is given. Okay, the next question is based on a transfer pricing question, which is exactly similar to question number 15 of the RTP, which we have discussed earlier. So I'm not discussing the repetitive question. I request you all to again not go through this question once again. If you have seen that question number 15 of RTP discussion, again you are not supposed to repeat this question once again. This is just a change of numbers. That's it. Exactly the question is same. You are not supposed to repeat this question once again. Next question, question number 5. Question number 5, part A is very important. I don't know why they like this particular question a lot, but they have been asking this question again and again. There are multiple questions in this. The first question is, what are the circumstances under which the AO can go for provisional attachment of the property? The provisional attachment provisions are given under section 281B. Now, what are the circumstances under which the AO can go for provisional attachment? First is when the assessment or reassessment is pending. Pending is pending. Second one is not mentioned in the book, but you can write it down. If there is a penalty proceeding under 271 AAD, penalty proceeding under 271 AAD, which is pending before the AO, and listen carefully, and the penalty is up to 2 crore rupees, then in that case also AO can go for what? Provisional attachment. Why he will go for provisional attachment? To protect the interest of revenue. Is he supposed to take approval from someone? Yes, he's supposed to take approval from principal commissioner, principal chief commissioner, director general. There are a lot of authorities you can go through in the solution. Next question is, also state the period for which he can attach the property. He can attach the property for a period of 6 months. Can it be extended? Yes, it can be extended for up to 2 years or within 60 days from the end of the assessment, whichever is later. Up to 2 years or within 60 days from the end of the assessment, whichever is later. Last but not least, can AO, after invoking the provision of provisional attachment, can he revoke also? Can he go back? Can he take back his decision? Yes, he can take back his decision if the assessee gives a bank guarantee from a scheduled bank of an amount equivalent to what or more than what the FMV of the asset attached. So if the FMV of the asset attached is 5 crore, and if the assessee takes a bank guarantee from a scheduled bank and gives the department a bank guarantee of 5 crore or more, then the AO can revoke what? The provisional attachment. The next question is based on GAR. To explain this question, I have made one diagram over here. With the help of this diagram, I'll try to explain you this question. Now, there is one company over here, I Private Limited, which is in India. Be very careful. Now, there are multiple parties over here. There is another company, D Private Limited, in country X. There is another company, Z Private Limited, which is 100% subsidiary of D Private Limited. Now, Z Private Limited and I Private Limited has formed a JV for a particular transaction, and that JV is termed as R Private Limited. So, one more company is formed in the form of a JV, which is held by I Private Limited and Z Private Limited. 49% equity is held by Z and 51% equity is held by I Private Limited. Now, what happens? This Z Private Limited is not doing any great activity, no other activity except what? Forming this JV. There is no other objective except forming this JV. Now, this Z Private Limited has allowed the D Private Limited to sell the shares on behalf of Z Private Limited. So now the actual owner in this JV is who? The actual owner in this JV is Z. But the Z has permitted D, that is the holding company, to sell the shares. Okay. Now, why they have done so? They have done all these things only because of one reason. That is to evade tax. This is an impermissible avoidance arrangement. There is the only objective of doing all those things because the DTAA between India and country X is beneficial as compared to DTAA between India and country Z. They have done all these things just to what? Just to avoid tax. And therefore, the GAR provisions will be applicable. For more detail, you have to read the entire provision because the GAR is a very technical topic whereby you need to learn the important terms over there. Tax benefit, tainted element, impermissible avoidance arrangement. We have done all these things in the class, but still, to understand that in a better manner, you have to go to the solution once if you want. Okay. But it is an important question. They have asked this question at least 2 times in the exam. Next one is a question of poem. There is a company which is incorporated in Malaysia. So it's a non-resident. Now, more than half of the board meetings are done outside India. Total 9 board meetings are done, out of which 4 are in India, 5 are out of India. Now, we need to find out the residential status of this company. So if the company satisfies the ABOI test, and board meetings more than half are outside India, then the company is non-resident, otherwise the company is resident. In ABOI test, what is the first condition? The passive income should be less than equal to 50% of total income. Now, what comes in passive income? What comes in passive income is very clear. Income where purchase is from associate enterprise and both sale is also from associate enterprise, purchasing from associate enterprise and selling from associate enterprise, that is a passive income. So the first two incomes are not passive income, because in that case you are either purchasing or either selling. You are not doing both. You are supposed to do both, purchase from associate, sell from associate, then only it is a what? It is considered to be a passive income. So only passive income is this 5 crore, 5 lakhs, whatever it is, 5 crore and 10 crore. Now apart from that, what is other passive income? Interest is passive, dividend is passive, rent is passive, royalty is passive, capital gain is passive. So these incomes are also passive. So if I take the total of passive income, it comes to 50 crores. And if I take the total of total income will include what? Will include this, this, this and this. This is the total income. So that will come to 50 divided by 110, 45.45%. So it is less than equal to 50%. Therefore, condition number 1 is fulfilled. What is condition number 2? The assets in India should be less than 50% of the total assets. How much assets in India are there? These are the assets which are there in India, which I have circled. And how much assets are there total? I have to take the total of all of them to 210 divided by 610. Again, it is less than 50%. Third condition, the employees in India should be less than 50%. The employees in India are 70 and total employees are 70 plus 90, 160. Again, it is less than 50%. So this condition is also fulfilled. And last one, the payroll expenses for employees who are situated in India or resident in India should be less than 50%. Yes, that is also 8 divided by total 20. That is also less than 50%. But one thing you have to be very careful. For passive income test, you have to check 50% or less than. Both would be fine. 50% would also be fine. Less than 50% would also be fine. But for asset and employees, it has to be less than 50%. Exact 50% is not sufficient. It has to be less than 50%. Be very careful. So all the conditions are fulfilled. Therefore, the assessee is what? Non-resident, non-resident, non-resident. You can go through this question, this mock test paper once. Okay, then we'll go ahead with the next one. So let's move on to the next mock test paper, that is mock test paper 2 December 2021. In this question, we are supposed to only compute the PGBP income. That's it. Nothing else has to be computed. Do not follow 115 BAA. Do not follow the MAT provision. Ignore all those things. Okay, the very first thing is manufacturing assessee is there. So additional depreciation might come over here. 560 lakh is the profit. Add the accounting depreciation has to be added back. The next adjustment is you are receiving some benefit or concession from Uttar Pradesh government. So that will be taxable as income under section 224(18). Any benefit, any perquisite, any subsidy, grant, reimbursement, concession from central government, state government, body, agency, it is considered to be income. So let it be part of PGBP income. You are making some payment of scientific laboratory to national laboratory, so that will be allowed as deduction under section 35(2)AA. Okay. The next one we have done earlier. You are selling some goods to, you are selling some land to what? You are selling some land to your entity, which is what? 100% subsidiary. So if you are selling some land to a 100% subsidiary, then that is exempt, provided the recipient is what? Is an Indian company. If the recipient is an Indian company, it is exempt, and exempt. Okay. So what you will do in this case, reduce from PGBP and then write a note that it is exempt under capital gains. Next one is you are making some transport payment to transporter on which generally TDS under 194C will be applicable, but here no TDS will be applicable. Why? Because the transporter is giving a declaration that he is following 44AE and he is also giving PAN. So if the transporter is giving declaration that he is following 44AE, it means he does not own more than 10 trucks. So do you remember that there is a relaxation under 194C that if the transporter does not own more than trucks and he gives a declaration that he does not own more than 10 trucks, and if he gives a PAN, then there is no need to deduct TDS under 194C. Therefore, this is relaxed. Okay. Next one is you are purchasing some second-hand plant and machinery on which you have taken a loan and you have paid an interest of 15 lakh rupees. But out of that, 5 lakh rupees is interest, is pre-use interest. It means it was an interest for the period when the asset was not put to use. So on 5 lakh rupees, you are not going to get that PGBP deduction. So add back 5 lakh rupees and that 5 lakh rupees should be added to the machinery cost and you will get 15% depreciation on that 5 lakh rupees. Okay. Because that is before the asset was put to use. So that interest will not be go to PNL. It will not be considered as a revenue expense. That has to be added to the cost of the asset. So add that to the cost of asset and then what? And then take depreciation and also add that to the PNL account because you cannot get the deduction of that 5 lakh rupees. Next one is you have sold some goods to your debtors and that debtor has become insolvent. So you have claimed the deduction of 20 lakh rupees as your bad debts and you have written off that bad debts in the books of accounts in the statement of PNL account. So you will get that deduction under section 3617. That is allowed as a deduction. Okay. Next one, you have received some additional compensation from the state government in pursuant of an interim order. Now, do you remember that if you receive some compensation from the government because of the interim order, then that is not taxable now. That will be taxable in the year in which the final order is made. Do you remember that? That is written in section 45 subsection 5. Go and check. If you receive any amount as a compensation from the government in pursuance of an interim order of the court, that will be taxable in the year in which the final order will be passed. Therefore, this 5 lakh rupees will be reduced from the PGBP and it will be taxable in the year in which the final order will be passed. Okay. Next, there is a non-resident. There is a non-resident fast tax INC who does not have a P in India and that non-resident is giving some online advertisement service to us. Do you remember that? This is a classic case of what? Equalization levy, and you are making a payment of more than 1 lakh rupees to that particular non-resident. So it's a case of equalization levy. You should have deducted equalization levy. You have not deducted equalization levy. Therefore, this expenditure of 5 lakh rupees will be disallowed. Next, you have paid some fees to consultant on expert opinion of new business setup. So if you are setting up some new business, it's a capital expenditure. So therefore, that capital expenditure will not be allowed as a deduction under the income tax law. Next one is very simple. As per the income tax rules, take the depreciation. Next one, you have issued some debentures on discount. How much discount? 3% discount. Now that discount is your cost. That will be allowed as deduction to you over the life of the debenture. Therefore, what will be the total discount? 1500 lakhs is the value of debenture. 3% of that will come to 45 lakhs, and that will be allowed over a period of 5 years. So in 5 years, you are going to get deduction of what? 9 lakhs each every year for the next 5 years. Next, you have purchased some cotton from your supplier in the month of March. The bill is of also March, but you failed to record that particular transaction in the month of March. You are failing to record a transaction, you are failing to record a purchase in the month of March, you are recording in April. That is wrong. You should record in March. So record that in March, take that deduction in the month of March itself, and take the deduction in the month of March, and you will get the deduction. Okay. And last but not least, you are purchasing some goods from cotton from your related party at 5,000 rupees, whereas in the market, the fair market value of that particular cotton is 4,600. Therefore, the differential amount, that is 400, will be subject to what? Add back under section 48(2), excess payment to relative, multiply by 1,000 bales, that will come to 4 lakh rupees. You have to add it back. Now, after that, are you supposed to compute any other tax or any other total income? No, you are only supposed to compute PGBP income. No tax, no total income, nothing has to be computed. Check it, please. Now, the next question is again a very important question, which is based on section 4713B. What happens in 4713B? A private company or an unlisted company is getting succeeded or getting converted into an LLP. Then what will happen? What will happen in that case? It is getting succeeded on 1st of November 2022. The first thing, can I carry forward the depreciation from here to there? Yes, you can carry forward the depreciation from here to there, but later on, do not violate any condition. If you violate any condition and if you carry forward and set off the depreciation, then that depreciation will become deemed income. Okay. Next, can I carry forward and set off the brought forward losses also of the predecessor to the successor? Yes, you can do so. And here there is a great advantage that you can carry forward for another 8 years, because in the law it is written that even though the loss is of 14-15, it will be deemed that the loss is of 22-23. That is the year in which the succession is happening. You can carry forward that loss for another 8 years. And that is a great advantage. Again, here also you should not violate any conditions later on. Otherwise, whatever loss you have claimed, whatever loss you have carried forward and set off, that will become deemed income. Can you carry forward MAT credit? That is not allowed. The company, the unlisted company or the private company might have some MAT credit. Can I carry forward that also? That is not allowed under 4713B. Next one, what will happen with the WDV of the assets? Now, there are two types of assets. One is normal asset and other is 35AD asset. Remember, for 35AD asset, nobody is going to get the deduction. Neither the predecessor will get the deduction because they have already claimed 100% deduction on that, no depreciation deduction, nor the successor will get deduction on the 35AD, because it is very clearly written in explanation 13 to 43(1) that once an asset is subject to what? 35AD deduction, then the actual cost of that asset is nil. You will not get any deduction. Now, what about the other assets? In respect of other machineries and in respect of there is one more building, what will happen? Now you have to think from two perspectives. What will happen with the current year depreciation? The current year depreciation will be bifurcated between the predecessor and the successor. Okay. And what about the WDV in the hands of the successor? The WDV in the hands of the successor will be very simple. The WDV in the hands of the predecessor minus the current year depreciation which the predecessor has claimed, minus the current year depreciation which you are going to compute over here with the predecessor has claimed. You will reduce that and you will get what? You will get the depreciation, you will get the WDV in the hands of the successor. Okay. Next, what will happen to the cost of land? The cost of land which is purchased by the predecessor will become the cost in the hands of the successor. Fair market value is not relevant. It is given under section 49 subsection 1. The cost to the previous owner will become the cost in the hands of the successor. Last but not least, 3 years back, they have incurred some VRS ka expenditure of 27 lakhs. Now, we all know that under section 35 DDA, VRS is allowed as deduction in 5 installments. Therefore, per installment will come to how much? Divide by 5, it will come to 5.4 lakhs. Now, the last 2 years, predecessor would have claimed. The next 2 years, successor will claim. Who will claim in the current year when the succession is happening? When the succession is happening, the law says very clearly the entire VRS expenditure will be claimed by what? Will be claimed by the successor itself. That is the LLP itself. The successor will claim the entire VRS. That is entire 5.4 lakhs of the current year. It is not going to be bifurcated between the predecessor and successor in any ratio. Okay. So this is what the treatment of this question is all about. The next question is a very, very good question, whereby there is one company by the name called as KP Limited, which is in India, and there is one company by the name called as LM Limited, which is in NJA, notified jurisdictional area. Now remember, if any person enters into a transaction with any person located in NJA, that transaction is deemed to be international, that relationship is deemed to be associate enterprise, and you have to apply the transfer pricing provision. And you do not get the benefit of 3% also, which you get generally when you do not follow the range concept. When the number of items are less than 6, do you remember that? You take arithmetic mean and then you compare with your arm's length price with your actual price, and you see whether 3% difference is there or not. That 3% difference should also not be seen over here. Now, what is happening over here? There is one entity which is in India and another entity in NJA, therefore both of them are deemed to be international transaction. So you are selling to them at 11.4 crore, whereas to others, to other unrelated party, you are selling at 12.6 crore and 12, 13.4 crore. Okay, so that is wrong. To people who are in NJ, you are selling at lower price, and to third parties, other third parties, you are selling at higher price. But it is wrong to compare directly. There might be some functional differences between the two. To NJ, to person located in NJ, you are selling at FOB. But to person located not in NJ, the third party, you are selling at CIF. And the insurance and freight amounts to 20 lakh rupees. So you have to reduce that 20 lakh rupees from your what? From your price. Okay, from 12.6 crore and 13.4 crore, reduce that to make both the prices at par. Further, to NJ person, you provide some after sales. To third party, you provide some after sales service. To NJ person, you do not provide after sales service. You can see you provide after sales service of 12 lakhs to all customers except that the person who is located in NJ. So that much also you have to reduce. After that, you will get 2 arm's length price. But if there are more than 1 arm's length price, then you have to follow the range concept. But the range concept is applicable where you should have at least 6 arm's length price. If there are less than 6 arm's length price, that is 2, 3, 4, 5, then what to do? Then take the arithmetic average of these two, and the arithmetic average of these two comes to 12.58. And in normal case, you have to compare this 12.58 with your 11.4 price, and then you have to see at least there has to be a margin of 3%. If in normal cases, but in case of NJ, you are not supposed to compare that. Directly 12.58 will become your arm's length price. And the difference between the two will be added to your what? Arm's length adjustment will be added to your profit. Okay. The next question is a very, very simple question. There is an assessee who is withdrawing some 12 lakh rupees every month, and they have withdrawn therefore in all 12 into 12, 1 crore 44 lakhs. They regularly file the return. Therefore, their TDS will be deducted under 194N if they withdraw more than 1 crore rupees. So they are withdrawing 1.44. So on 44 lakhs, 2% TDS will be deducted. That is 88,000 TDS will be deducted by the bank. Okay. On this particular transaction. Next one is a very, very good question. For that, I have made one small example over here. There is a Swiss company over here, and Swiss company has some employees, and there is an Indian company over here, Twinkle, and Swiss company has seconded some employees to the Indian company. Seconded means they have given some employees to the Indian company. Now, the employee came to India on the very first day of the financial year, that is on 1st April 2022, and they remain in India for the entire year. So if a person remain in India for the entire year, then that person is by default what? Resident. Now, Twinkle is in India, and the employees were called to India for some work in India. So Twinkle paid them salary and deducted the TDS. Okay, because Twinkle is liable to deduct the TDS because the salary is accrued in India. Therefore, Twinkle has to deduct the TDS. The question is not that. The Twinkle also paid some more special allowances on behalf of Swiss INC. Twinkle also paid some special allowances on behalf of Swiss INC, and on that special allowance, Twinkle did not deduct the TDS. So whether the TDS should be deducted on that, the answer is yes. Because the employees are resident, their income will be taxable. Now, global income will be taxable. Therefore, they'll be liable to tax in India. Now, because they are liable to tax in India, you should have deducted the TDS. Now, if you have not deducted the TDS, but if the employees have themselves paid the tax, and if they have themselves filed the return, and if they themselves included that income in the return, then employer, that is Twinkle India, will not be considered to be what? An assessee in default. Do you remember that we have done this particular provision while doing the provisions of what? PGBP. So if I have not deducted the TDS, but the other person has included that income, paid the tax, and also filed the return, that is deemed that I have deducted, I have paid. In that case, a marginal rate of interest at the rate of 1% will be charged on me. Will there be a penalty also for non-deduction of tax? Yes. If you have not deducted, the other person has also not paid the tax, then you will also be liable for a penalty under section 271C, equivalent to tax liable to be deducted. So this is what this question is all about. The next question, question number 5. Pay attention, please. 5A is a very good question, very, very important question also. I don't know why this question is asked again and again by ICI, but ICI likes this question a lot. There is a proprietor who has not filed the return, willfully has not filed the return. So if a person who is a proprietor other than company who has willfully not filed the return, and the tax payable after reduction of TDS and advance tax is more than 10,000 rupees. If the tax payable after reduction of TDS advance tax is more than 10,000, other than company, for company there is no limit only. For other than company, that is for proprietor, there is a limit of 10,000. Then they are liable for what? Prosecution. So this person has not filed the return. So the AO has lost prosecution. And AO has found that his tax payable after TDS and advance tax is 1,40,000. So assessee filed an appeal. After filing an appeal, the liability reduced to 18,500. Still, it is more than 10,000. Therefore, the order of the AO is correct. He is liable for what? Prosecution. Will your answer change if it is a company? Yes, definitely. In case of company, the limit of 10,000 is not applicable only. In case of company, the company will always be liable for prosecution. Obviously, company will not go in jail. Any official person, that is the chief executive officer or the MD or the other executive directors, will go to the jail. Okay. Next one, are we supposed to deduct TDS in the following cases? And if not, what are the penalty? Suppose you have made some payment to labor contractor under 194C, but you have not deducted the TDS. Now, what is the penalty? Penalty will be liable under 271C by joint commissioner. How much penalty? What is the penalty for non-deduction of TDS? Non-deduction of TDS, the penalty will be imposed under 271C. It will be imposed by joint commissioner. It will be equal to TDS. And if you do not deduct the TDS, the expenditure will also be disallowed to the extent of 30%. Okay, that we all know. Next, there is an hotel to whom the income tax officer has been asking some information of all the tourists who have made a payment of hotel bill of more than 10,000. Okay, so they are asking some information, but the hotel is not giving that information. They have been asking. The constant reminder has been given. Various reminders have been given to them, but they are not answering. So the department can impose penalty. Yes, 500 rupees per day penalty can be imposed on them in such circumstances. Okay. Now, the next question is, there is an Indian company, AX Limited. Now, that Indian company is taking some online advertisement services from a foreign company under two circumstances. One is, one company is a company who does not have a P in India. That is, J does not have a P in India. So there is a non-resident outside India, J, who does not have a P in India, and that non-resident is giving some online advertisement service. It's a classic case of equalization levy. The Indian company is liable to deduct equalization levy at the rate of 6% as per Finance Act 2016 and as per Section 165, and that income will be exempt in the hands of the non-resident. In second case, Mr. M is also giving us online advertisement service, but Mr. M has a P in India. So if Mr. M has a P in India, in that case, Mr. M is liable for income tax. Equalization levy is not applicable in that case. You are supposed to deduct TDS under 195, 40% tax will be applicable on Mr. M. Check it, please. This is what this question is all about. Okay. And one last question over here in this MTP, that is, there is one stockbroker who has defaulted some tax. Okay, so the stockbroker has defaulted some tax. His assessment might have been done and he has defaulted some tax. So what assessing officer did you know? He attached his membership card. Do you know that the stockbrokers get membership card from the stock exchange? So he attached his membership card. And he said that I will attach your membership card and sell it. The assessee said that it is non-transferable. It is an asset which is non-transferable. You cannot transfer that to anyone. And even the even the Gujarat High Court, even the Supreme Court held that such transactions are not subject to what? It's not transferable. Therefore, it will not be subject to what? Attachment. You cannot attach such particular things which are not transferable. This is not transferable as per the Bombay Stock Exchange laws, as per the National Stock Exchange laws, and therefore you are not liable to attach such kind of assets in your hands. Check it, please. So let's move on to the next MTP. The very first question over here is based on your total income and your tax liability, and you're going to follow your 115 BAB. Very careful. This is a manufacturing assessee because 115 BAB is only applicable to manufacturing assessee, but you will not get additional depreciation and many other deductions. So the very first thing over here is the net profit, which is given over here. You can write down this over there, and then you will add back what? The depreciation. The next thing is you are purchasing some intangible assets. So intangible assets you are purchasing on 12th of December. So you have to add back this. You cannot debit the intangible asset to PNL. Intangible assets are subject to depreciation. So add back this to PNL, and then you can take 12.5% depreciation to 50% or 25% because the asset is used for less than 180 days. The next is you are paying some excess payment of 14 lakh rupees to your related party, so you can add back this excess payment to your PGBP. Okay. The next one is an important adjustment. From the state government, you are receiving some subsidy of 15 lakh rupees for the purpose of purchasing new plant and machinery. So if you receive any subsidy, grant or reimbursement for an asset, you have to reduce from the block of asset which is mentioned in point number C. And in point number C, you are purchasing a machinery of 75 lakhs. So you reduce what? 15 lakh rupees from this 75 lakhs and then claim depreciation. Okay. Which depreciation? Only the normal depreciation. Do not claim additional because 115 BAB assessee do not get additional depreciation benefit. Next one. If you are incurring some legal expenses for issue of bonus shares, it is allowed as deduction because bonus shares does not lead to increase in capital. The overall capital does not increase. So it is not a capital expenditure. It is revenue expenditure. You can claim the deduction. But if you incur some legal expenses for right shares, then it is not allowed because increase in right shares, it leads to what? Increase in capital of the company, and therefore it is not allowed as deduction. It is a capital expenditure. I have done 9 case laws based on all these concepts with you all in PGBP. You can go and check those 9 case laws in the chapter of PGBP. Okay. Next one, you are having some short-term capital gains of 15 lakh rupees on equity shares which are listed on which securities transaction tax is paid. So this is subject to 111A. It will be subject to 15% tax. You have to reduce from PGBP, show under capital gains and charge at special rate of 15%. Okay. Next is you are having some long-term capital gains on zero coupon bond with after taking indexation. So this will also be reduced from here. It will be showed under capital gains and this will be subject to 20%. For zero coupon bond, long-term zero coupon bond, there are 2 options. Either you can take 20% with after taking indexation or you can take 10% without taking indexation. These people are taking after indexation. Therefore, we have to take 20%. If it would have been without indexation, we would have taken 10%. Okay. Next, depreciation 36 lakhs you can claim. Next is you are buying some assets in 2021. Unlisted shares you are buying in 2021 and you are selling in 2022. So unlisted shares are short term. If they are sold within 24 months. Okay. So if they are sold up to 24 months, then it is short term. So it is sold within 24 months. Therefore, it is purchased at 12 lakhs, sold at 22 lakhs. Therefore, 10 lakhs will be capital gains. 10 lakh will be STCG. Now, this STCG will be charged at normal rate. Now, what is normal rate in 115 BAB? Normal rate in 115 BAB is 22%. The special rate in 115 BAB is 15%. So this will be taxable at what? This will be taxable at 15. This will be taxable at what? 22%. Okay. And last but not least, the company has purchased some machinery of 75 lakhs. Obviously, out of this 75 lakhs, you are anyways going to reduce 15 lakhs which is received as a subsidy. Apart from that, you will also reduce 10 lakh rupees more, because 10 lakh rupees is paid by bearer check. You cannot purchase fixed asset by other than account pay check, account pay draft, ACS or such other electronic mode. You have to purchase by these four modes. You cannot purchase equity. You cannot purchase what? You cannot purchase fixed assets, plant, machinery, building, furniture, etc. by paying by bearer check for more than 10,000 to a person in a day. Therefore, this 10,000 also has to be reduced. Therefore, 75 lakhs is the cost, minus 15 lakhs subsidy, minus 10 lakh. Therefore, the actual cost will come to 50 lakhs. You can take 10% depreciation, 15% depreciation on that, because the asset is used for what? More than 180 days. You cannot claim additional depreciation because the assessee is following what? 115 BAB. Then you will compute the tax over here. As I have told you, for business income, it will be 15%. For 111A, it will be 15%. For 112, long-term capital gains on indexation, on which indexation you have taken on zero coupon bond, it will be 20%, and the short-term capital gains on unlisted shares will be charged at normal rate, and the normal rate under 115 BAB is what? It is 22%. 10% surcharge is always imposed on 115 BAB. So you will impose that surcharge, and 4% health and education cess. Okay. Next question is based on TTAA. But there are some unique points over here. That is the reason I'm discussing this question to some extent with you all. The very first thing is, the very first unique point is, this assessee is following cash system. Therefore, you will only take that much income in your books of accounts, in your income tax, which is received by the assessee. This assessee is believing cash system. They are not following mercantile. Therefore, you have earned royalty of 18 lakhs, but you will take only 13.6 lakhs in your income statement, because that much is received by the assessee. You will do on receipt basis, not on accrual basis. Second thing, you will say that this assessee is earning royalty by writing articles in journal and newspaper. Will this assessee get 80 QQB? 80 QQB will not be available to this assessee. 80 QQB is not available if you write some notebooks or a school textbook or some journal or some newspapers. For those assessees, 80 QQB is not available. 80 QQB is available to those authors who write some book with respect to artistic, literature, scientific books. Those authors are eligible for 80 QQB. So this author is not eligible for 80 QQB. Very careful. Okay. Now, out of that, this assessee is also earning some rental income of 3.6 lakhs. So I'm writing that. He is also paying some municipal tax. So I'm writing that. Then 30% deduction also I'm taking. And the rest of the question is a very simple question. There are two important points in this question which I have addressed. One is, you are following cash system. Other, you will not get 80 QQB in respect of all these newspaper and journals and all these things. It is not allowed. You can go and check chapter 6 if you want. Okay. Now, question number 3, in this, there are multiple parts. The very first part is based on taxation of trust. Now, there is one trust who has sold some building. Now, whenever a trust transfer any capital asset and there is a capital gains, to save that capital gains, the trust can purchase another capital asset equivalent to sale consideration. If it is equivalent to sale consideration, entire amount will be exempt. If it is less than sale consideration, then the cost of new asset minus the cost of old asset will be exempt. Okay, now let me tell you. The trust is selling some assets for 5 lakh rupees. Now, that asset is purchased for 3.7 lakhs and it is a short-term capital asset. You can check, it is sold within 24 months and it is a building. And if a building is sold within 24 months, it is a short-term capital asset. So it is sold for 5 lakhs, it was purchased for 3.7, therefore short-term capital gains is 1.3 lakhs. Now, if they want to exempt this 1.3 lakh, they have to purchase another capital asset within another capital asset of equivalent to sale consideration. Now, they have purchase of only 4 lakhs. They have not purchase of 5 lakh. They should purchase of 5 lakh, but they have purchased only 4 lakh. Therefore, the proportionate exemption would be cost of new asset, that is 4 lakh. Minus cost of old asset, that is 3.7 lakh. The differential amount will be exempt. Therefore, out of 1.3 lakhs, 30,000 will be exempt and 1 lakh will be taxable. Okay, next question. There is a trust which is partly religious and partly charitable, and they are receiving some anonymous donation. Now, we have done a provision under 115 BAC that if the trust is partly religious and partly charitable, both is there, and there are 2 donation boxes, then the amount received in the charitable purpose will be subject to 115 BAC, 115 BBC, sorry, and the amount received in the religious purpose, that is in temple, etc., that will not be subject to what? 115 BBC. So, you can check over here. The amount received in temple will not be subject to 115 BBC, but the amount received for the purpose of school, that is for charitable purpose, will be subject to 115 BBC. The next question is something which we have done in RTP also. There is an educational institution, along with that they are also running hospital, and if the total receipt from both is up to 5 crore rupees, their income is exempt. But if the total receipt is exceeding 5 crore rupees, then income cannot be exempt directly. Then they have to make an application to principal, commission, etc., take an approval. Only then their income will be exempt. This is what this question is all about. Okay. The next question is a good question on transfer pricing. Be very careful. There is an Indian company, PR Limited. Be very careful. It's a good question. And there is a foreign company, SK Limited. Okay. Now, both of them are deemed to be associated. How they are deemed to be associated? Let me tell you. The Indian company has a total borrowing of 60 crore. Out of that, 9 crore is guaranteed by SK. So, if I am an Indian company and you are a foreign company, and if I have a total loan of 60 crore, out of of this 9 crore is guaranteed by you, is it 10% or not? 10% or more or not? Yes, it is. So if one entity guarantees 10% or more of the total borrowings of the other entity, both of them are deemed to be associated. Now be very careful. Now we are selling the goods to our associate enterprise at 2,200, whereas we are selling this particular thing to other people at 2,300. But it is not correct to compare both of them directly. Okay, to our associate enterprise, that is SK, we are selling at 2,200 at a lesser price, but to others, that is to third party, other dealers, we are selling at 2,300. It is not correct to compare directly. There is one functional difference between the two. That is what? Whereas SK, to our associate enterprise, we give a credit of 3 months, but to others we give a credit of only 1 month. So to others we give a credit of 1 month, to our associate enterprise we give a credit of 3 months. So if we are giving a credit of 2 months extra to our associate enterprise, will we not charge 2 months extra price from him? Obviously, if I am giving you 3 months credit and your friend 1 month credit, obviously I will charge more from you because I am giving more time for you to pay. There is something called as time value of money, opportunity loss. Therefore, I have to add back that extra to SK. Okay, how much extra? 2,300 is the base price, multiplied by 12%, multiply by 2, divide by 12. That will come to somewhere around 46 rupees. Therefore, 2,300 is the basic price which I am charging to third party. Okay, but for you I will be charging over and above that also now. Why, sir? Why over and above? Why over and above? Because to third party to I am giving only 1 month credit, to you to I am giving 3 months credit. So 2 months extra credit cost I am going to recover from you. So if I do that, that will come to 2,346, and that will come to the differential. My actual price is 2,200, and the differential amount will be subject to what? Will be subject to transfer pricing. Okay, it will be added back to your income statement. Then all those old same questions. What is the time limit for repatriation of such money? If the such primary adjustment is done by the assessee himself, if the primary adjustment is done suo motu by the assessee, what happens? It has to be brought back to India within 90 days from the due date of filing of return. If you do not bring back that money to India within 90 days, then 2 options are available in your life. What is option number 1? The option number 1 is that you have to pay tax. You have to compute the interest, secondary adjustment. The second option is what? You have to pay one-time additional tax. That option is also there at 20.9664%. Okay, you can write both the options in the answer if you want. Question number 4. You are supposed to find out the TDS provisions, implication of the TDS provision, under which section TDS will be deducted, the rate, and assume that all the payees are residents. Okay, the very first thing is Mr. Suresh is an individual. His turnover of last year is more than 1 crore rupees, and he is making some payment of repair for residential house of 3 lakh rupees. Now listen carefully. I am Suresh. My last year turnover is more than 1 crore. Okay, and I am making some repair for residential house of 3 lakh rupees. Whether 194C will be applicable? No. 194C is not applicable for personal purpose. Then whether 194M will be applicable? No. 194M will be applicable if the payment is more than 50 lakh rupees. Otherwise, it is not applicable. Second thing, I am making a payment of 75,000 towards commission for Mr. Valish for business purpose. Whether 194H will be applicable? Yes. Because I am an individual, my last year turnover is more than 1 crore rupees, and I am making the payment for business purpose to Mr. Valish, and the payment of the commission is more than 15,000 rupees. Therefore, I am liable to deduct TDS at the rate of 5%. Okay. The next question is Mr. Rajesh. I am Mr. Rajesh. My last year turnover is 95 lakhs. Whether 194C will be applicable? No, because last year turnover is less than 1 crore. Whether 194M will be applicable? Yes, because now the aggregate payment for construction of residential house is exceeding 50 lakh rupees. Therefore, 194M will be applicable at what? At 5%. Check it, please. Okay. Now, the next question is something based on 194I. I am taking on lease from someone plant and machinery as well as building. Now we all know that the limit under 194I for deducting TDS is 2,40,000. But how to compute that limit? Individually, is it 2,40,000 for both or aggregate? It is aggregate 2,40,000 for both. So if the aggregate amount of payment for plant and machinery and building to one person is exceeding 2,40,000, you are supposed to deduct the TDS. And in case this question, it is exceeding 2,40,000 in aggregate. Okay. Individually, both of them are less than 240, but in aggregate, it is greater than 240. Therefore, deduct TDS. How much TDS? For plant and machinery, it is 2%, and for building, it is 10%. Check it, please. Now, the next question is based on 94B disallowances. In 94B, we know that lower of the two is disallowed. How much? Interest in excess of 30% of EBITDA is disallowed. And point number 2, amount of interest paid or payable to associate entity. So here there are two things which are given. There is a first year which is given financial year 21-22, and then they give financial year 22-23 to us. So now, first of all, we will go in the order of the year. Okay. Let's compute the EBITDA of first year. This is the profit. 557, add tax, add depreciation and interest. Do not add employee benefits because that is not added back in EBITDA. Okay. After I do that, I will get an EBITDA of how much? 1640. I will take 30% of that. 30% of that will come to 492. And therefore, 492 is the 30% of EBITDA. Okay. Now, 562 is my interest minus EBITDA ka 30%. That will come to how much? That will come to 70 rupees. The actual interest paid to the associate enterprise is 562. Therefore, whichever is lower will be disallowed. Therefore, 70 lakhs will be disallowed. But do you remember that whatever amount is disallowed in 94B, it is not disallowed forever. You can carry forward that in the subsequent year, and you can take the benefit of that in the subsequent year within the overall limit of 30% in the next year. Now let me tell you how. For how many years you can carry forward? For 8 years. Okay. Now again you have to compute the EBITDA for the next year. EBITDA for the next year will be 403 plus tax plus depreciation plus interest. Okay. Now the EBITDA for the next year will come to how much? 1378. Again you are going to take 30% of that. Up to 30% it is allowed. It means 413.4 you can take the deduction in the current year. Out of that, how much is the current year interest? That is the second year interest. The second year interest is only 389. 389 you will fully get. Plus whatever is disallowed in the current last year, that can also be allowed to the extent of 413.4. So the difference between the two is how much? The difference between the two is 24.4. So 24.4 you can also claim for the last year. So out of 70 you can claim, because you can claim up to 30%. Up to 30% of EBITDA it is allowed. So EBITDA ka 30% comes to 413.4. So that much is allowed only. But in the current year you do not have that much interest only to absorb. You only have 389. So claim entire 389 of current year and also the balancing figure of the last year. Okay. So balance comes to 24.4. Now out of 70, if I remove 24.4, 45.6 you can carry forward for another 7 years. You can carry forward that to the subsequent 7 years and you can claim the benefit of that in the subsequent 7 years in the same manner. Okay. Now question number 5 is a very theory question. Let me explain you with the help of an example what exactly is happening over here. The Commissioner of Income Tax has something on his record, and on the basis of that record he has issued a notice to the assessee for section 263 revision. Okay. So on the basis of that record he has sent some notice to the assessee for starting section 263 against the assessee. Okay, that's fine. After the notice was sent and the proceeding of revision was started, the survey of the assessee was done, and after the survey was done there was something new which was found. Now the commissioner wants to send another notice and he wants to change his revisionary proceedings. Can he do so? He cannot do so. The content of the new notice is different from the content of the original notice. He cannot do so. He has to stick to the revisionary proceeding based on what he has sent in the first notice, not what he is saying what is there in the second notice. Okay. Moral of the story, he cannot send such second notice subsequently. It was sent by one of the court earlier. Okay. Now question number 6, first question is a theory question that you can see at your end. Nothing great as such. I'm not interested in that question. I'm interested in the second question. Second question, there are two persons, one is Atharva, one is Vihan. Both of them are resident, both of them are individual, and both of them earn salary of 13 lakh rupees. And Mr. Vihan is also paying a self-occupied interest of 2,20,000, and Atharva is paying medical insurance premium of himself and spouse of 24,000. Now we are supposed to advise Vihan and Atharva both that whether they should go for the normal provision or whether they should go for the 115 BSc. Now for Vihan you are supposed to make 2 computation, for Atharva you are supposed to make 2 computation. But I'll tell you what will be allowed to whom. If you go for normal provision, you will get the deduction of this 2.2 lakhs, not entire 2.2 lakhs, you will get 2 lakhs because self-occupied property is allowed to the extent of 2 lakhs. Okay. And in 115 BSc, you are not going to get this 2 lakhs. Okay. If you go for 115 BSc. Now, if you go for normal provision, you will get the deduction of 80D also mediclaim, but in 115 BSc, you are not going to get the deduction of 80D also. If normal provision, you will get the deduction of 50,000 standard deduction for both of them under salary. Okay. So 13 lakhs minus 50,000, but in 115 BSc you are not going to get. Apart from that, nothing great is there. You can check the question. It's a very simple. Now the tax rate you would definitely remember here. What is the tax rate for 115 BSc and what is the tax rate for normal provision? You need to remember that particular tax rate. Okay. So you have to make 4 calculations for Atharva, for Vihan, for Atharva 2 calculation, for Vihan 2 calculation. I told you which deduction will be allowed. I told you which deduction will not be allowed. Okay. Now coming to the next question, which is based on what? Which is based on equalization levy of 2020, whereby a e-commerce operator is there whose turnover from India is 2 crore or more, and he is a non-resident and he does not have a P in India. If these 4 conditions are fulfilled, that there is an e-commerce operator who owns a website, okay, his turnover is 2 crore or more and he is a non-resident and he does not have a P in India, then he will be liable to pay equalization levy at the rate of 2%, not 6%. Okay. So on how much amount? On all those amounts which are paid to in respect of services or goods which are sold to residents, or in respect of services or goods which are even sold to non-resident, but where they are using the IP address located in India. So the total should come to 2 crore at least. Yeah. If it is not 2 crore, then equalization levy will not be applicable. So in this case, the first case is 180 lakhs. This will be subject to equalization levy. First of all, you are supposed to compute whether 2 crore is crossing or not. And the second case is out of 80 lakhs, 38 lakhs will be subject to equalization levy. So 180 plus 38 will come to 2 crore. It is greater than 2 crore. Therefore, greater than or equal, both will be fine. Even if it is exactly 2 crore, equalization levy is applicable. This will be subject to 2%. Now they are saying that assume that this is not 38, this is only 14. Assume. So if this is only 14, then 180 plus 14 will be less than 2 crore. And in that case, equalization levy of 2020, that is 165A, will not be applicable because the services which are provided to the residents in India and even to the non-residents in India in specified circumstance, taking together total should at least be 2 crore or more. Otherwise, equalization levy is not applicable to the assessee. Okay. So this is what this mock test paper is all about. Go through it once and then we'll move ahead with the next one. So now let's move on to the next mock test paper that is given over here. The question number 1 is based on what? Again, total income. We are supposed to compute what? We are supposed to compute the total income of the assessee. That's it. As per the normal provision, no 115 BAB, nothing MAT, etc. All those things are not supposed to be followed. So the very first thing is the assessee is a production and marketing assessee. Additional depreciation might be applicable over here also. The net profit is 72 lakhs. Therefore, depreciation has to be added back. Next adjustment is you are making some short payment of advance tax, so you are supposed to pay interest under 234B. All the kind of interest under the income tax law which is levied under income tax law, it is disallowed and disallowed. Okay. Now the third point, adjustment number 3 is there is some opening stock, there is some closing stock of the assessee in which they are including some interest and borrowing which are not meeting the criteria for recognition. It should not be part of opening stock and closing stock, and therefore this opening stock and this closing stock has to be, this amount has to be reduced from the opening stock and closing stock. So how to reduce the amount from the opening stock? Add back 9 lakh 50. How to reduce the amount from the closing stock? Reduce 7 lakh. So you have to add back 9 lakh 50 to the opening stock, because in opening stock it is already there, it is on the debit side, so it has to be added back, and the closing stock it is on the credit side, so it has to be reduced 7 lakhs. Okay. Now the next adjustment is you are making some payment of 41,000 in cash, out of which 22,000 is paid to producer of a dairy farming products. It is allowed. Rule 6DD says that if you are making some payment in cash to farmer for buying some dairy product, etc., it is allowed. You can make the payment in cash. There is no worry. 19,000 which you are paying for printing and stationery, that will not be allowed. Not be allowed. Next one is if you are making some payment of 3,50,000 for carrying out certain work of contractor and TDS is not deducted, then 30% of that expenditure will be disallowed in the current year. Next one is a new adjustment. You are transferring some carbon credit and you are incurring some expenses on transfer of carbon credit. Now this particular income is taxable as per 115 BBG at the rate of 10% without any deduction. Therefore, this 35,000 will be subject to tax, will be subject to addition. You have to add back that because expense is not allowed as deduction under 115 BBG. So in 115 BBG, you have to add this back, and there is some income of 115 BBG which is mentioned over here. You can see over here, and that income of 115 BBG will be part of what? Will be part of PGBP income. We will talk about that after some time. Okay. Now the next adjustment is a very routine adjustment. You are contributing to electoral trust, so add back that, and then you can take the deduction of that under what? Under chapter 6A. Okay. As you are making the payment by check, so you can get the deduction. Next is you are making some payment to advertising in a brochure of a political party, that will also be added back in PGBP, and then you can claim that deduction under chapter 6A under 80 GGB. Okay. Next, you have taken some loan from cooperative bank and interest on that loan is not paid, therefore that will be disallowed under section 43B. Okay. Next, you are making some contribution to pension scheme of employees. So can I get the deduction? The employer can get the deduction of contribution to pension scheme. Yes, but up to 10% of salary. What do I mean by salary? Salary over here means basic salary plus DA in terms. So what is the basic salary and DA in terms? It is given in the last line. The basic salary and DA in terms is how much? It is 10 lakhs. But you are contributing 1,50,000. How much is allowed under section 36 subsection 1 clause 4A? It is allowed to the extent of 10% of salary. It means it will be allowed to the extent of 1 lakh. Therefore 50,000 will be disallowed. Okay. Next, you are receiving some unrealized rent of 2020-21 and 21-22. So unrealized rent will be taxable in the current year, and against that unrealized rent you can also claim 30% standard deduction. So first reduce from PGBP and then show under income from house property. Next, dividend is a very simple adjustment. Reduce from PGBP, show under IFRS. Next is an important adjustment. You are importing some machinery for 95 lakh rupees, and while making the payment you are having a foreign currency profit, currency exchange profit. So if you are importing some asset and if there is a loss on payment of that particular machinery, then that loss is added back to the cost of asset. So if there is a gain, that has to be reduced from the cost of asset. So 95 lakhs minus what? Minus 3 lakhs will be reduced from here as per section 43A, and that will come to 92 lakhs. On that you will claim 50% depreciation because it is used for less than 180 days, 15 December 2022. So therefore you will claim 7.5% normal depreciation and 10% additional depreciation also, because the assessee is engaged in what? Production and marketing. Okay. Next one, you are earning some deposit from bank. How much? You are earning some interest on FD. 1,35,000 is your net income. So you have to gross that up. So reduce from PGBP 1,35,000 and then under IFRS you have to show that by grossing up, and that will come to 1,50,000 rupees. Okay. Next is 28 lakh rupees depreciation is there that you can claim. Next is you have claimed some deduction in the last year on accrual basis, but in the current year you are making the payment in cash more than 10,000. So that will be added back as deemed income of the current year. Do you remember there is a separate provision for that under section 48(3)(a) that if expenditure is claimed in the current year in the form of accrual basis, and in the next year if it is paid in the form of cash in excess of 10,000 rupees, it will be deemed income of the next year. Next one is also a very good adjustment. In 21-22 you have paid some audit fees of 75,000 and you have not deducted TDS in the last year. You have not deducted TDS in the last year. Therefore, in 21-22, 30% of this 75,000 would have been disallowed. But in the current year, you are making the payment. So should you get the deduction of that 30% in the current year? Yes, this 30% deduction would be allowed to you in the current year. In the last year, this would have been disallowed because TDS was not deducted and not paid. In the current year, you have paid the TDS, so you can claim the deduction. Okay. Next one is, as I've told you, the carbon income will be shown under what? PGBP, and it is included in the net profit. It is written. So let's assume that it's a PGBP income. You can assume either PGBP or IFRS, both would be fine. So we are assuming it to be PGBP because it is already a part of net profit. I'm not writing anything. Okay. After doing all these things, you will get your total income. That's it. The question is over. Okay. Now let's move on to the next question. They are not asking us to compute any kind of tax or nothing. All those things are not asked in this question. Now, question number 2. Question number 2 is on partnership firm. Always remember, whenever there is a question on partnership firm or LLP, always you have to compute book profit first. Why? So that you can compute remuneration. Why? Because you need to find out the actual remuneration allowed. It is not the actual which you pay. It is actual subject to the maximum remuneration which is covered in 40B. And then you can compute the total income and tax. In this question, tax is not asked. So just compute the total income. Tax is not asked in this question. So let's start with the book profit. While computing the book profit, what is book profit? Book profit is nothing but PGBP. Whatever is PGBP, that is book profit. That's it. You have to give all the effect of PGBP and then add back the remuneration which is debited to PNL. Whatever remuneration is debited to PNL, you have to add that back. You will get the book profit. Okay. Now, the very first thing over here is you are making a payment of interest on capital at the rate of 13%. 13% not allowed. Only 12% allowed as per 40B. Therefore, 1% you have to disallow. How will you compute 1%? It will be 7,15,000 is the total interest. Multiply by 1, divide by 13. You will get 1%. Add back that. Okay. Then the firm has taken loan from one of the partners. So if the firm is taking loan from partners, that also should be disallowed. How much will be disallowed? You are paying 15%, so 3% will be disallowed. How will you compute 3%? Total interest is 90,000. Multiply by 12 divided by 15. That will be the allowed portion. And how much will be the disallowed? Multiply by 3 divided by 15. You will get what? You will get the disallowed portion. So you can reduce, you can add back that much interest. Okay. Next, you are earning some interest from bank FD of 35,000. Now this is the gross amount. It is not a net amount, unlike the previous question. So you have to reduce this from PGBP and show under IFRS. It is as simple as that. Then add the depreciation as per books of accounts. It is as simple as that. Now the next question is very important. Next point is very important. You have purchased some building in 2019 having a WDV today. Today the WDV of the building is 36.45. Now you are selling that building in the current year for 90 lakhs. Okay, this is the building is a part of block of asset. So if you transfer a block of asset, always remember that the gain is always short term. So there will be a short term capital gains of 53.55 lakh. Now, can I claim exemption under 54EC against that 53.55? Yes, you can claim the exemption against this particular thing. So you can see this, you have made an investment of 60 lakh rupees in NHAI bonds over here within 6 months from the date of transfer. So to save this particular capital gain, you can invest up to 50 lakhs. You are investing more than 50 lakhs only. So you can claim 50 lakh rupees exemption under 54EC as per the Supreme Court judgment of Ace Builders. But you will say that, sir, in 54EC it is written that the asset should be long term to claim exemption under 54EC. Yes, it is correct. The asset should be long term. The gain should not be long term. The gain can be short term. The gain can be long term. It doesn't matter. The asset over here is long term only because it was purchased in 2019 and it is sold in 2020. The asset is long term only. The asset has to be long term. The gain can be short term, long term. It doesn't matter. Go and check the judgment of Ace Builders in the chapter of exemptions under section 54. Okay. Next one. You have 4 partners, out of which 2 partners are working partners. So they will be getting a salary of 20,000 per month, but that is the actual salary. You have to also compare the actual salary with the maximum remuneration which is allowable. That we'll talk about in a while. Okay. Next one. This is a very important point. The next one is also, as I've told you, if you have made an application for what SEZ approval and you have got the approval up to 31st March 2020, sorry. So if you have got the approval up to 31st March 2020, then you can commence the operation in 2021 also, and you can start the operation till 31st March 2021. So here the assessee got the operation, assessee got the approval till 31st March 2020 and it started the operation before 31st March 2021. Therefore, the assessee is eligible for 10 double deduction also. Now, how much deduction will be allowed to assessee? It's very simple. 7.5 lakhs is the profit of the assessee. Multiply by export turnover is 40 lakhs. Divide by total turnover is 120 lakhs. That will come to 2.5 lakhs. So assessee can claim 2.5 lakhs as deduction under what? Under chapter 6A. Okay. Next one. The assessee has some depreciation of 1,400 to 14,000. So you can claim that depreciation under the income tax law. The next one is a very, very important adjustment. The assessee has purchased some motor car on 1/1/2020 and the WDV of that motor car today is 6,80,000. How much depreciation you are going to get that? You will get 30% depreciation on it. Why? Because if the motor car is purchased between 23rd of August 2019 to 31st March 2020 and it is put to use during that period, then that motor car is eligible for 15% extra depreciation. Do you remember that? Now this machine and this motor car was purchased exactly during that period. Therefore, this will be eligible for what? 30% depreciation. Very important adjustment. Mobile phone purchased in the current year in the month of November, October. Therefore, it was purchased on 11th of October. Therefore, this mobile phone will be subject to what? Will be subject to 7.5% depreciation. That is half because it is used for less than 180 days. Okay. So this is how you are going to compute the entire question. After that, you are just supposed to add back what? You are just supposed to compute what over here? You are supposed to compute the maximum remuneration over here, which is 90 70% of book profit, 60% of book profit, and then you will compute what? Your the total income, so on and so forth. In this question, the tax liability is not asked, so we are not getting into the tax liability. Okay. The next question, question number B, is very simple, which is based on DTAA question. It's a simple question. There are a few important points which I would like to tell over here. Is this question is telling us to compute tax as per 115 BAC. Now, if it is telling us to compute tax as per 115 BAC, we have to keep few things in mind. The very first thing is deposit and PPF will not be allowed as deduction in 115 BAC. Second thing, will we get the standard deduction against the income from salary? You will not get the deduction of standard deduction of 50,000 against income from salary. This is the second thing that you have to keep it in mind. Third thing, the assessee also has income from house property. Will the assessee get the deduction of LOP, municipal tax and 30% standard deduction? Yes. In 115 BAC, the interest of SOP is not allowed, but in LOP, nothing is disallowed. For 115 BAC assessee, entire computation in LOP is same as the normal provision. Okay. So rest of the things are very simple. You can go through the question at your end. It's a very straightforward question. Okay. Now, the next question is based on 44C. What is 44C? There is a non-resident outside India. That non-resident has a branch in India. Now, if that non-resident is incurring some head office expenses and attributing some head office expenses to the Indian branch, how much deduction will be allowed to the Indian branch? The deduction will be as follows as per 44C. How much? It is the actual amount attributed to the branch in India compared with 5% of adjusted total income, whichever is less. Now, what is adjusted total income? Adjusted total income is nothing but total income plus 5 items. Which 5 items? Add UAD, add brought forward losses, add only capital expenditure of family planning, add chapter 6A, and add the actual head office expenses debited to the P&L. So what all things I will add back? Will I add current year depreciation? No. Current year depreciation I did not say in the 5 items. Will I add unabsorbed depreciation? Yes. Will I add capital expenditure of family planning? Yes. Will I add scientific research current year expenditure? No. That I didn't say. I said capital expenditure of family planning. I did not say of scientific research. Will I add brought forward loss of previous year? Yes. That I said. Will I add chapter 6A? Yes. Will I add the head office expenses? Yes. After adding all those things, that will come to adjusted total income. Take 5% of that or actual head office expenses, whichever is lower will be disallowed. Balance will be allowed under the income tax law. So this is a very simple question. Okay. Now, next question, question number 4. Question number 4 says what? About TDS. There are 2 parts which talks about TDS implication. The first part says that there is an assessee which has withdrawn 68 lakhs first of all, and then 58 lakhs from the bank account. Okay. So the total assessee has withdrawn 126 lakhs from the bank account. The assessee files the return regularly. So he's a regular filer of return. So for him, the threshold will be 1 crore rupees. So total he is withdrawing 1 crore 26 lakhs. So on 26 lakhs, 2% TDS will be deducted by bank, that is 52,000 will be deducted by bank in the form of TDS. Sir, this 68 lakhs will he not get exemption? No. That 68 lakhs is allowed as an exemption to whom? You know that it is allowed as an exemption to commission agent who are registered commission agent under APMC market, and they withdraw that money to buy agriculture products from the farmers. In that condition, there is a CBDT circular under 194N which says that there is no need to collect what? There is no need to deduct TDS. But this is not that case. This is a different case. Second, there is the non-resident who has purchased some bonds of Power Finance Corporation India, and he's earning an interest of 98,000 rupees. Is the company liable to deduct TDS? Yes. Is it covered under 194 LB, 194 LC, 194 LD? No. It is not covered under these specific sections of interest. So if it is not covered in these 3 sections, the TDS will be deducted under 195 at the rate of what? At the rates in force. So it has to be deducted at rates in force. There is no other option. Next one is a very good question. Mark it down. It's an important question. I say I've been asking this question again and again. There is a person, Mr. Balveer, whose assessment is done on 25th of December, and there is a tax liability of 115 lakhs. Now the department wants to recover that. Now it's very simple. Whatever belongs to Balveer, the department can recover that, and whatever can be clubbed in the hands of Balveer, that can also be recovered by the department. The simple rule is very simple. Whatever is belonging to Balveer, whatever is belonging to assessee, that can be recovered by the department, and whatever can be clubbed in the hands of Balveer, that can also be recovered. Now, there are 5 things over here. First of all, Balveer has a bank deposits of 22 lakhs. Yes, that can be recovered by the department. Balveer has 27 lakhs receivable from the debtors. So debtors can also be recovered by the CBDT. Do you know that garnishee order? I have told you in recovery and collection that the department can send a garnishee order to the debtor and they can recover the money from the debtor. Yes, they can recover the money from debtor. Then he has gifted a land of 28 lakhs to his major son. So if a land is gifted to major son, that income is not clubbed. That asset is not clubbed. Therefore, the department cannot touch this item. The department cannot. That is major son's property. The department cannot recover the money from there. Next, he has given some diamond necklace to his daughter-in-law. So whatever diamond necklace you have given to daughter-in-law, that will be clubbed in the hands of father-in-law only. There is a clubbing provision for the same. Therefore, this can also be recovered. And last but not least, residential apartment is there in UK in the name of Balveer himself. That can also be recovered by the department. So these 5 things can be recovered by the department. Out of 5 things, these 4 things can be recovered. Only the property which is given to the major son, that cannot be recovered. If that property would have been given to a minor son, that could also be recovered by the department. Okay. Next question. Question number C talks about section 9, whether the following incomes deemed to accrue or arise in India. Now, there is a firm of solicitors in India, and they have engaged a barrister from Australia to come to Madhya Pradesh High Court and practice on their behalf. So they have hired one High Court, they have hired some expert from Australia to come to Madhya Pradesh High Court, that is in India, and practice. Will he be liable for tax? Is his income liable to tax? Is his income accrued in India? The answer is yes. The CBDT yes said that the business connection not only includes business, it also includes profession. Therefore, this income is deemed to accrue or arise in India. Okay. The second question is what? There is a non-resident German company. That German company does not have a permanent establishment in India. Now, that German company is coming to India. For what? To give some technical services. Engineering fee is nothing but a technical services. Now, whether this will be covered under section 911? No, it will not be covered under 911 because for FTS there is a separate section 917. In 917, it will be deemed to accrue or rise in India. Why? Because the services are utilized in India, and for the purpose of interest, royalty and FTS, do remember that there is no need to have any permanent establishment or business connection or place of business or any residence. You can tax interest, royalty and FTS only on the basis of what? It should be utilized in India. If it is utilized in India, these incomes are chargeable to tax in India. And next one, last one, we have done earlier also, that there is a foreign company who is giving us some technical services, and in return we are giving them what? Not money but debentures. Will it be liable for tax? Definitely, because the technical services are utilized in India, it is accrued in India. Now, if I make the payment in cash or if I make the payment in kind, it doesn't matter. I am making the payment in kind in the form of debentures. So that debentures which he is earning from India will be liable to tax. Now, on that debentures, he will also earn what? Some 8% interest. Will that interest also be liable to tax in India? The answer is yes, yes, yes. That interest will also be what? Liable to tax in India. Okay. Now, let's come to the next question, question number 5. This question number 5 has 3 parts, A, B, C. And the third part over here is something which we have already done. It's a question which is exactly similar to what we have done in today's MTP only. You can go and check before. It's a very good question. We have done this but similar question earlier also. So I'm not interested in this question. I'm interested in question number 5, part A and part B. Part A, what does it say? Part A says that there is a partnership firm which is suffering some losses. Now they want to discontinue. So what is the tax implication? It's very simple. Whenever a partnership firm is dissolved, all the assessment etc. will be done by the assessing officer as if it is not dissolved, and he will continue doing the assessment. And at the time of dissolution, whomsoever is the partner is liable for all the liabilities of the firm, along with all the tax liabilities, penalties, prosecution, everything they are liable. All the partners who are partners at the time of dissolution are personally liable along with the firm, are jointly and severally liable along with the firm as per section 189. Okay, this is what this question wants to say. Now, last question over here in this mock test, because the next question I'm not going to do. It is exactly copy paste, something which you have done just some time before. Now, there is one company, Sun Limited, who has purchased a new plant and machinery of 12 lakh rupees on 1st April 2022. Now, they have not taken additional depreciation so far, okay, in respect of this machinery, okay. Now, they have not opted for any concessional rate. We are supposed to find out what is the most beneficial tax liability for them. So, just compute two things. One, compute tax as per normal provision. One, compute tax as per 115BAA. And then see where the tax liability is coming lesser. Okay. The turnover of this company for last year is 338 crore. Therefore, the normal tax liability will be only 25%. Okay. Surcharge will be dependent upon. So, under the regular provision, what will happen? Under the regular provision, this is the total income. Under 115BAA, this is the total income. Under regular provision, you will get additional depreciation of 20% on 12 lakhs. Normal depreciation you have already claimed, because the question says that you have not claimed additional depreciation. Apart from that, you have claimed everything. Okay. Normal depreciation is claimed. So, here you will get additional depreciation. You are not going to get additional depreciation. So, this is the benefit over here, and this is the disadvantage over here. Now, what is the disadvantage over here? The disadvantage over here is 25% tax rate, but in 115BAA it is 22%. Now, the advantage over here is there is no surcharge over here, but there is a 10% always surcharge in 115BAA. So, you have to compute the tax liability, that's it. In the normal provision, the tax liability is coming lower. In the 115BAA, it is coming more. Therefore, it is better to go for what? Therefore, it is better to go for what? The normal provision rather than 115BAA. 115BAA is of no use. Check it, please. So let's go ahead with the next MTP, that is MTP series 1, November 2022. So first question is on computation of total income, and we are supposed to compute total income and tax liability as per 115BAA. So be very careful about it. Okay, we are supposed to compute as per BAA. Okay, so now we are supposed to compute as per BAA the total income and the tax liability, as you can see over here. So accordingly, you have to give the effect of every adjustment over here. Okay, the first thing is 85 lakhs is your net profit, so that's all fine. You have taken some loan from financial institution, but you have not paid the interest on time. You have not paid the interest before the due date of filing of return. Therefore, this interest will be disallowed. disallowed. Okay, this interest will be disallowed under the income tax law. Next is you have taken some services for some non-resident and you have paid some fees for technical services without deduction of TDS. That is also paid later on. The TDS is deducted and paid later on. So 100% of this expenditure will also be disallowed under the income tax law. Next is you are doing some construction work for the government and you have not done the work properly. So you are making some payment of damages for the work done. So if you are making some payment for damages for the work done, then that is considered to be a compensatory penalty and that is allowed under the income tax law. Then the depreciation will be added back. Next one is mark to market loss of 6 lakhs is there. Mark to market loss is allowed if it is as per ICDS as per section 36 subsection 1 clause 18. If it is not as per ICDS, then it is not allowed. We are assuming that this is not as per ICDS because it is not mentioned over here that it is as per ICDS. Therefore, we are disallowing this mark to market loss. Next one is a very important adjustment. You are selling some land to your wholly owned subsidiary, but that wholly owned subsidiary, on that you are earning a profit of 10 lakh rupees. But that wholly owned subsidiary is not an Indian company. And if the other company is not an Indian company, then you are not eligible to get the exemption under section 47. The exemption under section 47 is only available if the other company, that is the transferee, is an Indian company. If the transferee is not an Indian company, then the benefit is not available. Therefore, this 10 lakh rupees will be taxable. So what are you going to do with this? You are going to remove this from PGBP and show under capital gains. But how will I show under capital gains? To show under capital gains, I want sale consideration. We will find out sale consideration. You can come to this adjustment below in the other information. The cost of the land is 30 lakhs and the profit is 10 lakh. Therefore, the sale consideration will come to how much? The sale consideration will come to how much? 40 lakhs. 40 lakhs will become sale consideration. Now, this land was purchased in 2015. You are selling in 2020-23. Therefore, it is sold after 24 months. Therefore, this land is long term. So, you are supposed to also take the indexation. How will you take the indexation? The indexation will be taken as 30 lakh is the cost and then you will compare that with what? 21-22 indexation 317 divided by 254. Now one more thing, the sale consideration is 40 lakhs, but your stamp duty value is 50 lakhs. Is the difference between the two more than 110%? The answer is yes. If the difference between the two is more than 110%, then the sale consideration will not be 40 lakhs, it will be 50 lakh rupees. Be very careful. Okay, so it's a very intelligent adjustment. You are supposed to understand this and you have to mark this. You have to see this before the examination. Next one is you are having some retention money. Retention money, you are into construction business, so you are taking some retention money. So retention money is taxable today itself as per the ICDS. So if you are taking some retention money is taxable today only. Therefore, let it be part of PGBP. Okay, this is also a new adjustment. Next one is also a new adjustment. You have put some money in your FD. Out of that, interest is earned. Generally, if you earn some interest from FD, it is chargeable under IFRS, income from other source. But here, the FD is not for investment purpose. The FD is to give guarantee to the government to obtain a particular contract. So if you give a guarantee to the government to obtain a particular contract for your business, then this interest is inextricably linked with the activity of business. Therefore, this interest will be chargeable under PGBP. It will not be chargeable under what? IFRS. Be very careful. It's a very good question. All the adjustments are absolutely new over here. Next one is you have made some investment in real estate investment trust, that is business trust, and business trust has earned 10 lakh rupees and it has given you 10 lakh rupees. Okay. Now that 10 lakh rupees has a breakup of 6 lakhs and 4 lakh, out of which 6 lakh rupees is short-term capital gains which is earned by business trust. So on short-term capital gains, business trust itself pays tax. You do not pay tax. Investor do not pay tax. Business trust will pay tax at MMR, that is 42.744%. So on short-term capital gains, the business trust will pay tax at 42.744. The investor will not pay the tax. But what about the rental income? The rental income which is earned by the business trust will be chargeable in the hands of the investor and it will be chargeable under PGBP. Why? Because the rental income in the hands of the business trust is its business. So whatever is the nature of the income in the hands of the business trust, that same nature should be there in the hands of the investor also. So if that rental income is business income in the hands of investment fund, in the hands of REIT, then in the hands of investor also, it should be in the form of what? In the form of business income only. It should not be chargeable under the head income from house property. Be very careful. Next one is you have to claim depreciation of 25 lakhs. You can claim that. And the last one over here is 80JJAA deduction is available for 115BEAA SSE. But for the first category, it will be available. So 15 employees, 24,000 into 12 months because they are employed for entire year. The second category will not be available because the emoluments is more than 25,000. The third category will not be available because the casual employees do not participate in the recognized provident fund. To claim 80JJAA, the employees should participate in recognized provident fund. Otherwise, they will not be eligible for 80JJAA. Last employee will also not get because they are employed for less than 240 days. So only the first category of employee will be getting the benefit. After doing all those things, you will compute your income. There are two heads of income over here. One is 80JJAA, one is manufacturing, one is your business income, which will be taxable at 22% under 115BEAA, and another is long-term capital gains on transfer of land, which will be taxable at 20%. 10% surcharge is always applicable, as you all know, in 115BEAA. Then you apply the cess of 4%. Okay. Next question, let's talk about that. Next question is about what? Is about deemed dividend. There is an MD over here who is holding 72% shares in the private company. A private company is considered to be a closely held company. So if a shareholder is holding 10% or more of the voting power in a closely held company, and if the company gives loan to the shareholder, then it is deemed to be dividend. But the deemed dividend cannot be more than what? More than the accumulated reserve. So here the loan is 5.5 lakhs and the accumulated reserve is much more than that, 8 lakhs. Therefore, deemed dividend will be 5 lakh rupees in the hands of the MD, that is the shareholder. It doesn't matter whether that loan is subsequently given to some other person. It doesn't matter. All those things doesn't matter under the income tax law. The MD has taken the loan. Now, whatever he has done with that loan, it doesn't matter whether he has given to someone and whether he has repaid also low. Even if he has repaid the loan, then also 222E will be applicable over here. You can check it over here. Okay. Now, the next question is exactly copy paste of what we have done earlier in question number 11 of the RTP. Now, there are a lot of questions which ICI is going to repeat in the subsequent MTPs. So we are so the question which is exactly similar, we are not going to repeat that. It doesn't make sense. We are doing this revision with an objective of revising a day before exam. So it doesn't make sense to revise the same question again and again. In fact, where the number is also same, name is also same, everything is same. So it doesn't make any sense. So we are not doing this question. I'm giving the reference that this is a question which we have already done either in MTP or RTP, as the case may be. Okay. Now, the next question is question number 3. In question number 3 also the first part and the second part, that is part A, we have already done earlier, and part B also we have done earlier. You can check it once if you want. It is exactly copy paste of what we have done earlier in RTP or MTP. Somewhere we have done, I have not put the reference over here, but we have definitely done both the questions definitely in RTP and MTP, that I am 100% sure. So I am not repeating those two questions. Okay. The second question is very, very important. I agree to that, but it doesn't make sense to repeat the question again and again on the day of exam. The syllabus will not be over like that. Next question, question number 4. We are supposed to find out the tax deduction which has to be made by the assessee. Now, this assessee is earning a salary of 7,30,000 rupees. Apart from that, the company is also giving him non-monetary perquisites of 1,20,000, and company has made a commitment that the tax on non-monetary perquisites will be paid by the company. The tax on salary will be paid by the employee, and the tax on non-monetary perquisite will be paid by the company. So company has to deduct TDS only on the salary, not on non-monetary perquisite, because on non-monetary perquisite the tax will be paid by the company itself. So why the company will deduct TDS on that portion on which the company itself is going to pay the tax? Therefore, first of all, what we'll do, we'll compute the tax. Okay, and then we'll find out how much is the average rate. How to do sums in the such cases. One more important thing is the assessee is following 115 BSc over here. So be very careful. First of all, the salary is 7,30,000. Okay, and 1,20,000 is non-monetary perquisite. Assessee is not going to get the standard deduction. Therefore, I am not taking a standard deduction. You compute tax on 8,50,000. Whatever tax will come on 8,50,000, that comes to 54,600. You divide that by total income. What is the total income? 8,50,000. You will get your average rate. Okay. Now you apply that average rate on two incomes. That is on non-monetary perquisite, apply average rate that will be paid by the company, and on other incomes, that is on other income, if you apply the average rate, or if you can directly do, this is the total tax minus the tax which will be paid by the company, the differential amount will be deducted by the company. It's as simple as that. You can check it once. Okay. Next one is based on section 194A, a very, very important provision under the chapter of TDS with respect to deduction of TDS by bank, etc. Generally, what happens? The bank computes interest on a daily basis. I have told you that for macro monitoring purpose. But do the bank credit also interest on a daily basis? No. Bank does not credit the interest on a daily basis. They only compute the interest on a daily basis. Therefore, here the bank is computing the interest on a daily basis and crediting to one common amount. They are not crediting to what? To the individual customer account. They are not crediting to the individual customer account. Therefore, whether the TDS should be deducted, the TDS should not be deducted in this case, and therefore 30% disallowance cannot be made by the assessing officer in this case. Okay. Next question is about what? Is about there is an e-commerce operator who is in Japan. E-commerce operator, just round the condition, e-commerce operator who is in Japan. It means that e-commerce operator is a non-resident. That e-commerce operator does not have what? Does not have a permanent establishment in India, and it is providing some online advertisement services to a person located in India, but the bill does not exceed 1 crore rupees, 1 lakh rupees per recipient. So be very careful. If a non-resident who is an e-commerce operator who is providing some online advertisement services to me and the payment does not exceed 1 lakh rupees, then in that case, the equalization levy of 2016 will not be applicable. Because for applicability of 2016 equalization levy, the online advertisement payment per year should exceed 1 lakh rupees, but it is not exceeding 1 lakh rupees. Then we have to check the 2020 equalization levy. Is 2020 equalization levy applicable? Yes, it is applicable. Why? Because the assessee is non-resident. He is an e-commerce operator. He does not have a P in India. His gross receipt from India is 2 crore or more. You can check it over here. It's 2.1 crore. And his individual payment is less than 1 lakh rupees. Therefore, the assessee is liable for deduction of payment of equalization levy. The e-commerce operator is liable to pay equalization levy at the rate of 2%. What is 2% of 2.1 crore? 2% of 2.1 crore will come to how much? It will come to 4,20,000 rupees. That is what the assessee is liable to pay over here. Okay. So this is what this question is all about. Let's move on to the next question. The next question, question number 5A. 5A is a theory question. What is thought theory in this? There is a search which is conducted in the premise of assessee on 30th of April 2022. We are supposed to explain, and there was some unexplained money, unexplained jewelry which was found in the premise of the assessee. We are supposed to examine and explain the penal provision in such case. The penal provision in such case is nothing but it is section 271 AAB, and we all know that what happens in 271 AAB. There are two terms which we are supposed to define. First, in 271 AAB. 271 AAB is applicable in case of search and seizure, and there are two terms which we have to define. First, specified previous year. Second, specified date. What is specified previous year? There are 2 points in that. First point, a previous year which is preceding the year of search, for which the due date of filing of return has not come and you have also not filed the return. That year can be called as a previous year. And what is the due date for that previous year? What is the specified date for that previous year? The specified date for that previous year will be the date mentioned in 148. The date mentioned in 148 will be considered to be the specified date for that previous year. What is the second specified previous year? Second specified previous year is the year of search. That is which year? 22-23. And what is the specified date for that previous year? Specified date for the year of search will be the due date under section 139. That is 31st October or 31st July or 30th November, whatever it is of the next year. So first of all, we are supposed to define these terms under section 271 AAB. 271 AAB can be imposed by AO also, and as per Finance Act 2022. It can also be imposed by the CIT appeal. So once we have defined that, now we are supposed to explain to the assessing officer before the search ends. So before the search end, if we are able to explain the assessing officer that this money, this jewelry belongs to specified previous year, we have to explain that in a statement under section 132 subsection 4 before the search ends that this belongs to the specified previous year, and you have to pay the tax, and you have to file the return, you have to pay the interest, and you have to file the return on or before the date of what? Specified date. Whatever is the specified date. If you do that, you will be liable for a penalty of 30% of undisclosed income. If you are not able to do that, if you are not able to fulfill any of the condition which I said you just now, then you will be liable for 60% of undisclosed income as per section 271 AAB. Okay. Now, next question is also a very intelligent question. There are two persons over here, Mr. Sahil, Mr. Rahul, two friends are there. And to both of them, the department is what? Sending a notice under section 148 for income escaping assessment. So let's talk about Sahil first. In case of Sahil, the CBDT has got the information in their system, that is in SFT or in AIS, that 38 lakh rupees are escaped by Mr. Sahil. So in case of Mr. Sahil, CBDT cannot issue notice beyond 3 years from the end of the relevant assessment year. They can only issue notice for 3 years from the end of relevant assessment year. They cannot issue beyond 3 years. Why? Because the escaped income is not 50 lakhs or more. It is less than 50 lakhs. And in case of Mr. Sahil, CBDT has to also do an inquiry under 148A. And CBDT also has to give an opportunity to the assessee that while doing the inquiry under 148A. Second one is in case of Mr. Rahul. In case of Mr. Rahul, there is a search and seizure in the month of April. In case of Mr. Rahul also, CBDT cannot issue notice beyond 3 years, because beyond 3 years, if you want to issue notice, you have to prove that the income escaped is 50 lakhs or more, and it is represented in the form of asset, in the form of expenditure, and in the form of entries in the books of accounts. You have to explain that, otherwise it cannot be issued beyond 3 years. But in case of Rahul, there are some relaxations given to the government and some strictness is there for Rahul. That in case of Rahul, there is no need to do any inquiry under 148A, because a search and seizure case, if a search and seizure is happening on or after 1st April 2021, it is considered to be a deemed escapement, and therefore in case of Rahul, there is no need to issue any inquiry notice under 148A. 148 is necessary, but inquiry is not required. Neither opportunity of being heard should be given to the assessee. It is not required in case of Rahul. Okay. Now, the next question. Question number 6. The first one is a theory question. I am not interested. And the second question is same as the MTP question, where I have also made a complete diagram for you all. You can check it over there of GAR. This question is on GAR, where I have made a complete diagram for you all. Don't worry about it. We have done it earlier. Okay. Now, we'll come to the part C of this particular question, which is a very good question. There is a foreign company, and foreign company is incorporated obviously outside India, and that foreign company is earning some incomes over here. The very first income which is earned by the foreign company is dividend of 8,50,000 on GDR, and GDRs are purchased in foreign currency. Therefore, these GDRs will be taxable at 115 AC at 10% without any deduction of any expenses. 10% deduction, a 10% tax rate under 115 AC. Now the second one, this foreign company is also earning some dividends from Indian companies. So if a foreign company or a non-resident is earning some dividend from Indian company, it is to be taxable at 20%, 20% under 115A. No deduction of any interest is also allowed. Generally, for dividend income, there is an interest deduction which is allowed up to 20% of gross dividend. That is also not allowed for what? Non-resident and foreign company. But the third one is very, very important. The third one, this foreign company is earning some royalty of 8,70,000. I am sorry to say it's not earning. It is receiving receiving some royalty of 8,70,000, 76,000, and there is no agreement, there is no approval by central government. Therefore, this cannot come in 115A. It will be taxed at 40%. One first important thing is that because the agreement is not approved by central government, it cannot be taxed under 115A. It will be taxed at 40% normal rate. The second important thing over here between this and the previous 2 points, in the previous 2 points, the income was earned. It means that was their income. But in this point, the income is not earned. It is received. 8,76,000 is received in the bank account. Therefore, this is not the income. You have to gross it up. How will you gross it up? The tax rate is 40% plus 4% says 41.6%. Therefore, what will be received in your bank account is 100 minus 41.6. That is 58.4. And therefore, you have to divide 8,76,000 by 58.4%. Then you will get the gross income. And on that, you will apply 41.6%. I hope you understood this point. Next one, business income will be subject to 40% tax, 4% cess. And the last one is also something which we have done earlier, that non-resident is giving us some technical services, and now there is an agreement, and that agreement is also approved by central government. So now it is a case of 115A. Therefore, that non-resident is giving some services to us, and we are giving them what? Not money, we are giving them debenture. Therefore, this debenture of 32 lakhs will be taxed under what? Under 115A. It is a consideration for giving technical services. This 32 lakhs will be taxed at 10%. And as against this assessee is also earning 2,88,000 interest on that debenture now. That interest on debenture is not earned in Indian, it's not earned in foreign currency. Therefore, it cannot be taxed at 20% under 115A. You have to tax this interest on debenture at 40%, 40%, 40%. You can go through this. This is what this MTP is all about. So let's move on to the next MTP, that is MTP series 2 November 2022. The very first question in this particular MTP is exactly same as this question what we have done in question number 2 of December 2021 MTP. You can see that entire question is same, all the adjustments are same, all the numbers are also same, the tax liability is also same, everything is same. You can check it once if you want. So it doesn't make sense to waste time unnecessarily on this particular question. The next question, the tax liability is also same. You can check, the computation of income, the final total income is also same. You can check it once, okay. The next question number 2 is also same. It is copy paste. 2A is I am putting the references over here. I am just saying in the air. I am putting references over here. Question number 2, MTP 1 December 2021. It is exactly same. All the taxes is same. All the adjustments are same. Book profit is same. Tax liability is also copy paste. You can check it once if you want. Okay. Now coming to the question number 2B. Now that is a different question. Now there is one company ABC Limited which holds 32% in alpha and alpha holds 75% in beta. So the question is whether ABC and beta are what? Are associate enterprise or not, and is the transfer pricing applicable between ABC and beta? Now we know that ABC and alpha are associate enterprise because both of them are having 26% shares. Okay, alpha and beta are also associate enterprise. They are also having 26% shares or more than 26%. It's in fact 75%. We are not interested. We are interested in the relationship of ABC and beta. Now if alpha is having 75% shares of beta and ABC is having 32% shares of alpha, it means indirectly ABC is having 32% of 75%, right? ABC will have 32% of 75%. Okay, so we have to do 32% of 75% to compute the actual interest in that particular company, that is in beta. So 32% of 75%. If you have 75% in some entity and if I have 32% in your entity, then 32% of 75% is mine, na? Because you have 75% and I have 32% in your company. Therefore, I have to do 32% of 75%. If I do that, it will come to 24%. And the moment it comes to 24%, the transfer pricing provisions will not be applicable. Why? Because both of them are not associate enterprise. Check it, please. Now, the second question is a good question. This is also we have done earlier, but still we are going to do that once again because it's something which is repeating and it's very important and which goes out of the mind of the students again and again. There is one company which is engaged in making some highway projects, etc. They have 2 units, one eligible for ATIA, another not eligible for ATIA. We all know that if one unit is eligible for ATIA, another is not eligible for ATIA, and if they do transaction in between, then it is liable for domestic transfer pricing, okay, under section 92BA. But domestic transfer pricing is applicable only if the aggregate transactions of domestic transaction exceeds 20 crore in the entire financial year. So here the aggregate transaction in the entire financial year does not exceed 20 crore rupees. Therefore, domestic transfer pricing is not applicable, even though the business is eligible, but the provision will not be applicable because it is within the threshold of the provisions. Okay. Now, the next one is also important. This is not repeated ever. Neither it has come earlier, nor it is going to come once again. Do you know that if one company is eligible for 115BAA, it means 15% tax rate, and another entity is not eligible for 115BAA, and if both of them do transaction in between, and if it is different from FMV, then the domestic transfer pricing shall be applicable. Again, here we are supposed to see that domestic transfer pricing is applicable only if the aggregate transaction of domestic transfer pricing, aggregate domestic transaction exceeds 20 crore rupees in the entire financial year. So in this case, one entity is eligible for what? Eligible for 115 BAA, and another entity is not eligible for 115 BAA if they do any transaction, and if the aggregate transaction is greater than 20 crore, which is 20 crore, greater than 20 crore in this case, you can check it once. It is 23,000 per metric ton into 10,000 metric ton, it is 23 crore rupees. So if it is more than 23 crore, 20 crore, domestic transfer pricing will be applicable in this case, you can check it once. So these two questions are also going to repeat once again later on. The last question is not going to repeat, but this one, the middle one, is going to repeat once again later on. So keep that particular thing in your mind. Okay. Now, the question number 3 has multiple parts. The part A is exactly similar to what we have done in question number 20 of RTP. It is cut, copy, paste. This one is same, this one is same, and even this one is same. Don't repeat unnecessarily. You can just see how institute is doing here and there and here, here and there, from RTP to MTP, MTP to RTP, the old MTP, the old RTP. They are just juggling up and mixing up. They are not ready to make all together a completely fresh RTP and completely fresh mock test paper. They are not ready to do that. They are some or the other ways copy pasting the things from here and there. Okay. The next question is a very simple question on DTAA. I'm not interested in DTAA on question. You all know that. The only important thing which I like in this question, which I would like to tell you, is the assessee is ensuring the health of her mother, who is an aged 63 years and incurring 35,000 rupees for the mediclaim, but assessee will not be eligible for deduction of 35,000 rupees because the mother is non-resident. The deduction of 50,000 under 80D is available only if you incur on a senior citizen who is a resident. If a senior citizen who is a non-resident, then the extra 25,000 deduction will not be available. Therefore, here you are going to get deduction of only 25,000. Apart from this, it's a very, very simple question. Do not follow 115 BAC. Compute tax as per the normal provision only. Okay. Now, question number 4 also. In question number 4, part A and part B, it is exactly similar to question number 27 of RTP. You can go and check it over there. You can cross verify. Okay. Now I'm going ahead with the question number 3, question number 4, part 3. And in part 3 also, that question also we have done earlier, but again, I would like to tell you. This question is based on 194O. In 194O, what happens? The e-commerce operator is liable to deduct TDS of the sellers, and the sellers has to be resident. Okay. How much TDS is to be deducted? 1%. And if the seller does not give a PAN and Aadhaar, if the seller does not give a PAN and Aadhaar, you are supposed to deduct TDS not 1%, but you are supposed to deduct TDS at the rate of 5%. Generally, if the deductee does not give a PAN or Aadhaar, you are supposed to deduct TDS at the rate of 20% as per section 206AA. But here in section 194O and in 194Q, it is not 20% for non-PAN cases. It is just 5% for non-PAN cases. So this is what it is happening over here. There is an e-commerce participant, Mr. Adhir. He is selling the goods of approximately 52 lakh rupees. So if an individual sells goods of more than 5 lakh rupees, they are liable for what? TDS. So here, individual and HUF get an exemption up to 5 lakh rupees. Do you remember that in 194O? So he is selling 52 lakhs. He should give PAN and Aadhaar. He is not giving PAN, he is not giving Aadhaar. So he will be liable for 5% TDS over here. This is also we have done earlier in one of the questions, but it is important. It is a recent amendment. That is the reason I have told you once again. Okay. Now next one is a very, very, very good question. Be very careful. This is a very, very good question. There is one entity, Trump Inc., who is non-resident. There is another entity, Sam Inc., who is non-resident. And Sam Inc. is giving what? Online advertisement services to Trump Inc. Now we are supposed to answer this question in 3 parts. First part, assume that both of them do not have a PE. If Sam does not have a PE and Trump also do not have a PE, then equalization levy is not applicable. Why, sir? Equalization levy is applicable only if the person who is receiving the online advertisement service has to be resident. So Trump is not resident. Trump is non-resident. So condition is not applicable. Second, the Trump can be non-resident, but equalization levy is only applicable to those non-residents who have a P in India. Now, because Trump does not have a P in India, in first case, equalization levy is not applicable. Both of them are non-resident and both of them are not having a P in India. Equalization levy will not be applicable. Second part, assume that Trump has a P. If Trump has a P, then Trump is liable for equalization levy of 2016 because he is receiving online advertisement services and the payment is greater than 5 lakh rupees. If the payment would have been less than 1 lakh rupees, then equalization levy of 2020 would have been applicable, as I have told you sometime before. But if the payment is greater than 1 lakh rupees, then the equalization levy of 2016 will be applicable. So here, the non-resident is Sam. Sam is non-resident. Sam does not have a P in India and he is giving online advertisement service. It's a classic case of Facebook. In India, who is there? Trump is there. Trump or Turnip, whomsoever it is. Trump or Turnip, whomsoever. Turnip is having a P in India. Therefore, equalization levy of 2016 is applicable because Turnip is taking services from Sam Inc. and making payment of online advertisement service greater than 1 lakh rupees. So, Turnip is liable to a deduction of equalization levy at the rate of 6%. If it does not deduct, does not pay, he has to bear all the consequences of interest penalty. Along with that, the expenditure will also be disallowed under section 40A1B. And apart from that, if he deducts everything properly, then the advertisement income will be exempt in the hands of Sam Inc. And in third case, if Sam has a permanent establishment in India, It means the service provider, if Facebook has a permanent establishment in India, then also equalization levy is not applicable. In that case, income tax will be applicable. Facebook income will be deemed to accrue or arise under section 911. They will be liable to pay tax under the income tax law. You can check it once if you want. Okay. Now, let's move on to the next question. Question number 5. What is question number 5? There is an assessee over here whose return of income shows that the total income is 52 lakh rupees. So, if your return of income is 52 lakh rupees, and the AO has increased the income to the extent of 3,20,000 rupees. Now you want to go to what? You want to go to dispute resolution committee. Can the assessee go to dispute resolution committee? The answer is no. Who can go to dispute resolution committee? Only those assessees whose returned income is up to 50 lakh and AO enhanced the income up to 10 lakh. Now AO has enhanced the income within 10 lakh, but his returned income is more than 50 lakhs. So because of this reason, he will not be able to go to DRC. So the question is saying, if he is not able to go to DRC, is there any other remedies available to him? He is having 2 remedies. First remedy, he can go to CIT appeal within 30 days from the date of receipt of notice of demand. He can go to CIT appeal. The second option which is available with him, he can go for revisionary application under section 264 to the Commission of Income Tax. Okay. So these are the 2 options which are available with him. Next one is Mr. Rajesh, who is an individual. He regularly files the return. Now CBDT has extended the due date till 31st December. So if the CBDT has extended the due date till 31st December, it's all fine. You can file the return till 31st December and it will be considered to be on time, and you can carry forward all the business loss and capital losses. It is allowed to carry forward because CBDT itself has extended the due date. Now what happened? 11 o'clock in the night. In the night, 11 o'clock, the person was not able to file the return because of some network problem. Okay, on 31st December. So the network problem got resolved at 1 a.m. At 1 a.m. it is 1st January. And therefore, when he filed the return, it became a belated return. Okay, now because it became a belated return, will he be allowed to carry forward this loss? The answer is yes. What is he supposed to do? Because the loss is 51 lakh, you can go to CBDT and ask the CBDT to condone the loss, to condone the delay, and CBDT can do so. Do you remember that? If there is a genuine reason and if the loss is up to, or if the refund is up to 10 lakh, you can go to Commissioner and make an application. Above 10 lakh, up to 50 lakh, go to Chief Commissioner. Above 50 lakh, go to CBDT. So if it is a 51 lakh case and it is a genuine case, which prima facie looks to be a genuine case, because you are filing the return and there was some network problem, you should show the proof that there was some network problem at your end. You will be allowed to carry forward the loss. Don't worry, you have to go and make an application to CBDT. Or if it is 48 lakhs, then you are supposed to go and make an application to Chief Commissioner of Income Tax. This is what this question is all about. Okay. Now, the next question, question number 6. What does it say? This says that there is one assessee who is doing some trading business, whose last year turnover is greater than 50 crore rupees. Okay. So there is one assessee who is doing some trading business, whose last year turnover is greater than 50 crore rupees and current year turnover is 47 crore. Now current year turnover is not relevant. Last year turnover is relevant. Okay. Now he says that I will accept the payment only through cash, check, credit card and debit card. He says that I will not accept the payment through any other mode. It is not allowed. As per section 269 SU, if you are doing a business and if your last year turnover is greater than 50 crore rupees, then you have to put all those modes which are prescribed by the CBDT in your business. Cash, credit card, you can keep those, but apart from that, you have to keep 3 more modes in your business. One is debit card powered by RuPay, one is QR code payment, and one is UPI payments. You have to do all these things in your business. If you do not put all these modes of payments in your business, then there will be a liability of penalty under section 271 DB of 5,000 rupees per day. Every day 5,000 rupees will be imposed on you till the time you put these 3 modes of payments in your business. So till the time you do not put these 3 modes of payments in your business, you will not be what? Relinquished from your penalty. You have to pay the penalty till that date. Okay. Now the next 2 question is what? It is there is one assessee. Pay attention, please. So the question number 6, B1. B1, I'll talk about B1 first. Okay. There is a manufacturing company. There is an assessee who has 2 units. One is in SEZ, another is in outside SEZ, in domestic area. Now, the unit which is in SEZ is doing packing and the unit which is there in domestic area is doing manufacturing. Will the assessee be eligible for 10AA? No. Still the assessee is taking 10AA. It's a clear case of tax evasion. The unit which is there in SEZ is doing packing and the unit which is not there in SEZ is doing manufacturing. It should have been reversed. Then the assessee would have got the deduction. So therefore, this is a case of clear tax evasion. The assessee would not liable for what? Will not be liable for the deduction under 10AA. Next one. There are 2 manufacturing units. Okay. One is in SEZ and one is not in SEZ and they transfer goods to each other. So as I've told you, in that case, what will be applicable? There is already a specific anti-avoidance rule for that. That is the domestic transfer pricing. One unit is under SEZ and another unit is not eligible for SEZ, and if they are selling goods between them, then there is a specific domestic transfer pricing provisions applicable. So you know that guard is applicable in case of tax avoidance. And in which case of tax avoidance for which there is no specific anti-avoidance rule. If there is a specific anti-avoidance rule, guard will not be applicable. So this will be classic case of what? A SAR. Specific anti-avoidance rule is already applicable over here. And the next question, last question in this MTP is about a non-resident. A non-resident is there who is providing some technical services and they have an agreement. The agreement is also approved by central government, so on and so forth. You can check it once that much. Okay, so it's very important to check that whether there was an agreement or not to classify that income as an FTS or royalty under 115A or 44DA. The agreement is there. Agreement is also approved by central government. Now they are asking us to compute income under two circumstances. Assume that they do not have a P. If they do not have a P, then they will be liable for what? 115A. And in 115A, 265 will be the income, 302 will be the income, and no deductions will be available in 115A. And the income will be liable to tax at 10% tax, 2% surcharge because the income is more than 1 crore. For a foreign company, 2% surcharge is imposed and 4% cess. What about if the company is having a P in India? If the company is having a P in India and it is effectively connected with such P, then 44DA will be applicable. Then the revenue will be 265 plus 302. Then the deduction of 35 lakhs will be available. The deduction of 24 lakhs will also be available. The deduction of 8.2 lakhs will not be available. Why? Because that expenditure is not wholly incurred for what? The Indian P. If an expenditure is not wholly incurred for the Indian P, then it is not allowed. Similarly, this 14.6 will also not be allowed. Why it will not be allowed? Because that expenditure is given to what? To an HO. So if you take some services from HO and if you make the payment to HO, it is not allowed. If it would have been reimbursement, we would have allowed. It is not a reimbursement. It is very clearly written in the bracket. The last one will be allowed because it is a case of reimbursement. Reimbursement of actual expenses to HO is allowed as deduction. After doing that, you are supposed to what? Maintain books of accounts, etc., etc., etc. All those things you are supposed to do. One more thing they are asking. In first case, in 115A case, is the assessee liable to file the return? No need to file the return because assessee is having only this. If assessee is having only this income and if the TDS is deducted at the rate mentioned in 115A, there is no need to file the return income. In second case, in 44DA case, you are supposed to file the return of income also. You are supposed to do audit also. All those things you are supposed to do. This is what this RTP is all about. Sorry, this MTP is all about. Check it once. Then we'll move ahead with the next one. Okay. So let's move on to the next MTP, that is MTP Series 1, May 2023 exams. Okay, there is one assessee by the name called as Pratik Hospital. He is owning a 3-star category hotel. Then suddenly it will come to your mind that you should claim 35 AD. But in the last line in the question, it is written that it is not eligible for 35 AD because of some reason. He might have not fulfilled, the company might have not fulfilled certain conditions. So don't take 35 AD over here. The very first thing which they are doing is they are making some cash payment to certain people. First, 25,000 they are making payment to buy some raw cotton from an agriculturist. It will be allowed because raw cotton is agriculture product. You are buying from a farmer and therefore it will be covered as an exception in Rule 6DD. If you buy agriculture products from a farmer, then it is allowed to pay in cash. Okay. The next one is you are paying some 30,000 cash to Mr. Khalid, who is a spice trader, masala wala for corn products. So masala is not an agriculture product. So if you are making a payment to buy to a spice trader for buying some masala, then that is not considered to be covered in exception, and therefore this 30,000 will be disallowed. The next point is about ATCCD disallowances, which is covered under section 3614. Employer can contribute to the approved pension scheme ATCCD of the employee, but it is allowed only up to 12% of the salary. Salary means what? Basic plus DA in terms. If it is above 12% of salary, the excess is disallowed. So now the company is paying how much? Company is paying 3 lakh rupees, which is 12% of the salary. Okay. So 2% will be disallowed. So how to compute 2%? Very simple. 3 lakh into 2 divided by 12. You will get 50,000, add back 50,000 rupees. Okay. The next one is you are making some payment to a road transporter who is a partnership firm. And the road transporter is a partnership firm. That partnership firm is following 44A. It means that partnership firm is not having more than 10 trucks. That partnership firm is also giving you a declaration, and that partnership firm is also giving you PAN to that effect. They are also giving their PAN. If these conditions are fulfilled, 194C is not applicable. You all know that. 194C, you get an exemption in case of road transporter who is owning not more than 10 trucks. Okay. Next one is you are selling some plot of land to Avinia Limited, which is a domestic company, and it is a holding. There is a 100% holding subsidiary relationship, and now this profit will be exempt. Do you remember that in the previous MTPs you were selling that particular land to a foreign company? In that case, it was taxable, but here you are selling to a domestic company. So if you sell to a domestic company, then it is exempt. So you have to remove from here, remove from PGBP and show as a note below the sum that this is exempt under section 47. Okay. Next one, you are making some payment to IIT, that will be allowed as a deduction under 35(2AA). Next, you are making some payment for travel of 2 directors to foreign country because they are going to they are going for some collaboration with a foreign company for a project setup. But unfortunately, the project was not completed and that project did not succeed. The negotiation did not succeed and the project was abandoned. So this will be considered as a capital expenditure and therefore it will not be allowed as a deduction over here. Okay. Next one is you are making payment of some fees to independent directors without deduction of TDS under 194J. So if you are making the payment of 1 lakh rupees, which is more than 30,000, and you are not deducting TDS under 194J, 30% of the expenditure will be disallowed. Next one is depreciation, which will be added back. Next one, you are receiving some compensation, additional compensation or enhanced compensation from the state government. Generally, it is taxable in the year of receipt, but this compensation is coming out of an interim order of a court. Do you remember that? If an enhanced compensation or compensation received out of an interim order of the court, it is not taxable now. It will be taxable in the year in which the final order will be made. So you have to remove this particular 10 lakh rupees from here, and you have to write a note that it will be taxable in the final order in which it is made, and it will not taxable in the year in which you have received the money. Okay. Next one. You are receiving some dividend from a foreign company of 5 lakh rupees. So you can remove from here and that dividend will be shown under IFOS. And against that dividend, you have distributed 7 lakh on or before 1 month before the due date of filing of return to your shareholder. So you are eligible for deduction under ATM. Do you remember that? Whatever dividend you have earned during the year, if you distribute that dividend to the shareholders 1 month prior to the due date of filing of return, you will be getting the deduction under ATM for whichever is lower. Dividend received compared with dividend distributed, whichever is lower. And therefore the lower amount is 5 lakh. So this is a new adjustment which has not come earlier. So this 5 lakh will be allowed as deduction under ATM to you. Okay. Next one is also some additional informations are given over here. The first one is you have taken some loan from a bank and that loan, on that there is an unpaid interest of 10 lakh rupees. Now you are converting this unpaid interest, that is outstanding interest, into a new loan. Will you get a deduction? No, no, no. Explanation 3C, explanation 3D says that conversion of an outstanding interest into a new loan or into any other security will not be considered to be what? Will not be considered to be actual payment. Yes, whenever that new loan will be repaid, it will be allowed as deduction. So this 10 lakh which is converted will not be allowed as deduction. But out of this 10 lakh, 2 lakh installment was paid in March 2023. Therefore, that will be allowed as deduction. Next is depreciation. Next, last adjustment number 3 is you are buying some vegetables or some in the month of March. The bill is of also March, but you have omitted to record that in the month of March. In fact, you recorded that in the month of April in the next year. So that is wrong. You should record that in the current year because this expense is of the current year and you can also take the deduction of that particular thing in the current year. You are only supposed to compute the total income. Do not compute any tax over here. The next question is also a very good question. There is a company PQR LLP which is there is an LLP, sorry, not a company. There is an LLP PQR LLP which is located in SEZ. Therefore, it is eligible for what? 10AA deduction. It was set up in 1819. So it is within 5 years. 2022-23 is 5 years. Within 5 years. So it will be eligible for 100% deduction. Apart from that, this SSC is also having a warehouse for storage of agriculture produce. So this SSC is also eligible for what? It's also eligible for 3580. Now, what is the total income and tax liability including the AMT calculation? So we are supposed to make two calculations. First, total income as per the regular provisions and then tax liability. Then total income as per the adjusted total income as per the AMT and then tax liability. Let's compute the total income as per the regular provision first. What is the profit in SEZ? Let's compute the SEZ profit first. SEZ profit is 40 lakhs. Okay. How much will be allowed as deduction under 10AA? It's very simple. The profit of the SEZ multiplied by export turnover which is 80 lakhs divided by total turnover which is 100 lakhs. If I do that, 40 lakhs into 80 lakhs divided by 100 lakhs, my deduction come to 32 lakhs. Okay. Therefore, 40 lakhs minus 32 lakhs, the 10AA profit will come to, after deduction, will come to 8 lakh rupees. What about 3580 deduction? 3580 profit is 1 crore 5 lakhs. Out of that, 75 lakhs is the capital expenditure which you have done. But out of that, 10 lakh is land. Land is not eligible for deduction. So you will get deduction of 65 lakhs. Okay. So here, the final profit after deduction will come to how much? 105 minus 65, that is 40 lakhs. So 10AA, the final profit was 8 lakh. 3580, the final profit is how much? It is 40 lakhs. Therefore, the total profit is 48 lakhs. On 48 lakhs, you will apply the tax rate which is applicable to an LLP. It is 30%, no surcharge because the income is below 1 crore and therefore no surcharge and plus 4% cess. Compute the tax liability. Now compute the adjusted total income. What is adjusted total income? Adjusted total income is given on the left hand side as I have computed over here. It is total income plus 10AA plus 3580. But after taking 3580, you also have the right to remove the depreciation. So that much depreciation of 10% on building will be reduced because building is eligible for 10% depreciation. Reduce that much. You know, do you remember that? How adjusted total income is computed? Add all profit link deduction except ATP. Add 10AA. Add 3580 and then reduce depreciation on the assets which are used in 3580. So additional, normal both. Your additional depreciation will not be eligible. Only normal depreciation is eligible because building is not eligible for additional depreciation. Anyways, it will come to 138.5. Then 18.5% is the tax. 12% surcharge now because the adjusted total income is greater than 1 crore rupees and 4% cess. After doing all these things, you will get what? You will get your AMT, then compare whichever is higher and find out AMT credit, so on and so forth. Okay. The next question is a very, very simple question. I'm not interested in that. It's a question of DTAA. So you are supposed to take one important thing over here is you are supposed to take 3 lakh rupees deduction on 80QQB because this royalty income is on book which is of artistic book. Artistic book. It is not a newspaper or journal or magazine. It is an artistic book. So you can get the deduction of 3 lakh rupees under 80QQB over here. Okay. Now, the next question is based on exit tax. A trust was there which subsequently converted into some other entity which is not eligible for exemption under 12AB, registration under 12AB. So we are supposed to compute the accredited income and then on accredited income we are supposed to apply 34.944 tax. Okay. Now how to compute the accredited income? It is nothing but aggregate of all asset minus aggregate of all liability. How to compute the values of the asset? For land, you are supposed to take stamp duty value or market value whichever is higher. Therefore the market value is 17 lakhs. We are taking 17 lakhs. For equity shares which are listed in a stock exchange, you have to take highest and the lowest price average and that comes to 80 rupees. For preference shares which are obviously are unlisted, for that you are supposed to take the fair market value. You are not supposed to take the book value. Corpus fund is not taken in liability. Outside liabilities is taken. Provision for tax is not taken in liability and other utility bills which are there for liabilities like electricity outstanding, rent outstanding, other kind of utility outstanding will be allowed to be taken as a deduction from liabilities. Okay. After that, you will get what? You will get your accredited income, apply 34.944% tax on that. Okay. Next one. What is the remedy against the advance ruling? If there is some advance ruling which is passed by the board of advance ruling, what is the remedy against that? I can go to High Court. I can go and appeal to High Court against the advance ruling. Within how many days? I can go within 60 days from the date of communication of the ruling. Whenever I receive the ruling, I can go within 60 days from that day. Can I get extension? Yes. If there is a genuine reason, you can make an application and they can give you an extension of another 30 days in that particular case. Okay. The next question is based on equalization levy of 2020. There is a non-resident who is there in Singapore and who is having what? A website. So non-resident who is an e-commerce operator and the online sale of goods and services, if it is 2 crore rupees or more and that non-resident does not have a P in India, it is written in the last line. So equalization levy of 2% will be applicable and all the conditions of equalization levy of 2% are fulfilled. First, the assessee is non-resident. Just make a count of all the conditions. The assessee is non-resident. Second, the assessee is having a website. So therefore, it's an e-commerce operator. Third, the assessee does not have a P in India. And the fourth, the services provided and the goods sold to person resident in India is 158 lakhs plus out of 96 lakhs which is provided to non-resident, 57 lakhs is from the IP address which is located in India. So that should also be part of 2 crore. Therefore, the total will come to how much? 215. So the threshold of 2 crore is also crossing. Therefore, the assessee, that is the e-commerce operator XYZ and company, is liable for equalization levy at the rate of 2% on 215 lakhs. Okay. Next one is based on what? TDS. So you are buying some assets over here. First of all, the assessee is buying a house property in Mumbai of 90 lakh rupees and the stamp duty value of that house is 95 lakhs. So because the value of the house and the stamp duty value of the house is 50 lakhs or more, the assessee will be liable for what? The buyer will be liable for deduction of TDS at the rate of 1% on sale consideration or stamp duty value, whichever is higher. So you should deduct TDS at the rate of 1% on 95 lakhs. Okay. Now the assessee is buying another property, urban plot in Kolkata for 4950. The stamp duty value of that plot is 48 lakhs. Now the stamp duty value as well as the sale consideration at the purchase consideration of this plot is less than 50 lakh rupees. Therefore, the TDS provisions will not be applicable of 194 IA. 194 IA will not be applicable. Third, the assessee is buying some rural agricultural land. Rural agricultural land is not liable for TDS under 194 IA. So forget about that. Okay. Next one. Are we supposed to deduct TDS on retention of commission? That I've told you earlier also. Yes, TDS is applicable on retention of commission. I told my consignee to sell some goods for 1,50,000 and then I told him that give me 1,30,000 and 20,000 you can retain. Now because the retention amount is more than 15,000 rupees, it will be liable for TDS under 194J at the 194H, at the rate of 5%, 5%, 5%. Okay. Next one, the assessee is earning some salary of 55,000 rupees per month. He is not opting for 115 BSc. So 55,000 into 12 will come to how much? 6,60,000. Now because he is not opting for 115 BSc, he will also be eligible for 50,000 standard deduction. Now he also have a self-occupied property on which he has paid an interest of 80,000. So the employer will give the deduction of that SOP interest also. Employer is liable to give the deduction of interest on SOP if the employee gives the proof of that. Interest certificate has to be produced to the employer. So he has done all those things. So the income will come to 5,30,000. Now on 5,30,000 he will compute the tax and that one should be deducted by what? That one should be deducted by the employer. Okay. Next one is a very, very good question. There is an assessee who is a sole proprietor whose last year turnover is greater than 1 crore rupees. So if the individual's last year's turnover of business is greater than 1 crore rupees, the individual is liable to deduct TDS under 194II. In 194I, what is the TDS rate? For plant, machinery and equipment, it is 2%. And for land, building and furniture, all three of them, it is 10%. And the limit of 2,40,000, which is the threshold limit, has to be counted by taking all of them together. So for office, he is paying a rent of 15,000 per month, which comes to 1,80,000. And for furniture, he is paying a rent of 6,000 per month, which comes to 72,000. Taking together both of them is 2,52,000. The aggregate limit has to be counted under 194I. In 194J, you have to see the individual limit of 30,000. But in 194I, you are supposed to compute the aggregate limit of 2,40,000. And on furniture also, it is 10%. And on building also, it is 10%. Don't be confused. For plant, machinery and equipment, it is 2%. For furniture, it is 10% only. Okay. The next question is a very, very, very good question, which is based on a foreign institutional investor. There is an FII who is earning some interest on rupee denominated bond. So at what rate it will be taxable? It is very clearly written in 115 AD that if an FII is earning some interest which is mentioned in 194 LD, then you have to tax as per 194 LD also. And in 194 LD, FII's rupee denominated bond interest is mentioned over there. You can go and check in 194 LD. In 194 LD, FII's rupee denominated bonds interest is mentioned. Therefore, it will be subject to tax at 5%. Next, the dividend income from the listed company will be taxed at 20% under 115 AD. In 115 AD or 115A, in both the sections, the rate is same only, it is 20%. Next, interest on security will be taxed at 20% without deduction of any expenses under 115 AD only. So interest on debentures will be taxed at what? at 20%. Now, what about the capital gains? Short-term capital gains is taxed at 30%. Long-term capital gain tax is taxed at 10%. Short-term capital gains of 111 is taxed at 15%. And long-term capital gains of 112 is taxed at 10% subject to 1 lakh exemption. So now we are supposed to find out the first one. The first one is a bond which is purchased in 2017 and sold in 2023. Therefore, it is a long-term capital gains. Indexation and all is not available in 115 AD. In 115 AD, indexation is not available. Therefore, 47 minus 32. It comes to long-term capital gains. At what rate long-term capital gains is taxable in 115 AD? 10%. Next, listed shares which was purchased in May 2020 and sold in February 2023. So it is sold within 12 months. It is sold within 12 months. Therefore, it is short term. And therefore, it is short term. So this capital gains will be subject to 111A because it is listed as TT is paid. So it will come in 111A, which will be taxed at 15%. Third one, unlisted share is there, which was purchased in July 22, sold in March 23. It is sold within 24 months. Therefore, it is short term. So short term capital gains, which will be taxable at what? Under 115 AD at 30% tax. Okay, indexation obviously not available on short-term capital gains. This is how you are going to compute the tax over here. Okay, next one, question number 5A. There is one person by the name called as Srimati Kanti. That person is engaged in growing, roasting, grounding of coffee and mixing kikori, lot of business activity. Therefore, 40% of the income will be taxable and 60% will be exempt. Now, the composite income of the assessee is 6 lakh rupees. Now, if the composite income is 6 lakh rupees, so 40% of that is the taxable income. So 40% of that comes to 2 lakh 40. Now, because it is less than basic exemption limit of 2.5 lakhs, the assessee is not liable to file the return. Okay. Now, there is further information given in the question. What if the assessee has gone to US for travel and has incurred 2 lakh rupees, 2.2 lakh rupees as an expenditure for foreign travel? So now she will be liable to file the return because every person who goes on a foreign travel for himself or any other person and incurs 2 lakh rupees, who incurs more than 2 lakh rupees for foreign travel is liable to file the income tax return. I hope you remember that. Okay. The next part is a very theory question. You can read at your end, but still I will just discuss the correctness or incorrectness of the question. The first one is the powers of the commissioner to enhance the assessments are quite wide and plenary. Yes, commissioner has lot of powers under the income tax law, commissioner of appeals. The powers of the commissioner appeal is co-terminus with the assessing officer. What do I mean by co-terminus? Is co-terminus means it has power with the assessing officer. It means he can do what AO can do and he can direct AO what AO has failed to do. His powers are very wide. Next one, at the time of rectification application, the appellate tribunal, what they did, they reappreciate the entire order once again. So there was some mistake apparent with record made by the tribunal. So assessee made an application for rectification. So the tribunal is not rectifying the apparent mistake. It is reappreciating the entire order. Can a tribunal review its own order? No. It can rectify its own order if there is a mistake apparent from record. There are a lot of high courts and supreme court judgments also on this. You can go through it. I have also done that in your class with the help of the judgment, if you remember. Next one is a theory question that you can go at your end. The next one, there is an assessee. There was a case when what happened? The assessing officer passed an order for AY 2122. Be very careful. But while writing in the order, by mistake, it was a clerical mistake, typing error, the assessee wrote 2021 in that particular order. And the department raised a demand on the assessee. Now the assessee is saying that I am not ready to pay the demand because the order is invalid. Because instead of 2122, why the hell the officer has written 2021? He should not have written 2021. That is a mistake by the assessing officer. So there is one section 292B which says that if there is a clerical mistake, you have to ignore that. Clerical mistake cannot be the reason to tell the assessment that the assessment is invalid. It is absolutely wrong to say that. The clerical mistake is what? The clerical mistake will hold the order was as invalid. Clerical mistake cannot make the order invalid. It is written in section 292B. You can check it over there if you want. Okay. Next question. Next question is what? We are supposed to find out whether the following cases are tax planning or tax management or tax evasion. In first case, the assessee is maintaining some register for tax deduction. So for proper compliance. Therefore, it's a case of tax management. Okay. Next, the assessee is obtaining from the lenders and the depositors what? 15G, 15H and then forwarding the same to what? Income tax authority. It's also a case of tax management. Okay. Next, the company has purchased some air condition and has installed that air condition in the residence of the director. Where it is installed? At the residence of the director. And now the company is showing in the books of accounts that it is installed in factory. So it's a clear case of tax evasion. You are evading tax now. You are buying a AC, installing at the house of the residence of the director, but showing as an asset of the factory. Absolutely not allowed. It's a tax evasion case. Next one, the assessee is issuing a credit note to one of its broker of 80,000 rupees and claiming deduction of 80,000 rupees. Okay. And the other person's income is increasing from 4 lakh 20 to 5 lakh rupees. So other person it does not affect because at 4 lakh 20 also is not going to pay tax. At 5 lakh also is not going to pay tax. Therefore, let's take a credit note of 80,000 rupees. So I gave you a credit note of 80,000. I am showing some purchases from you. And then I am claiming a deduction. I am a company. You are an individual. I am showing some purchase from you. I am giving you a credit note. And therefore, that is a clear case of tax evasion, tax evasion, tax evasion. Okay. Next one, you are investing some amount in tax saver deposit of government in a nationalized bank. So you will be eligible for deduction under 80C. And this is the case of tax planning. It is allowed by the law. Tax planning is allowed by the law. Next one, last question of this RTP is XC Limited is there and Zilla Inc is there, and one entity holds 28% equity shares of the other entity. Therefore, both of them are deemed to be associate enterprise. Okay. Now, there are some simple transactions between both of them. When you are selling the t-shirts to Zilla, you are selling at $2. When you are selling it to third party, you are selling at $3. Why at higher price to outsiders and why at lower price to associate enterprise? Therefore, the differential amount will be added back to your income. $1 into 1 lakh shirts into 64. Similarly, when you are giving guarantee to Zilla, when you are taking guarantee from Zilla, you are paying 10,000. But when you are taking guarantee from third person, you are paying only $7,000. So again, you are paying $3,000 extra multiplied by 64, whatever is the conversion rate. Third one, when you are making payment, when you are making payment to Zilla, you are making payment of $15,000, and to unrelated party, you are making a payment of $10,000. Again, you are making excess payment $5,000 into 64. That will be subject to what? Arm's length price will be added back to your total income. Now, the question is, the assessee is located in SEZ. The question over here is very simple. Whatever income is increased by the assessing officer, can assessee claim 10AA deduction on that enhanced income? It is not allowed. Do you remember that? If the income is increased by AO, then the assessee cannot claim deduction of 10AA or profit linked or chapter 6A on that enhanced income under the transfer pricing. It is not allowed to claim the deduction over there. You can check it once. Then we'll move ahead with the last MTP. So this is the 8th and the last MTP as of now. Okay, so this is what I tried to do from my side. I used to do that earlier only for my North India student and West India student and East India student. So my dearest South Indian students were left out. I never felt like leaving you all, but it was just a time which was a constraint from me. So I tried my best to take out the time for you all, and I said that I have taken an oath now that whatever I will do for my other students, I will also do it for you. You all are equally important for me. You all are equally intelligent. You all have equal potential. So you should get the same services. Whether you are my student or you are not my student, it doesn't matter to me. If you are my student, well and good. If you are not my student, then also it is well and good. It's all fine. I'm all okay with that. So without wasting any further time, let's start with the last MTP over here. And the very first question in this MTP is on what? Again, a total income question. What are we supposed to do in this question? No MAT, no 115 BAB. It's a normal question. Okay. So let's talk about one by one. Assessee is a manufacturer since 2009. So 50 lakhs, first of all, the depreciation has to be added back. The adjustment number 2, employer contribution to provident fund is paid on 30th June. Allowed. Employer contribution to provident fund can be paid till the due date of filing of return. Allowed. But employees contribution has to be added back because employees contribution has to be paid by 15th of the following month. You cannot pay till the due date of filing of return. Not allowed. This is late. So this should be added back. Okay. Next. You have got some concession from the government, state government. So any kind of benefit, any kind of subsidy, grant, reimbursement, waiver, concession received from the government, central government or state government, it is an income under section 222(18). So let it be part of PNL. Let it be part of PNL. It is credited to the PNL. It's an income under PGBP. Let it be part of PNL. Okay. Next one. You are making some provision of 25 lakhs payable to the worker, which provision which you make in every 3 years, and it is based on fair estimation. So this is the policy of the company to make this provision in every 3 years, and which is based on, this is the kind of wage revision. Okay. So while revising the wage, they have to make some provision. So that is a fair estimation, which is the policy of the company. It shall be allowed as a deduction. Next, you have some debtors of 200 lakhs, out of which you feel that 10% is bad and doubtful debts. Bad and doubtful debts will not be allowed as deduction. Provision for bad debts is not allowed as a deduction to all assessee. It is only allowed as a deduction to banks and NBFC under section 36(1)(7)(a), and this assessee is not a bank. Next one, your debtor is insolvent to the extent of 40 lakh rupees and you have written off that debtor in the books of account. So if your debtor is insolvent to the extent of 40 lakh rupees and you have written off that debtor in the books of account, therefore it will be allowed as deduction under section 36(1)(7). Okay. Next one, you have a creditor of 50 lakh rupees which is supposed to be payable, out of which the creditor has given you a discount of 75%. Means the creditor has waived off 75%. 75% of 50 lakhs will come to how much? It will come to 37.5 lakhs. That is waived off by the creditor. So that will become your deemed income under section 41. 1. Remission or cessation of a trading liability is a deemed income. Now, you should not do anything because that is already credited to the PNL. So do not do anything. It is a part of PNL already. Don't make any adjustment. Next one, your opening stock and your closing stock, both of them are overvalued by 10%. It means your opening stock is valued at 110%, closing stock is also valued at 100%. Do backward working and then find out how much is overvalued, and opening stock has to be added back and closing stock is to be reduced. Okay. You can also do one more thing, that opening stock is 200, closing stock is 255. Therefore, the net is 55. Okay. The differential amount is 55. Differential amount is going towards what? The higher portion is what? It is closing stock. So divide that by 110%, you will get 5 lakhs extra. So that extra is what? That is towards closing stock because closing stock is higher. So reduce that much amount. Okay. That also you can do. Next, Provision for payment of gratuity of 500 lakhs. Not allowed, not allowed, not allowed. Disallow that as per section 40A7. Provision for payment of gratuity is disallowed under 47. But when it is paid, it is allowed. So 300 lakhs is paid. So 500 lakhs will be added back because it is provision, and 300 lakhs will be reduced because it is paid, and that will be allowed as reduction. You are making some payment of commission of 1 lakh rupees to a agent for recovery of debt. There are some debtors who are not paying you the money. So I gave 1 lakh rupees as a commission to a commission agent, and I told him that get the money recovered from them. Yeah, I also deducted that TDS. So it is allowed as a reduction. There is nothing wrong in that. Okay, you are also deducting TDS. So expenses incurred to recover your debt is allowed as a reduction. Okay, next one. You are making some extra payment to your related party, so that is disallowed. That is a very simple adjustment. Next one, the assessee is buying a plant and machinery of 50 lakhs or 50 lakhs on 10th of June, and it is used for more than 180 days. Additional depreciation they forgot to give. And the assessee is also manufacturing, you can see on the very first line. Therefore, the assessee will be eligible for what? Additional depreciation of 20%. 20% will come to 10 lakhs, reduce 10 lakhs. Okay. Also reduce this 80 lakhs income tax depreciation which you can take. Okay. Next one, you have made some payment to the subcontractor in the last year of 10 lakh rupees, but you did not deduct TDS in the last year. So in the last year, 30% of 10 lakh would have been disallowed. So in the current year, you have made that payment on 31st of December 2022. That is, you have made the payment in 22-23. So in the last year, whatever this TDS expense was disallowed, that is 30%. That 3 lakhs will be allowed as deduction in the current year. You can see over here. Okay. Now the next adjustment is a very important, intelligent adjustment. You have collected 7 lakh rupees GST from customer. Now, if you have collected 7 lakh rupees GST from customer, you will get the deduction of GST if you pay that GST. You paid 7 lakh. So you took 7 lakh as deduction. This 7 lakh is nullified. Now, you filed a case in the High Court. So High Court gave you a refund. So on that refund, you are supposed to pay tax as per section 41(1) because that 7 lakh was claimed as deduction and subsequently it was recovered. So 41(1) will be applicable. You are supposed to pay tax on 3 lakhs. Now, out of this 3 lakhs, you have given that money back to the customers because ultimately GST money is taken from customers only. So you have given back that 2 lakhs to the customer. So 2 lakhs you will be allowed as a deduction. So ultimately, what will be added back? First, you got 7 lakh, you pay 7 lakh, that is nullified. Then you got 3 lakhs and then you pay 2 lakhs. So 1 lakh is still yet to be paid. So that will be added back to your income statement. You can check over here. Okay, because GST is allowed on payment basis, not on accrual basis. Okay. So this is what this question is all about. After that, you are going to compute the tax. The tax will be how much? The tax will be 30%. Why? Because the turnover of last to last year is more than 400 crore. Surcharge of 7% will also be applicable. Why, sir? Because when you compute the total income, it is more than 1 crore, but up to 10 crore. It is between 1 to 10 crore. So surcharge of 7% will also be applicable. Okay. Now, the next question number 2A is also a very intelligent question. There is a partnership firm who is having a total income GTI of 300 lakhs, gross total income. Now, this partnership firm is not eligible for any kind of international transaction or transfer pricing. They are not eligible for transfer pricing. Okay. They are domestic assessee. Now, this partnership firm has a profit of 200 lakhs, which is what? Eligible for deduction under 80IA. Now, and this is the 5th year of the assessee. Therefore, the assessee will be liable for 100% deduction in the section 80IA. So, the GTI is how much? 300 lakhs. The 80IA deduction is how much? 200 lakhs. The assessee is having 5th year of business, therefore 100% deduction will be available. But do you remember that 80IA is available only if you file the return on time. If you file the return late, then none of the profit link deductions are available. In all, there are 15 profit link deductions which I have told you, which are mentioned in section 80AC. You can go and check the chapter of return filing. I have mentioned over there in the Easy Notes colored book. Therefore, if the assessee is not filing the return on time, then the deduction of 80IA will not be available to the assessee. So, now the assessee is thinking to file the return on 7th of December. That is wrong. They will not get the deduction of what? They will not get the deduction of 80IA. So, we are supposed to give them a working that what will be the tax treatment if they file the return on 31st October. 31st October is the last date as per 139(1). Then what will be the tax liability? And what will the tax liability if they file the return on 7th of December? And what should be the practical solution that we can give to them? Now, let me show you what will happen. First of all, if they file the return on 31st of October, they will be eligible for 80IA. So, GTI will be 300 minus 200 lakhs will be 80IA deduction. Total income will be 100 lakhs. And on 100 lakhs, they will be liable for tax. And surcharge, tax and cess, surcharge will not be applicable. Surcharge is applicable if the income is more than 1 crore. On exact 1 crore, surcharge is not applicable. But because the assessee is not a company, it's a partnership firm and it is claiming deduction under 80IA, it will also be liable for adjusted total income AMT provisions. Therefore, how much will be the adjusted total income? It is nothing but 100 lakhs total income plus chapter 6 deductions 80IA. Therefore, adjusted total income will come to 300 lakhs. And on that 18.5% will be taxed. Now, even surcharge will be applicable because the income is more than 1 crore rupees and 4% cess. So, that will come to the tax liability. Whichever is higher, the assessee is liable to pay that. Now, if the assessee files the return on 7th of December, then the assessee is not eligible for 80IA. And if the assessee is not eligible for 80IA, you are not supposed to compute AMT then. Don't compute AMT. If the assessee is not eligible for 80IA, AMT is not applicable. AMT is applicable if you compute any of the deductions under chapter 6A or 80IA, 80IB or 10AA or 3580. If you do not compute any of them, then the provisions of AMT are not applicable. Then you compute provisions of normal provision tax. The normal provision, the JTI will be 300. You will not get the deduction of 200 lakhs. On 300, you will compute 30% tax, 12% surcharge, 4% cess. Definitely, this tax will be greater than the tax as per if you file the return on 31st October. Therefore, the first advice will be file return on time. But the company is saying that we do not have time to file the return on time. There are some workings which are yet pending, which is to be done on 31st of October, which we cannot do on 31st of October. We cannot file the return before 7th of December. So I'm giving a practical solution to you. Okay, that practical solution is very simple. Tell them to file the return on 31st October as per the working which they have. Whatever working they have with them, file the return as per that working on 31st of October. Now, once they file the return on 31st October, then tell them to revise under section 139(5). Later on, you can revise the return before 31st December, and then you can revise and you can change, and then it will be said that revised return steps into the shoes of the original return, and it will be said that revised return was also filed on 31st October, and nobody can take the deduction from you of what? ATIA. So this is the practical solution that we are going to give to the assessee. Okay. Now, part number B is very important question, but that question exactly same copy paste with same numbers, everything we have already done as question number 5C of MTP December 2021. You can check it over there if you want. Okay, it's an exactly same copy paste question. You can check it once. So let's move on to question number 3A, which is based on charitable trust. There is a charitable trust registered under 12AB. It has received a gross income of 21 lakhs, 10 lakhs, 4 lakhs, 7 lakhs. And this 21 lakhs will be first subject to 15% flat exemption, which is given under section 10, section 11, subsection 1. And after that, it has also incurred 11.6 lakhs towards what? A charitable purpose. But out of that 11.6 lakhs, 3.6 lakhs is repayment of loan. And against that, it has already claimed exemption. It has already claimed deduction under 2020-21. So in 2020-21, they might have taken some loan, and when they took the loan, they incurred some expenses out of that loan. Because earlier what used to happen, this is an amendment which is made by Finance Act 2021. That once you take a loan and if you incur an expenditure, then expenditure is not allowed. But earlier it was not like that. Earlier when you used to take a loan and if you used to incur the expenditure, it was allowed as an expenditure. So in 2020-21, you would have taken a loan of 3.6 lakhs and you would have taken a loan and you have incurred that expenditure. Now, if you have taken a loan of 3.6 lakhs and incurred the expenditure and you have taken the deduction in 2021, then you cannot take the deduction of that once again while repaying 3.6 lakhs. So out of 11.6 lakhs, I am removing 3.6 lakhs and therefore my final deduction will be only 8 lakhs. So I will remove 8 lakhs from 17.85 and that is my taxable income. Okay, this is what this question is all about. Now the next question is repeating again and again. There is one institution which is registered, which is covered under 1023C and they are engaged in hospital also, education also. The limit of 5 crore has to be seen taken together. So if the limit of 5 crore, if both of them, the hospital receipts and the education receipts, if both of them are up to 5 crore, then their income is exempt. If it is exceeding 5 crore, they are liable to take what? They are liable to make an application to the CIT and take the registration and approval under 1023C. Okay. The next one, question number B1. B1 is a theoretical question which says that advance ruling will only address the application of the non-resident. Is it so? Advance ruling will only address the application of the non-resident. It is absolutely wrong. Advance ruling, there are a lot of applicants which are there in advance ruling. Yes, the very first applicant is non-resident, but the second applicant is a resident when the resident enters into a transaction with non-resident. The third applicant is a specified resident whose transaction value is 100 crore or more. The fourth is a PSU, public sector undertaking, and the fifth one is the assessee who is engaged, who has undertaken any kind of transaction which will be liable for what? GAR. So all these people are applicants. It is not that only the non-residents are eligible for advance ruling. That is board for advance ruling. All these people are eligible for what? Board for advance ruling. Okay. Next is also a question on equalization levy. There is a company ABC Limited in India and there is a company which is PQR Limited in London, which is a non-resident. It does not have a P, and that company is giving us, the Indian company is the recipient, and that foreign company is a non-resident who is a service provider. They are giving us online advertisement services and we are making them payment of more than 1 lakh rupees. So if a non-resident is there who does not have a P, giving online advertisement services in India, there is a resident who is making a payment of more than 1 lakh rupees. It's a classic case of equalization levy under section 2016 equalization levy under section 165. So the Indian company, Indian entity is liable to deduct TDS, is liable to deduct equalization levy at the rate of 6%. If they do not deduct, they will be liable for interest, penalty and disallowance also under section 40A(1)(b), and if they deduct everything, then the income will be exempt in the hands of PQR. So it's a classic case of equalization levy which came in 2016. It's not a 2020 equalization levy. 2020 equalization levy would have been applicable if this 5 lakh payment would have been less than 1 lakh rupees. Then 2020 equalization levy would have been applicable. Okay. Now the next one is the question which is based on TDS. So there is a company MNO Limited who has credited some salary in the books of accounts of the employee. So if the employer is crediting the salary in the books of accounts, is TDS applicable on credit basis or payment basis under 192? Under 192, TDS on salary is eligible to be deducted on payment basis, not on credit basis. Therefore, this is not liable to TDS. Yes, if whenever the payment will be made, at that time the employer will take what? The proof of investment, the proof of interest, the proof of interest certificate, the proof of ATC at that time. Right now, the employer is not liable to deduct TDS Because the salary is not paid. Salary is deducted on payment basis, not on credit basis. Be very careful. Next one, there is an individual, Mr. T, whose last year's turnover is greater than 1 crore rupees. Check. Okay, now if the last year turnover is greater than 1 crore rupees, therefore it is eligible for what? 194C. Now, it is making a payment of 9 lakh rupees for renovation or construction of factory building to an individual. Yes, an individual whose last year's turnover is greater than 1 crore rupees and it is making the payment not for personal purpose but for business purpose, and it is more than 30,000 and 1 lakh rupees. Therefore, the TDS will be liable to be deducted at 1% on 1 lakh. Why 1%? Because the contractor is what? Individual. If the contractor would have been other than individual and HUF, it would have been 2%. Okay, next, BCD Limited is making some payment of 28,000 towards professional fees and 27,000 towards what? Technical fees. So I am making two payments to one person. One is professional fees, one is technical fees. One is 28, one is 27. Is TDS applicable? Not applicable. Because under 194J, the limit of 30,000 is applicable separately for professional fees, separately for royalty, separately for technical fees, separately for non-compete fees, and for director, over and above remuneration to director, what you pay. For that, there is no limit only. Even if you pay 1,000 rupees, you are liable to deduct TDS. But for royalty, FTS, and non-compete fees and professional fees, there is a limit of 30,000 separately applicable. Next one is a very simple question. There is a nationalized bank who is taking some services of a catering organization. So the catering word is covered in 194C in the definition of work. So that will be liable for TDS under 194C. If the caterer is individual HUF, then 1%. If the caterer is other than individual HUF, then it is 2%. Okay. Next one is which talks about that whether the transfer pricing provision will be applicable or not. So it's a very simple thing, whether the transfer pricing provision will be applicable or not, and whether the associates are, whether the two parties are associate enterprise or not. In the first case, one entity is PQR INC and another entity is Indian company Mahanadi Limited, and one entity has a book value of asset of 300 crores and another entity has given a loan of what? 170 crore to the other entity. Therefore, it is 56.67%. Therefore, if one entity is financing at least 51% of the book value of the assets of the another entity at any time during the previous year, then both of them are deemed to be associate enterprise. Now here, market value is not relevant. What is relevant in 92A is the book value of asset to determine the associate entity relationship. Market value is not relevant. Further, it is not relevant whether the loans are repaid or not repaid. It doesn't matter. It doesn't matter whether it is repaid or not. At any time during the previous year, if it is 51%, then both of them are deemed to be associate enterprise. Next, if one entity appoints more than half of the directors of the other entity, then both of them are deemed to be associate enterprise. Now we are appointing 3 out of 8 directors. That is not more than half of the directors. Therefore, both of them are not deemed to be associate enterprise. Next, if one entity purchases 90% of the raw material is purchased from another entity. So, of the raw material is purchased from another entity, then both of them are deemed to be associate enterprise. I am having a total raw material consumption of 900 lakhs, out of which 830 is purchased from one person only. That comes to 92.22%, which is 90% or more. Therefore, both of them are deemed to be associate enterprise. You can check it once. Now, the next question, question number 5A, is a very good question. What is happening over here? On 12th of September, see on the dates, focus on the date. This question is based on dates. On 12th of September, there is a search in your office, in your factory, in your premise, and cash of 25 lakhs was seized by the income tax department. Now the department gives you some time to explain the nature and the source and take back that cash. What is the time? It is within 30 days from the end of the month in which the search was conducted. Search was conducted in which month? September 22. So you have time till 30th of October 2022 to explain the nature of source, nature and source. And if you explain the nature and source properly, the department will take the existing liability and will return you back the remaining things within 120 days from the date of the last authorization of search. They will return you back. So when is the search happening? The search and seizure is happening on 12th September. By when you are supposed to go? You can go up to 30th October 2022. When are you actually going? I am going within time. On 27th October, I am going. And I am giving the explanation to them. But the CBDT is turning down the application. They are saying that we do not agree to your application. It's all fine. They may agree to your application. They may not agree to your application. It is their discretion, yeah. If they agree to that application, then they will return your assets by taking the existing liability. They will recover the existing liability out of this 25 lakhs and they will return you the remaining money within 20 days on the last date of the authorization of search. But if they do not agree to your explanation, they do not agree to your story of what? From where you have got the money, then they will not give you the money back. Then they are not obligated to give you back. These are the two possibilities which are there in this particular question. Next question is, the return of the assessee was filed on 26 September. Now, by when the scrutiny notice should be served to the assessee? The scrutiny notice is to be served to the assessee within 3 months from the end of the financial year in which the return was furnished. So, return was furnished in 22-23. So, within 3 months from the end of the financial year will come to which date? Will come to 30th of June 2023. Now, remember, by this date, the notice have to be served to the assessee. It means the assessee should receive the notice. Now, unfortunately, the notice notice was served to the assessee on 3rd of July. Now what will happen? Now there are two possibilities. If the assessee raises an objection that the notice is late, when should it raise the objection? Before completion of assessment. If the assessee raises an objection, then the notice is an invalid notice. But if the assessee does not raise an objection before the assessment is completed, and assessee is raising an objection after the assessment is completed, then it is deemed to be valid as per section 292BB. This is what this provision wants to say. Next, point number C is a theory question, but still I'll discuss one because it's a very important theory question which ICI has asked a lot of times in the examination, which is based on Article 4 of OECD and UN Model Convention. What does it say? What has to be done in case of tiebreaker rule? In case of tiebreaker rule, what is tiebreaker? When a person becomes resident of two different countries, then of which country he should be considered to be resident as? It's a match which is tie. Now, how to resolve this tie? You have to apply the tiebreaker rule given under Article 4 of OECD and UN Model Convention. What are you supposed to do? Suppose I am a resident of India and I am also a resident of UK. So in case of individual, if he becomes resident of both the countries, then first of all you need to find out where his permanent home is. Wherever his permanent home is there, in that country he will be considered to be resident. If that is not possible, then second possibility, find his center of vital interest. Center of vital interest means where his personal and economic relations are closer. Wherever his personal and economic relationships are closer, that country will be considered to be country of residence. Third, if that is also not possible, find out his habitual abode. If that is also not possible, find out which country's national he is. If that is also not possible, then both the country's competent authority will decide that this person is considered to be what? A resident of this country or that country. Both the country will play passing the parcel. Whether you want him to be resident or whether I want to be resident, that will be decided mutually between both the countries. In case of other than individuals, in case of companies, etc., it will be decided based on mutual agreement procedure between both the countries, considering many factors like POEM, etc., country of incorporation, and many other factors. Okay, next one. Question number 6A. There was an assessee who has taken some loan in cash of 50,000 rupees. Okay. Now, the assessing officer is saying that this is not a loan. He is saying that this is not a loan. This 50,000 is undisclosed income and he is treating that as section 68, 69, etc. undisclosed income. That's well and fine. There's nothing wrong in that. But while applying the provision, he is doing something wrong. On one hand, he is saying that it is not loan, and on other hand, he is imposing penalty under 271D. Penalty under 271D is imposed in case of violation of 269SS. And in 269SS, you have to say that first of all, it is a loan. So this is the mistake. If the AO is not agreeing to the story of loan, it's all fine. There's nothing wrong in that. But at the same time, then he cannot impose what? 271D. Even if he wants to impose 271D, he cannot impose 271D more than the amount of loan. It cannot be more than 50,000 rupees. You can check it once. So there are a lot of loopholes by the assessing officer in this particular question. Now, the next question is something which we have already done as question number 6B of MTP November 22. And the last question is a very important question. I am not saying this is not an important question. It's a very important question, but we have done that in class also, and it's a DTAA question, but it's a very important DTAA question. If you do only this, we have done it in class. That is the reason I am not recapping that. It's a very simple question, but it's an important one. Nothing great as such. So that's it. Here we complete what? Here we complete all the 8 MTPs in approximately, I think so, in around 2 hours. 15 minutes for one MTP, approximately an hour for 4 MTPs and 2 hours for 8 MTPs. So this is what my objective was. When I was teaching you the subject in your regular batch or even in your fast track batch, I have discussed all these 6. Most of the things I have discussed except the latest one, because latest one came just now, not during the batch. So at that time I was thinking that how the hell a student will revise these things. There are a lot of revision videos on YouTube revising what? The entire subject. In English, so there are very few, except ours. Very few people have uploaded that. There are a lot of marathon on big questions. 10 hour marathon. What sense does it make? It doesn't make any sense. Ultimately, if you don't have an answer to the question that how to revise the subject a day before exam, then it doesn't make sense to revise or to do that much effort in the study leave. So this is what I have tried to do. I don't know to what extent it has helped you. I don't know whether I'm benefiting you all or not. I don't know. That you all can comment below and you can let me know. Okay. So that's it from my side as of now. Very soon I'll be also coming up with the past papers. 5 past papers I'm going to discuss with you all so that you come to know further important adjustments which are generally asked in the exams. Okay. Take care all of you. Bye. So hello all my dearest students of South India. I hope you all are doing good and I hope you all are studying well for your upcoming exams. Okay. So now I am coming towards my last commitment which I have made to you all, and that is the discussion of past papers. So here today we are going to do the discussion of last 5 past papers which are relevant for your exams for May 23 as well as for your November 23 exams in full English, especially dedicated to my South India students. Okay, so that you guys should not be felt left over. So without wasting any further time, the very first question over here is based on the computation of total income and tax payable as per the regular provision, not as per MAT, not as per 115BAA. Okay. So this is not as per MAT, not as per 115BAA, as per the regular provision. So let's start. Assess is a manufacturing company, so accordingly you can have some special provision applicable. The net profit is 75 lakhs. The very first adjustment is a very good adjustment till last year, that is till 21-22. The company used to include the interest as a part of their stock. Interest was a part of the cost of stock. But from financial year 22-23, they have removed that, which should not be part of cost. Okay, as per the accounting standard also, interest cannot be part of what? The stock. Interest has to be removed from the stock. So in the current year, the company has done properly, and the company has also decreased the profit because of that. Whatever profit was to be adjusted, the company has done that. Now, if everything is done by the company properly, we don't have to do any adjustment, and that is the reason for this first adjustment, we are not going to give any effect over here. Okay. The next question is, the company has made a provision for gratuity of 5 lakhs. Now, we all know that provision for payment of gratuity is disallowed under the income tax law. Whatever is the provision is not allowed, not allowed, not allowed. Yes. So this 5 lakhs will be disallowed. Yes. As per 48(7), it is disallowed. But whenever it will be paid, that is 1,20,000 is paid, that will be allowed as deduction. So the ultimate effect of this particular adjustment would be add 5 lakh less 1,20,000. Next one, the company has purchased some one-time license fees, franchise fees, paid some one-time franchise fees. Now that is what? That is your intangible asset. So you have to add back this 20 lakhs and you will remove 25% depreciation on the same, and you will claim full depreciation because the asset is used for more than 180 days. Next, there is some loss, cash loss by theft, and the company has not insured that particular cash. Okay, so cash loss by theft, cash loss by fire, etc. All these things are revenue losses, trading losses, which will be allowed as deduction as per the Supreme Court judgment of Badridas Daga versus CIT. Therefore, this will be allowed as deduction. The next one is a very, very, very intelligent adjustment. You are making some payment of 3 lakh rupees royalty to non-resident. Now, you have deducted the tax, but you have not deposited the tax till the due date of filing of return. So now this expenditure will be disallowed 100%. It is as simple as that. Now, they have given you some information to confuse you, like the other person, that is the payee, has filed the return. The payee has included this 3 lakh rupees in the income, but the payee is claiming refund on that. Okay, there are two reasons because of which I cannot give you the deduction of this 3 lakh rupees. First of all, do you remember that if the payer has not deducted, payer has not paid, but the payee has included that income, has paid the tax and has filed the return, then the payer will be deemed to be what? Not assessed in default. It is deemed that the payer has deducted and the payer has paid. Do you remember that there is some proviso like this in the income tax law? But that is applicable only if the other person pays the tax. Now, in this question, the other person does not pay the tax; he is claiming a refund. So that is the first reason because of which I will not allow the expenditure, because there are three conditions that the payer has to do. He has to file the return. Yes, he has filed. He has to include the income. Yes, he has included it. But apart from that, he also has to pay the tax. Now, he is claiming refund. He is not paying tax. Therefore, in that case, I will not get the deduction. This is the first reason because of which I will not get the deduction. The second reason because of which I will not get the deduction is as follows. Listen carefully. The second reason is very, very simple. That it is deemed that it is deducted in the month of what? In the month of July. So if it is deducted in the month of July 2023, it will be allowed in the next year, not in the current year. In any case, in the current year, it will be disallowed. Okay. Next one is a very routine adjustment. You are selling some plot of land to your 100% holding subsidiary. Okay. So that is exempt under income tax law. So that is not subject to tax. Okay. That is exempt under income tax law. Next one. You are having some 16% shares in the private company. Private company means a closely held company. So if any person has a 10% or more shareholding in a private company, that is in a closely held company, and if that company gives a loan to you, then that becomes deemed dividend. But the deemed dividend cannot be more than the accumulated reserve. Therefore, the loan is 2 lakhs and the accumulated reserve is 5 lakh. Therefore, the deemed dividend will be only 2 lakh under 222E. Okay. Next is a very important adjustment. Once again, the company has purchased a new motor car. See the date. Focus on date. On 23rd of August 2019. So if anybody has purchased a motor car between 23rd of August 2019 to 31st March 2020 and put to use the vehicle in that period, then that person is eligible for 15% extra depreciation. So you will be eligible for 15% extra. It means in the current year. In the current year, on 12,80,000 WDV, you are going to get depreciation of 30% instead of 15%. Be very careful. Okay. Now, this depreciation is not taken in the above calculation. So you have to reduce that much depreciation from your P&L. Next one is a question on 80JJAA. Now, 80JJAA is applicable if the strength of the employee increases as compared to the last year. Now, in the last year, the employees were 480. In the current year, the employees are 530. Is the strength increased? Yes, it is increased. Because the strength is increased, you are eligible for 80JJAA. Otherwise, you would have not got 80JJAA. Now, how many additional employees you have hired? You have hired 120 additional employees. For how many months? For 9 months. And you are paying 15,000 rupees emolument to them. That is all fine. Up to 25,000 it is allowed. And that will be subject to 30% what? 30% deduction. Okay. Now, one last thing which is given over here, the tax rate of the company will become 30%. Why? Because the turnover of last year is exceeding 400 crore. Therefore, the tax rate will come to how much? 30%. Will it be subject to surcharge? No surcharge, etc. will not be applied because the total income is less than what? 50 lakh rupees. Check it, please. Sorry, not 50 lakhs, 1 crore. For a company, the surcharge limit is 1 crore. So now let's move on to the next question. The question number 2, in this there are 2 parts. The first part is absolutely same as what we have done earlier in MTP. You can check it. This is the same question we have done earlier. So I am not repeating the same question once again. It is same with the amounts also. The amounts are also same. Everything is same. You can check over there in the MTP. Okay. Now the second question is a very, very, very intelligent and a different kind of question which has been asked by ICI in this particular paper. Now let me tell you what exactly is there in this particular question. First of all, there is a company Veonia Inc. which is there in Japan. It's a non-resident. It's a foreign company which is also non non-resident. How you can say non-resident, sir? It is incorporated outside India. Is it not a resident because of poem also? No, it is not resident because of poem also. They are holding some meetings in India, no doubt. But those meetings are not in relation to what day-to-day business and management. It is not in relation to your control and management in India. It is in relation to the sale of some part of the company in India. Now, the sale of some part of the company in India does not amount to poem. It does not amount to what? The control of actual business or management in India. Okay. And on behalf of that, we have seen that in particular thing in the circular of poem, that if a company is engaged in sale of asset or amalgamation or demerger, then that does not amount to what? That does not amount to what? A poem. It is not something where you are taking key management and commercial decisions. It is a decision in respect of what? Sale of the business, which cannot be called as key management and commercial decisions for your day-to-day business. Therefore, the company is a non-resident, that is for sure. Now, you have to answer the entire question based on non-resident. Now, be very careful. Every part is very important, especially the first two parts are absolutely important. Now, this is the foreign company, Vioni INC. Now, this Vioni INC is earning some dividend from another foreign company. So, one foreign company is giving dividend to another foreign company, and the second foreign company which is giving the dividend is having 70% of its total assets in India. No doubt, 70% of its total assets in India. Therefore, the shares of Miami INC derive its value substantially from the asset located in India. Now, this entire provision, this entire question is based on what? Vodafone case law. So, this company, Miami INC, is deriving its value substantially from asset located in India. So, will the dividend be taxable in the hands of Vioni INC? No. That Vodafone case law amendment came only for capital gain taxation. It did not came for dividend taxation. Do you remember that? If CGP gives dividend to what? To HTIL, then that dividend is not taxable. It is exempt as per a CBDT circular which was issued in 2015, and therefore this dividend will also be what? Exempt. Second question, this Vioni INC is giving some technical services to the government of India, and government of India is making the payment, but government of India is using that technical services not in India but in Nepal. Will that technical services be taxable in India? The answer is yes. Now you will have a doubt, sir, how it can be taxable? The Vioni INC is giving us services and the government is using that services not in India. They are using outside India. It doesn't matter. The services should be used in India. It should not be used outside India. That logic is applicable for resident payers. It is not applicable for government. So in case of government, if a technical service is taken or royalties taken or money is borrowed, and if it is used outside India also, 915, 916 and 917 is applicable in case of a government. Therefore, here the income will be taxable in the hands of what? In the hands of the foreign company. Okay. Next. This is a very simple one. There is a unit located in IFSC who has taken some loan from Vioni INC, and IFSC unit is making the payment of the low interest to the Vioni INC. Now, this interest is exempt under section 1015 on or after 1st September 2019. Okay. You can check the provisions of 1155. We have written below that if an IFSC unit pays interest to a foreign company or non-resident, then that is exempt. And the last one is a very simple one, that is based on grandfathering, that you can go. We have done a lot of questions on grandfathering. Whenever the date 31st Jan 2018 will come now, it means there is a question on what? Grandfathering. You have to compute your cost of acquisition accordingly. Okay. And compute capital gains under 112A. Now, in this question, you are only supposed to compute the total income, that's it. You are not supposed to compute any tax liability. The next question is based on a charitable trust. There is a charitable trust which is registered under 12AB and it follows accrual system. Now, whichever system it wants to follow, let him follow. But the payment, the deduction will be allowed only on payment basis from Finance Act 2022. Do you remember that? There is an amendment made by Finance Act 2022 which says that the deduction of application will be allowed only on payment basis, not on accrual basis. Okay, you can book your revenue on accrual basis. There is no harm in that, but the deduction will be allowed on what? Payment basis. Otherwise, it will not be allowed. So let's compute the income statement. How they compute the income? First, all the incomes less 15% exemption, then all the application, then total income will come, and then we'll apply the tax. Okay. Now, the very first thing over here is 24,41,000. You have received some money from students, so you put that particular thing in your income statement. The second thing is you are receiving some donations. Now, in that donation, 1,85,000 is voluntary anonymous donation. So, for anonymous donation, section 115 BBC will be applicable. Separate treatment will be done. 3,35,000 is a normal donation. You can add to your income statement. Now, for anonymous donation, what will happen? 1,85,000 is your anonymous donation. You will get exemption under 115 BBC at the rate of 1 lakh or 5% of donation, whichever is higher. Therefore, higher is coming to 1 lakh. Therefore, 85,000 will be taxable at 30%. Okay. Now, what about this donation which is exempt? I have told you in the class also. This donation which is exempt now, that is not going to be 100% exempt. That you have to add in the normal income statement. So, I am adding that donation in the normal income statement, and then I am claiming 15% exemption, and then I can apply that money and take further exemption. But the donation which is taxable at 30%, it is subject to flat 30% taxation. It is not subject to any deductions under the income tax law. So, you have to make two bifurcation of that 1,85,000. Whatever is a taxable donation, that will be subject to 30% tax, and what is the exempt donation, you have to add to the income account statement above 15%. Okay, and then you can claim 15% exemption on that. Next one is you have received some dividend from Indian companies. Yes, you have to add that to the income statement and then take 15%. Then 2,85,000 income from mutual fund, add to the income statement and take 15%. Agriculture income is exempt for even trust. Section 10(1) is exempt for trust. Okay, don't worry. Now the trust is accumulating some money for the next 4 years. Yes, you can claim exemption under section 11 subsection 2. The trust is making payment to one of the trustees as rent. Okay. You can make the payment to trustees as rent. There is no harm in that. But don't pay excess. So you're not paying excess. In fact, you're paying less only. The fair market value is 2,50,000. You are paying only 147. So it's all fine. So 147 you can claim as a deduction. Okay. Then you're making payment to some teachers. Okay. So that will also be allowed as deduction. Then other expenses are there. That also can be claimed as deduction. But assume that other expenses are paid because it is not mentioned whether it is paid or accrued. If it is not paid, then it is not allowed from Finance Act 2022. You have to pay that other expense. Okay. Now, once you do this, you will get the total income as 9,54,000. Now you have to make two bifurcation of that. Out of 9,54,000, 85,000 will be subject to 30% tax and the balance amount 869,850. So 954 2 bifurcation, 85,000 30% tax, balance 869,850 will be subject to slab rate. You apply the slab rate and then you apply 30% on 85,000, then you apply 4% cess and then you will get what? You will get the amount of tax over here. Okay. Now coming to the next question. Next question is a very routine question of DTAA. I am not much interested in that. There are a few important points which I would like to address you all. The assessee is a resident. Assessee is 65-year-old and therefore the assessee would be subject to what? The assessee will be subject to what? Will be subject to 80 TTB benefit under the income tax law of 50,000 rupees. That is the only important thing which I would like to tell you in this question. Apart from that, it's a routine question. You can check it. Now, the next question is based on TDS, where we have to find out whether TDS will be deducted or not. The first question is, there is one company, Maxell Limited, who is engaged in business. They are making some payment to what? As a bank guarantee to a bank. Now, whenever a payment is made to a bank guarantee, commission to a bank, TDS is not deducted. There is one CBT circular on that, which says that whenever you make a payment to the bank as a bank guarantee, TDS will not be deducted. You can check the circular if you want below. Okay. Next one. There is one trust by the name called as Study Card, who has paid 98,000 rupees to a non-resident, Mr. Monty, for web-based lecture. Now, whether I should deduct TDS or not. Now, TDS will be deducted under 195 if it is deducted. Now, whether I should deduct or not. Now, there are two views which are taken by ICI. First of all, the web-based lecture which they are providing to us, if it is accrued in India, if it is a normal business, okay. If it is, listen carefully, it's a very important question over here. The web-based lecture which is provided by Mr. Monty, a non-resident, if it is a normal business, then it is not accrued in India. Why? Because for normal business, if it wants to accrue in India, there has to be a permanent establishment or a business connection, which is not there. And if it is not accrued, then the payment made to them of 98,000 will not be subject to TDS. Now, the second view which is taken by ICI. Suppose the web-based lecture which is provided by the non-resident, suppose it is in the form of FTS, fees for technical service. Now, for fees for technical service to accrue, there is no need to have any business connection or place of business or permanent establishment in India. It is accrued just because it is utilized in India. So in that case, it is accrued. And if it is accrued, you are supposed to deduct TDS under section 195. You can write both the views. You can write either of the view, whatever you want to. Okay. Now there is one person, Mr. Nitin, who is an individual, whose last year's turnover is less than 1 crore rupees. Therefore, 194C will not be applicable to him. Okay. But he has paid 65 lakhs to repair his office. Therefore, to a resident. He is making the payment to a resident. So 194C cannot be applicable because for 194C to be made applicable to an individual and HUF, last year turnover has to be greater than 1 crore rupees. Okay. Now that is not happening. So 194M will apply because the payment is made to resident and it is more than 50 lakhs. Therefore, 194M will apply 65 lakhs into 5%. Okay. Next question. You are making some payment to Airport Authority of India. You are an airline company. You are making some payment to Airport Authority of India in the form of landing and parking charges. So whatever payment you make to Airport Authority of India in the form of landing and parking charges will be subject to TDS under 194C and not 194I. It is not 194I, 194C. It is said by Supreme Court in the case of Japan Airlines in 2015. Therefore, this will be subject to 2%. Why? Because the Airport Authority of India is a company actually. It's not individual or HUF. Therefore, you will deduct 2% TDS over here. Okay. Now the next question is very important. I am myself saying it's very important because we have done this question a lot of times. We have done this question at least twice in the RTPs and mock tests. So I'm not repeating this question, but it is an important question. They have been asking this question again and again. It's an important one, but we have done it earlier. So that is the reason I'm not doing it once again. Okay. Question number 5, I'm going to question number 5, which is based on case laws. The first case law is something which we have done at least 2 times earlier, which is of Lakshman Das Khandelwal. What is this case law all about? Do you remember that? That 292BB cannot be attracted if the notice is not issued by the department. For 292BB to attract, the notice has to be issued by the department. Without issue of notice, 292BB cannot be attracted. Check. That is the case law which is mentioned over here. Now the next case law is High Court has passed some order and now High Court has made some mistake in the order. Now can High Court recall its own order and rectify the apparent mistake? Why not? Definitely High Court can recall its order, rectify its apparent mistake in some circumstances that you can go through in the solution. I don't have that much time to speak about each and every circumstance over here. Anyways, it's not a very important case law. Once upon a time it had to ask and they have asked. Moral of the story is very simple. If the High Court wants to rectify its apparent mistake, they can recall the order and it can rectify the apparent mistake in some circumstances. Okay. Next one is a very important case law which we have done it in class a lot of time. I have said you this a lot of time, that when you sell a asset from block, when you sell a block of asset, the gain is always short term, but the asset may be short term, may be long term. Asset is not always short term. Therefore, there is a building which is purchased by SSC in 2009, which is a business building, and the SSC is selling that building in 2019. Okay, in 2019 they are selling the building. So after 10 years they are selling the building. Therefore, the building is long term. Now the gain will always be long term. The gain will always be short term because the building is a part of block. Whether the SSC can claim 54 EC? Yes, 54 EC says that the asset should be long term. The gain should be long term. It is not said by 54 EC. The gain can be short term. The gain can be long term. 54 EC is not interested in that. 54 EC is only interested in the nature of asset. If the asset is long term, 54 EC is available. The gain is short term, it doesn't matter. 54 EC can be claimed in this particular case. Okay. Next one is a question on cooperative society. There is a cooperative society who is giving credit to its members. Therefore, it is eligible for ATP deductions. It is a deduction. It is not an exemption. Be very careful. First of all, it is making some deposit to other cooperative society, that is eligible for deduction under ATP. If a cooperative society gives loan to other cooperative society and earns interest, that is deductible under ATP. So you can claim this deduction under ATP. Next, if a cooperative society is receiving some interest from members, then that is also eligible for deduction under ATP. Next, the cooperative society is receiving rent. So rent of 36,000 into 12 minus what, 30% deduction, it is taxable. That is not exempt. Okay. Now, income from agency business, that is also taxable, that is not exempt. Against the agency business, you can claim an expense of 1,24,000. You can check over here. Next, the cooperative society is also earning interest received from deposit of idle fund members. Yes, this 2,04,000 will also be eligible for what? Eligible because it is also by giving idle funds to members, they are earning some interest. That is also subject to ATP deduction. And last but not least, you can claim what? 98,000 rupees loss deduction at the end of the calculation. You can claim that. What is the tax payable? You have to compute tax as per the general provisions. Plus, apart from that, the cooperative society will also get 50,000 rupees standard deduction. Why? Because the cooperative society is a normal cooperative society. If this cooperative society would have been a consumer cooperative society, then they would have got deduction of 1 lakh. But this is a normal cooperative society, therefore they will get deduction of 50,000 rupees. You will compute tax as per the normal provision, not as per 115 BAD. I don't know why institute has not computed tax as per 115 BAD. They have computed only as per the normal provision. Okay, maybe at that time when this question was asked, at that time 115 BAD was not there. But you compute as per normal provision. Now, what is the normal tax rate for cooperative society? Up to total income 10,000, 10%. Above 10,000, up to 20,000, 20%. Above 20,000, it is 30%. When surcharge will be imposed, if the income is more than 1 crore and up to 10 crore, surcharge is 7%. And if the income is more than 10 crore, surcharge will be 12%. Okay, just like a domestic company. You can check it, please. So this is what this question is all about. Now, one last question is over here. Let's go to that question also. And that is question number 6 in this paper. Then we'll move on to the next paper. There was an assessee who received a draft order from the assessing officer as per 144C. 144C is what? 144C is applicable to eligible assessees who are either foreign companies or non-resident, or in whose case TPO has passed a prejudicial order. So in that case, the assessing officer has to give a draft order. After that draft order is received, the assessee has two options: either to accept the draft order or to object the draft order to the dispute resolution panel. Now the assessee does not want to object. Assessee is saying that I don't want to object. I want to directly appeal to the CIT appeal later on. He can do so. Nobody can stop him. So that's what the question is. The assessee does not want to object to DRP. It wants to directly appeal to CIT appeal. Can he do so? Yes. Nobody can stop him. Whenever the whenever the AO's draft order will come, accept that order. The AO will pass the final order, take the final assessment order, and then you can appeal to CIT appeal within 30 days. Okay, that is allowed. There is no harm in that. Next one is a theory question. The assessing officer has initiated a penalty proceeding under 270A. The assessing officer has also launched prosecution against the assessee. The assessing officer has done both the things. Now, the assessee wants immunity from this. Now, what are the conditions? He has to follow a few things. Then his penalty will be immuned and his prosecution will be immuned under 270AA. What are the things that he is supposed to do? The very first thing that he is supposed to do, he has to make an application to the assessing officer within 1 month from the end of the month in which the order is received. He has to make an application. Then within 30 days of the receipt of notice of demand, he has to pay tax and interest. Okay. And then the third thing which he has to do, he should not appeal against the assessment order. He should not appeal against the assessment order. If he does these three things, his penalty will be, his penalty may be immuned by the assessing officer under 270AA. Okay. One more thing that he has to do, he has to keep it in mind that only the 50% penalty will be immune over here. 200% penalty is not immune over here. That is only a case of normal under-reporting penalty is immune. Misreporting cases are not immune over here. Check it, please. Next question is exactly similar to what we have done earlier also. We have done this question a lot of times here, but still once more I will tell you this question for the very last time. After this it comes, I am not going to be speaking on that. Identica Limited is an Indian company and Horizon Russia is a foreign company, and both of them are associate enterprise. How they are associate enterprise? Because one holds 35% in another. On that note, both of them are associate enterprise. Now the Identica is giving some services to what? Horizon. The total cost is 2,25,000. This is step 1. Now what is the GP margin to the third party? This is the question on cost plus method. In cost plus method, what are you supposed to find out? What is the cost which is in case of service which is given to associate enterprise? That is step 1. The cost in case of service given to associate enterprise is 2,25,000 rupees. Second step is you have to find out the arm's length GP. What is the GP margin on cost which is given to third party? And that is 50%, which is given in the question. And now you have to adjust the margin. Okay, now for that you need to find out the functional differences. There are 4 functional differences over here which has been asking again and again by the IC here. The first one is when Identica gives services to Horizon, Horizon also give us some services. So if I give you some services and you also give me some services, then I should charge you more profit or less profit? I am giving you some services, you are also giving me some services free of cost, then I should charge you more profit or less profit? I should charge you less profit now. Therefore, how much is the service which you are providing to me? It is normal 18% of normal GP. 18% of normal GP will come to 9%. Therefore, I should charge you 9% less now. Therefore, I should reduce 9% from 50%. Okay. Second, I am providing you services. That is, I am providing services to Horizon and I am giving you discount. But to third party, I am not giving discount. So if I am giving you discount, associated enterprise, I am giving discount, and the charge and the profits have to be lower now. Accordingly, how much lower it has to be? It is 10% of normal GP. 10% of normal GP is 5%. So there again, I have to reduce 5%. The third one is when I give you services, there is no risk. There is no risk. So if when I give you services, there is no risk. When I give the services to a third party, there is a lot of risk. So when I give the services to third party, there is a lot of risk. The profit has to be higher there. And in your case, there is no risk. The profit has to be lower. So that much I have to reduce again. Therefore, again, here it is how much? 12% of normal GP. 12% of normal GP will come to 6%. So the first, second, and third point will be reduced from 50%. And the fourth point is what? I give you 1 month credit. I give credit to Horizon. That credit I don't give to my third party. Now, if I give credit to associate enterprise, I should charge less price or more price? I should charge more price. So here you are not going to reduce, you are going to add back. Okay. So here you are going to add back 2% of normal GP. 2% normal GP come to 1%. Now, if I do all these things, three reductions, 1 addition, the arm's length GP comes to 31%. And therefore, this 31% will be added to the cost of the asset, and then you will get the arm's length price of your calculation, and then accordingly you can find the differential amount, how much was actual price and how much is your arm's length GP. Arm's length price, differential amount has to be added back to your income. Okay. So let's go through it, and then we'll move on with the next question. So let's move on to the next paper, that is July 2021. The very first question over here again would be obviously on total income. We have to suppose to compute total income, ignore MAT, ignore 115 BAA. Okay. So let's see one by one all the adjustments. The assessee is a manufacturer, so accordingly you can have some special provisions applicable in your case. First of all, add depreciation. Second one is you are giving some donation to a research institution, scientific research. It is allowed as a deduction under section 35(11), 50 lakhs. So it is already debited. It is already debited. So ignore that. And one very important note is given in the last line, which says that the approval of the research institution was withdrawn after you gave the donation. So will it affect your donation? The answer is no. Suppose if I give you donation today, today you are approved, and if tomorrow your approval is withdrawn, my donation will not be denied. It will be allowed to you. Don't worry about it. Okay. Next one is a very important adjustment whereby you have taken a loan from a financial institution, that is NBFC, on 1st of May 2022. Therefore, your total interest on 350 lakhs will come to 350 lakhs into 8% for 11 months. That will come to 25.67. Now, out of this loan, the some portion was used for what? Machinery. Some portion was used for machinery. Okay. Now, not some portion, in fact, entire portion was used for machinery only. Now, machinery was put to use on 1st of Feb. So, on 1st of Feb, you have put the machinery on use. You can see over here. So from May till 31st Jan, whatever interest is that, you have to capitalize that much interest. So 25.67, you have for 9 months interest, you have to capitalize. 9 months interest will come to how much? 21 crore. You have to capitalize. What about the remaining one? The remaining one should be allowed as a revenue expenditure, but that will also not be allowed. Why? Because that is also not paid. That is outstanding, and it will not be allowed because section 43B will disallow that particular expenditure. So what is the ultimate treatment? 25.67. What is the ultimate treatment of that? 21 crore will be capitalized to the cost of asset and 4.6 crore will be disallowed. Entire 25.6 crore, 67 will not be allowed as a revenue expenditure to you. 21 crore will be capitalized and 4.67 will be considered as what? As your disallowance because of 43B. Next, you have paid some salary of 100 lakhs to foreign technicians for installation of machinery. Now, this is also should be added to the actual cost of the asset. So, add this 100 crore to the cost of asset. Next, you are incurring some 35 lakhs rupees on general expenses to bring water in your factory. That is allowed. That is a normal revenue expenditure. There is nothing wrong in that. Next, you're giving donation of 10 lakhs to a political party. So first add back in PGBP and then you can take the deduction in 80 GGB subject to a condition that the payment was not made in cash. If the payment is made in cash, then it is not allowed. They have not given the whether the payment is made in cash or whether the payment is made in kind. They have not given that. Okay. Next one is a very important adjustment. You have purchased some 25 lakh rupees coal in your business, but you don't have invoice for that. You don't have an invoice for the purchase of the coal, but you have some indirect evidences. Like you have indirect evidences like goods invert report. You also have the payment details. Auditor has also given an adverse remark against you that this is for this particular transaction invoice is not there. Now there are two views which are possible. If you can satisfy to the assessing officer will give you the deduction. If you cannot satisfy to the assessing officer will not give you the deduction. Both the answers are correct over here. Okay. Next is also very important and tricky adjustment. You have made a sale of 20 lakh rupees to a person. Okay. Now after 1 or 2 years, you have write off out of that 20 lakhs 10 lakhs. So now the remaining amount receivable is only 10 lakhs. Okay, 10 lakh is receivable. Now that other person from whom 10 lakh is receivable now, because 10 lakh is already written off. Now from whom 10 lakh is receivable, that person is died. He expired. Now we could only collect 7 lakh from him through final settlement. Okay. So, and remaining 3 lakh is now absolutely bad debts. Now, what should I do? Now, this 10 lakh is already credited to the PNL. Okay. So, you have again credited that to PNL. This 7 lakh which is recovered now, you have again credited that to PNL. Now, when you sold the goods of 20 lakh rupees, have you credited 20 lakhs to the PNL? Yes. After that, 10 lakhs become bad debts. So, 10 lakhs you took the deduction. But still, the other 10 lakh is credited to the PNL. Now, you have paid tax on that. Now, if you are recovering something out of that 10 lakhs, you cannot again credit that to PNL. Now. So, you have credited that again to the PNL. So, first remove this 7 lakhs because it is already included in the sale earlier. And then remaining 3 lakh, which is absolutely not possible to recover because 7 lakh is final settlement. So remaining 3 lakh you can claim as a bad debts. Okay. Now there are some opening WDVs which are given. You have to claim depreciation on that. Factory building 10%, computer 40%, office appliances 15%, tractors very important. These tractors are used within the factory. Be very careful. It will be useful to us in some time. 20 lakhs. This will be 15%. Okay. And plant and machinery 800 lakhs. Now there are some assets which are purchased during the year. Now you have to see whether it is used for more than 180 days or less than 180 days. Factory building 1st November. So only half 50%. Computer on 1st May, full 40%. Tractor, be very careful. There are 2 tractors which you are purchasing. One is purchased on August, so you will get full 15% depreciation. Another is purchased in February, so you will get half depreciation, that is 7.5. Plus, you will also get additional depreciation on these tractors. Why? Because these tractors are used in factory. Do you remember that I have told you? Forklift trucks, special cars, special vehicles which are used especially inside the factory will be eligible for deduction of additional depreciation. So it is eligible for depreciation. Okay. Next, this plant and machinery 500 lakhs. On that 100 lakhs installation cost will be added back, and 21 lakhs you have to add back what? The interest cost. Therefore, the actual cost of this plant and machinery will be 621 lakhs. On this 621 lakhs, you are going to compute what? 15%, 7.5% because it is used for less than 180 days, 7.5% normal depreciation, and 10% additional depreciation will also be allowed on this particular thing. Okay. Then you are incurring some expenses on ISO certificate 10 lakhs. Now, this is not an asset as per the income tax law. As per ICDS, it might be as per the Ind AS, it might be an asset. But as per the income tax law, it is not an asset, and therefore this payment wage for ISO certificate acquiring of ISO certificate, because to tell the quality of the product, you have to make some payment to the ISO people, and therefore whatever payment you have made, that will be allowed as what? As a revenue expenditure. You can claim deduction on that. Check it please, and then we'll move on with the next question. We don't have to compute the tax liability over here. So let's go on to the next question. The first question, the very first question over here is based on some amendments now which are made by say Finance Act 2022 under section 170 and 170A. So accordingly, you have to go to that amendment and solve this question. This question as of now is not much relevant to us. Okay, let's move on to the second part of this question. In the second part of this question, a lot of things are happening. There is an assessee, Messrs. A and Company, a partnership firm, who has filed the return, and his return is selected for scrutiny. Okay, now there are 2 disallowances which are made by the assessing officer. First, he has added 50 lakhs as bad debts. Why? Because the assessee was not able to prove that the debt has become bad. So is the contention of the assessing officer correct? The answer is no, no, no. Why? Because the assessee is not supposed to prove that the debt has become bad. If he wants to claim deduction under section 3617, he has to do only one thing. That is, he has to write off that debt in the books of accounts. If he write off that debt in the books of accounts, that's it. Nobody can stop him to claim the deduction. It is not necessary to establish the fact that the debt has become bad. You don't have to prove it to anyone. Okay. Therefore, the assessing officer is wrong. The second disallowance which he has made, that he has made disallowances of repairs and maintenance which were booked on an estimate. So the assessing officer is saying that I am adding back 75 lakhs because I am feeling that this repairs and maintenance are on estimated basis. Now again, there are 2 views taken by ICI over here. Yeah, that is, if the assessee can explain to the assessing officer that this repairs is a current repair. If it is a current repair, then it is allowed. If he is not able to satisfy the assessing officer that it is a current repair, then it will not be allowed. It is as simple as that. Now the third contention which is there is one more company, Messrs. B and Company, which is a partner of A and Company, and therefore AN company is a partnership firm in which there is another partner BN company. So the question over here is, the AO said that the partnership firm cannot become a partner in another partnership firm, and therefore I am treating this partnership firm as an AOP and not as a partnership firm, because in this partnership firm there is another partner. Therefore, the joint venture of both of them cannot be called as a partnership firm. The joint venture of both of them should be called as what? As an AOP, and the answer is correct. Partnership firm is not a legal person in India. It does not have a legal identity. Therefore, a partnership firm having a partnership in another partnership firm cannot be called, joint venture cannot be called as a partnership firm. It will be called as an AOP, and therefore the AO is correct in justifying that the associate is not a partnership firm but an association of person. Now the next question is one of the most beautiful questions of this entire booklet. A beautiful question. There are so many provisions which are asked in this particular question, which I will try to address you all one by one here now. So pay attention, please. The very first thing is Mr. Ram is a citizen of USA and he resides in some San Jose, etc., etc., etc. Pay absolute attention, please. It's a beautiful question. Now he is a non-resident since 2006-2007. Now he works in a foreign company. Now in 2022 he came to India. The very first thing which you are supposed to do is please change this date to 2022 and the last date to 2023. And here also you have to change this date to 2022 to 2023. Okay, this will become 22. This will become 23. In short, moral of the story: change all the dates as per the current year. Okay. Now who is this associate? This associate is a non-resident until last year. Now in the current year, that is on Jan 10, 2022, he came to India and he was there in India till 31st of Jan 2023. It means he is there in India for how many days? If you count, he is there in India for 306 days. Okay. From 1st April till 31st Jan, if you count, there are 306 days. So is he resident? The answer is yes. The very first thing which we have got it, he is a resident. The second thing, is he ordinary or not ordinary? He is not ordinary because he was non-resident till he was non-resident since 2006-7. He has come to India after a lot of time. After a lot of time in 2022, he came to India. Therefore, the possibility of fulfilling the two additional condition is impossible. That is 730 days in the last 7 years, two times resident out of last 10 years. That is impossible over here. Therefore, I have got his residential status first thing. He is a resident, but not ordinary resident. Now, in case of resident and not ordinary resident, when the income is taxable in India, either the income has to be accrued in India or the income has to be received in India. In case of PGBP, even if it is accrued outside India, but it is controlled from India, then also it is taxable. But in this question, PGBP is not there. In this question, PGBP income is not there. So talk about normal income. Normal income like salary, interest, etc. It is taxable in India for NOR only if it is accrued in India, if it is received in India. Now, he is in India from when? From Jan till next Jan, he is in India. Let's talk about the current year. In the current year, he is in India from April till what? From April till Jan, he is in India. So they have given us the salary to us. So is that salary taxable in India? That salary is taxable in India because he has services, he has rendered services in India. Check it, please. He has come to India for work from home in India. So if an NOR is coming to India, he is working from India, so he is rendering services in India, so he will be liable to tax in India. Okay, definitely he has to pay tax in India. This is the first thing which you have to keep it in your mind. Now be very careful. Be very careful. Be very careful. There are a lot of things in that. Sir, will he not get exemption under section 6.1? Sir, we have learned under section 10.6. Under section 10.6, we have learned one exemption, sir. What exemption you have learned in section 10.6? That if a non-resident who is if a person who is not a citizen of India, if a person who is not a citizen of India, who is employed by a foreign enterprise, and if he comes to India, then his remuneration will be exempt. Will he not get this exemption? No, no, no. He will not get this exemption because there is one condition over there. The condition is the stay in India should not exceed 90 days. And he is staying in India for how many days? He is staying in India for more than 90 days. He is staying in India for 306 days. Therefore, he will not be eligible for that exemption. Forget about that exemption. Okay. He will be liable to tax. Now, how to compute that? You have to convert all the salary into what? Rupees. Now, how to convert that? To convert that, you have to apply Rule 115. As per Rule 115, the rupees, as per Rule 115, the salary income is converted as per the TTBR of the preceding month. What is the TTBR of the preceding month? So for April, you have to take the TTBR of the preceding month. Now, luckily, the TTBR of the preceding month is given over here and it is same for every month. So luckily, it is very simple for us. 6250 into how many months? From April to Jan, 10 months into 72, we'll get the salary. Okay. So once we get the salary, we'll take what? We will not take the standard deduction because the assessee is opting for what? 115 BSc. So 10 months into 6250 into TTBR, which is given in the last column. So once we'll get this, we'll get the salary. Okay. Will not get the standard deduction because he is opting for 115 BSc. Now he is earning one more income. One more income which he is earning over here is fixed deposit in US. Now because this fixed deposit is in US, it is accrued outside India. It is received also outside India. Therefore, that will not be taxable in India for NOR. For NOR, only income which is accrued in India or which is received in India are taxable. Therefore, this income will not be taxable for him. Then you compute the tax as per 115 BSE, and then you will get the tax as 11,31,000. Now, we have to give him what? FTC. FTC is how much of FTC is available in India? In India, FTC available is very simple. You get the FTC as tax paid in India or tax paid in foreign country, whichever is lower. Whatever is lower, that will be allowed as FTC. For FTC, we have to read Article 2 of DTAA. The taxes covered for the federal taxes imposed by the Internal Revenue Code. Internal Revenue Code is the law of US, but excluding Social Security tax. You are not supposed to take the Social Security tax in that. Now, here also we have to make two assumptions that these taxes which are there, it is excluding Social Security tax. One assumption is this. Second assumption is this. These taxes are including Social Security tax. If it is including Social Security tax now, then out of this 1600, you have to remove this 420. 420 you have to remove. So that is what you are supposed to do over here. So there are two assumptions which we are making over here. First assumption we are making over here is that this 1600 is what? This 1600 is excluding what? Is excluding the Social Security tax. Therefore, 1600 into 10 into 72, this will come to 1131. And if this is 1131, this will not come to, just wait. This will come to, 1152. And if this comes to 1152, the tax payable in foreign country is 1152. The tax payable in India is 1131. Therefore, whichever is lower is 1131. Therefore, entire tax will be exempt in India. You are not supposed to pay any tax. But there is one more assumption which is made by ICI. The another assumption which is made by ICI is that 1600 federal tax is including the Social Security tax. And on Social Security tax, you do not get what? Credit. Credit is not available on Social Security tax. Now, if credit is not available on Social Security tax, you have to remove that much. From 1600, remove 420, then multiply by 10 and into 72, that will come to 849. Therefore, you will get a credit of how much? 1131 or 849, whichever is lower. And therefore, you will get a credit of 849. And therefore, you have to pay tax of 281,400. But here, one more mistake you are doing. You are filing the return on 25th of August. It means you should have filed the return on 31st of July. 31st of July, you should have filed the return, but you are filing on 25th of August. Therefore, you have to pay interest at the rate of 1% if you follow second assumption. In case of first assumption, you don't have to follow any interest. But in case of second assumption, you have to pay interest at the rate of 1% under section 234A because you are delaying to file the return by 1 month. So this is what this great question is all about. If it comes, it will come in the same form in the next attempt. So be very careful. You do this question properly before the exam. In fact, I have said every aspect of this question beautifully to you all so that you understand each and everything properly. Okay. Now, the next question, question number 3A. There is an investment fund and this investment fund has 20 resident unit holders and 5 each unit holders holding 5 units. Now, out of that, 16 unit holders are holding units for more than 12 months and 4 unit holders are holding units for less than 12 months. So 16:4 ratio is how much? 80:20. It means I can say 80% of the unit holders are holding units for more than 12 months and I can say 20% of the unit holders are holding units for less than 12 months. You should understand the importance of more than 12 months and less than 12 months. Okay, there is some provision which is linked to this particular aspect. Now, the first income which is earned by business trust, investment fund is business income. Always remember, business income tax will be payable by fund only. In the hands of investor, it is exempt. Okay. Second, long-term capital loss. Long-term capital loss, tax is payable by the investor. But what if long-term capital gains, tax is payable by the investor, it is exempt in the hands of the fund. What about long-term capital loss? Long-term capital loss you can attribute to the investor to the extent if the investors are holding units for more than 12 months. Now, how many investors are holding units for more than 12 months? Only 80%. Therefore, out of this 30 lakhs, you can attribute 80% to the investors, which investors will carry forward and set off in subsequent years for 8 years because in the current year, anyways, there is no loss. There is no gain against that. The investors cannot set off because in the current year, there is no long-term capital gains. There has to be a long-term capital gains to set off a long-term capital loss. So, out of 30 lakh loss, you can attribute 80% to the investor. Why? Because the units are held by more than 12 months, you can attribute. Third one, income from other source. It is exempt in the hands of the fund. Fund will not pay tax on other source. Investor will pay tax on other source. Okay. Last line, they are asking one question. Will your answer change if the investment fund distributes only 80%? The answer will remain same. Why? Because in case of investment fund and in case of securitization trust, whether you distribute or whether you do not distribute, entire amount will be taxable in the hands of the investor. Out of the 40 lakh rupees income from other source, if I distribute only 80%, still I have to deduct TDS on entire 40 lakhs. Still entire 40 lakhs is taxable in the hands of the investors by logic of what? Deemed accrual. This logic is applicable for investment fund and for what? For securitization trust. But this logic is not applicable for business trust. For business trust, the amount is taxable in the hands of the recipient on receipt basis, not on accrual basis. So in case of business trust, if I distribute only 80% will be taxable in the hands of the other person, but not here. Okay. The next question is a very simple question. Now it has become simple. By default, it is not simple, but now it has become simple because we have done this question a lot of time. There is a non-resident foreign company. It is earning some dividend of 20%, dividend of 12,50,000. This will be taxable at 20% under 115A. Now it is also receiving some, it is that non-resident foreign company is giving some technical services to us, and we are paying them 20 lakh rupees by what? By giving them what? A debenture. We are not giving them money, but we are giving them debenture. Now this will be subject to what? This will be subject to 40% tax. Why, sir? Will it not be covered in 115A? It will not be covered in 115A because this is not, there is no agreement between the two, and the agreement is also not approved by central government. Therefore, this will be covered in normal provision. Apart from that, the non-resident is also earning now 8% interest on what? 20 lakh rupees. So that interest will also be subject to 40% tax. That interest will also cannot come under 115A because it is earned in foreign Indian currency, not in foreign currency. So therefore, there are two treatment over here. 20 lakh rupees is the consideration for FDS, which will be taxable at 40%, and the interest is the consideration for what? Debentures, which will also be taxable at 40%. Now, they are also earning some dividend on global depository receipts. These global depository receipts were purchased in foreign currency. Therefore, it will be subject to tax at the rate of 10% under 115AC. Business income will be taxed at 40%. Now, the last one is they are also earning some royalty. Now, this royalty, there is an agreement and it is approved by central government, and the DTAA say 10 for 12%, but the income tax rate says 10%. Therefore, now this will be taxable at what? 10%. Now, there are two important things to be kept in mind. Here, it will be taxable at 10%. Second thing, here, there are two things which you need to keep in mind. This amount is received by the assessee, and if this amount is received by the assessee, you have to gross up this because the amount received in your bank account is after TDS. This amount is also received by the assessee, and if it is received by the assessee, you have to gross up because the amount received in the bank account is after TDS. So here the TDS rate is how much? 10.4%. Here the tax rate is how much? It is again 10.4%. So at both the places, you have to divide by 89.6%. Check it, please. So let's go on to question number 4, which is based on tax deduction at source. Now, in the first part, there are two parts. There is an infrastructure debt fund in India which is making payment to a non-resident. So how much TDS it will deduct? Under 194LB, it will deduct TDS at the rate of 5% plus 4% says that is 2.5%. Okay. Now this same infrastructure debt fund is making payment to a person located in NJ. So if you make a payment to a person located in NJ, then the 194LB 5% will not be applicable. Then you are supposed to deduct TDS at the rate of 30% plus 4% says that will come to 31.2%. Okay. Now the next point is very simple. We have done 2-3 times earlier. Is TDS deductible on commission which is retained by the consignee, etc.? Yes, TDS is deductible on commission retained by the consignee. We have done that in the earlier mock test paper or RTP paper a lot of time. Okay. Now next one is Mr. Harsh, an employee. This is a new question. This has not come earlier. This is an employee who joined the company in 2019 and resigned in 2023. Now, because he is resigned before 5 years, he has left the company before 5 years. Whatever PF which he will withdraw will be subject to tax. Now, if the amount of that PF paid by the company to the employee is 50,000 or more, then the company will deduct TDS at the rate of 10% under section 192A because the amount withdrawn by the employee is 80,000 rupees, which is more than 50,000. Secondly, the employee is also leaving company within 5 years, therefore it is taxable, and therefore you are supposed to deduct TDS at the rate of 10% under 192A. Next one, Mr. Money has sold his flat and the other person is what? Purchasing, Mr. Money is purchasing some flat. The value of the flat is 48 lakhs. Okay. But does the consideration for TDS purpose, again it is asking about TDS. So does the consideration for TDS purpose only include the basic consideration? No. The money, Mr. Money has also paid some maintenance charges. That should also be included. 1,20,000, 24 months into 5,000 per month. So that will come to 1,20,000. He has also paid 2 lakh for car parking. That should also be included. He has also paid 1 lakh for club membership. That should also be included. So if I take the total, all these things are part of consideration because consideration is defined under section 194IA. You can go and check all these things are included in that. Now, if I include all these things, all of them are totaling more than 50 lakh rupees. And because it is more than 50 lakh rupees, I have to deduct. That is, the money has to deduct while purchasing the flat 1% TDS. If the stamp duty would have been higher, suppose if the stamp duty would have been 60 lakhs, then you would have deducted TDS also on 60 lakh rupees. Okay. Now, the next question is a very important question. I am myself saying it's a very important question, but it's a repetitive question. We have done this entire question, same to same question a lot of times, and therefore I'm not repeating. It's a very important question. So you have to go through this question at your end if you have time, but I'm not going through because I'm explaining everything from the perspective of what? Exam. Therefore, I'm not going through this question. Here, your paper is completed. This paper is completed. Then we'll move ahead with the next paper. Okay. So let's move on to the next paper, that is December 2021 attempt. Okay, there is the first question which is based on 115 BAB now. So accordingly, you have to think from the perspective of 115 BAB over here. Okay, and one important thing over here, the assessee is a manufacturer, he will not get additional depreciation. 115 BAB assessee does not get additional depreciation. Second important thing, the assessee is engaged in leather product, and if an assessee is engaged in leather, apparel or footwear, then the number of days of employment under 80 JJAA is only 150 days. It is not 240 days. So these are some of the important points which should click to your mind immediately immediately you see such words in your exams. Okay, now the assessee is in your state, that is in the state of Tamil Nadu. Okay, the profit of the company is 1 crore 20 lakh rupees. Let's start with the first adjustment. The opening stock and closing stocks are overvalued and undervalued by 10%. Now first of all, let's talk about opening stock. The opening stock is overvalued, it means it is 110%. So if the opening stock is overvalued, add back. Okay, and if the closing stock is undervalued, it means it is 90%. So you have to what, add back that also, because closing stock is undervalued. So you have to increase that much closing stock, it means you have to increase that much credit side, it means you have to increase that much profit in your books of accounts. Okay, next one, you are making some payment of 10 lakh rupees as commission to Mr. John, who is a non-resident. Now Mr. John has not given any services to you in India. He has done some services outside India, he has procured some order outside India, and you are making payment of commission to him. So in that case, Mr. John's income is not accrued in India. If his income is not accrued in India, you are not liable to deduct TDS, and in that case, if you have not deducted the TDS, the expenditure will be fully allowed, because the other person's income in section 195, when you deduct TDS, if the income of the other person is chargeable to tax in India. Now the income of Mr. John is not chargeable to tax in India, because he is not procuring orders in India, he is procuring orders outside India. Therefore, do not make any disallowance. Okay, next one, you are making 45,000 payment in cash to Mr. Rajan employee. You will say it is disallowed, but not disallowed. Why? Because this payment is in respect of retirement benefits. Whenever you make any payment of retirement benefits to your employees, you can make the payment in cash up to 50,000 rupees. That is given in rule 6DD. In rule 6DD, that is given. So be very careful with that. Okay, the next one is a very simple one. I'm not much interested in that. That is based on what, grandfathering. You can go through it once. Okay, the next one is point number 5. Because this grandfathering 112A 55 section 55, it has come a lot of time, that how to derive cost of acquisition in case of grandfathering. The next one is an important one. You are transferring some capital asset on which no depreciation is allowable. It means it is not a part of block of asset, it is a normal asset. So in case of normal asset which is not part of block of asset, the STCG will be chargeable under 115BAB at 22%. Be very careful, this will be chargeable at 22%. So reduce from PGBP and show under what? Show under capital gains, charge at 22%, because it is covered under 115BAB. Next one is also very simple. You are selling some plot of land to your subsidiary, etc. Then that is subject to what? 100% subsidiary, that is subject to exemption under section 47. So reduce from PGBP, show under what? Show under capital gains as exempt income. Next one is an important one, because you are receiving some dividends. You are receiving some dividend. If you are receiving some dividend, first of all, you have to remove from PGBP. Okay. Secondly, when you go to IFOS and show under IFOS, you have to gross up that dividend, because this is received amount. This is not earned amount. So you will gross up that dividend and you will show that dividend as 50,000 divided by 90%. That will come to 55,555. Next, you are making some payment for inauguration of a new branch, for expanding the business. Yes, that is allowed as a revenue expenditure. There is nothing wrong in that. Next, you are making some penalty to the government for failure to perform the contract on time, etc. So you are making the compensation for that. So this is allowed, because this is not a penal penalty. This is a compensatory penalty, and compensatory penalty is allowed as a deduction. Next, you are incurring some VRS expenditure of 5 lakhs. It will not be allowed in one shot. It will be allowed in 5 installment. So 1/5 will be allowed and 4/5 will be disallowed. It will be allowed in the subsequent years. Next, you are making some payment of 75,000 to bank. The person, there is one person there is one non-resident buyer who is outside India, who has given, this is a very intelligent point. There is a non-resident buyer who is outside India, who is giving you some deposit. You are using that deposit in India for manufacturing purpose, and you are paying that interest to the non-resident. This interest will be accrued in section 915. Therefore, you are liable to deduct TDS. Now you have not deducted the TDS. Therefore, this 75,000 will be disallowed. Very, very important point. If a non-resident gives you money and you use that money in India for the purpose of business, you are using that for the purpose of manufacturing, then the interest paid to the non-resident is accrued in India. You are supposed to deduct TDS. You have not deducted the TDS. That is your mistake. Therefore, this amount will be disallowed under the income tax law. Next one, very important point. A very, very debatable point, a question which has been asked by many students across the country to me. Now, finally, I am resolving that question. Now, this company has employed 56 additional employees. Out of this, now we have a breakup of that. Out of that, 39 employees were employed on 1st June at a salary of 15,000 rupees. So, but out of this 39 also, 9 employees were paid by what? Were paid by bearer checks. So, first of all, out of this 39, you have to remove this 9 employees. These 9 employees will not be subject to what? Deduction under 80JJAA. So, whatever is the salary of these 9 employees, that will not be allowed as deduction to you. But at the same time, because you are paying the salary of these 9 employees by bearer check, you should also disallow that particular expenditure under PGBP. Why you have not been doing that since so many papers, in so many mock tests and so many RTPs? They are not doing that so far. So now finally they are awake in December 2021 suggested answer. Now what are they doing? They are disallowing this 9 employees amount by bearer check. Okay, so whatever is the salary of the 9 employees, they are disallowing in what? PGBP. But they are also giving an alternate answer, that this information is given only for 80JJAA, and everything in the PGBP is done correctly. So if you take that assumption, then in that case, you don't have to disallow this 9 employees salary in PGBP. It means in that case, you have to do whatever you have been doing so far. But according to me, the first one is better. You disallow this 9 employees salary also in PGBP. That is more correct more correct treatment as compared to what? Ignoring that particular adjustment by saying that this is only given for the purpose of 80JJAA. That is wrong. Now, what about other employees? These 3 employees, these 14 employees were joined at an emolument of 45,700. They will not be eligible for the benefit. Why? Because the emolument is more than 25,000. These 3 employees will be eligible because these 3 employees are employed on 1st of November. So if you count from 1st of November till 31st of March, it is more than 150 days. To be precise, it is 151 days. And the assessee is engaged in which business? Leather business. So 150 days is sufficient. And therefore, for 3 employees, 5 months, 22,000 will be the salary. So take the total of 2 and then take 30%, you will get the deduction. Last but not least, the assessee has paid 1,20,000 to National Fund for Rural Development. Now this is available under 35 CCA. Now in normal provision, it is available under 35 CCA. But is it available under the provisions of 115 BAB also and BAA also? Yes, it is available under the provisions of 115 BAB also. 115 BAB does not allow 35 CCA, does not disallow 35 CCA. 115 BAB disallow what? It disallow 3511, 3514, it disallows what? 35 AD, but it does not disallow what? It does not disallow this particular item. So it is a very important point that this 1,20,000 allowed under 35 CCA will be allowed as deduction. Last but not least, you have to compute tax. The manufacturing income will be subject to tax at 15%. This dividend income will be subject, which you have to gross up first. This will be subject to 22% tax, and the short-term capital gains will also be subject to 22% tax. After that, you have to apply 10% surcharge and you will get your income tax. You can check it over here once if you want. So now let's move on to the next question, question number 2, which is based on amalgamation of companies. There is one company, Samay Impex Limited, which is an amalgamating company. Now this company is getting amalgamated with another company, Delhi Impex Limited. Now in case of amalgamation, what happens? Whatever the losses and whatever the UADs and capital expenditure of family planning, capital expenditure of scientific research, all these things can be carried forward by what? By the amalgamated company. But few losses are not allowed. Now we need to compute the total income of what? Delhi Impex Limited. Okay, so the profit of Delhi Impex Limited is 175. Okay, that I'm writing over here. Now the first thing, can I carry forward speculative loss? No, no, no. As per section 72A, it is very clearly written. You can carry forward non-speculative loss given under section 72 and unabsorbed depreciation. You cannot carry forward what? You cannot carry forward speculative loss. This will not be allowed. Unabsorbed depreciation is allowed to carry forward by the amalgamated company? Yes. Whether the unabsorbed expenditure of capital expenditure allowed? Yes, that is also allowed. Whether business loss is allowed? Yes, that business loss is allowed for another 8 years. In fact, that is a greater benefit over here. So you can take this benefit also. Okay. Now there is one mistake done by the company. What is the mistake? The company has transferred the asset at 160 lakh rupees to the amalgamated company. Now they have taken depreciation at 160 lakhs only. No, no, no. You are not supposed to take depreciation at 160 lakhs. Suppose in amalgamation, if I am amalgamated company, you are amalgamating company, and you are selling me assets for 160 lakhs. I am not supposed to claim depreciation at 160. I am supposed to claim depreciation at WDV. So whatever depreciation comes on 160 lakhs, that is the consideration, purchase consideration. That is 160 lakhs into 15%. That I will add back. Okay. And what is the WDV? WDV is 100 lakhs. And therefore on 100 lakhs, I will take 15% reduction. After doing all these things, I'll get my gain as what? I'll get my profit as what? 39 lakhs, which is subject to tax. That will be chargeable to tax. Okay. Now, the next question is a very simple question on section 45, subsection 5, which is on compulsory acquisition. There is an assessee who has purchased some land in 2003. In 2003, has purchased the land. And in 2019, the land was compulsorily acquired, but he got the compensation from the government in 2020. So, when the capital gains will be chargeable? Capital gains will be chargeable in 2020. That is the year in which the original compensation or the part of the compensation is received. But how will you compute the cost of acquisition? The cost of acquisition will be computed as 12 lakh rupees will be the cost multiplied by which year's indexation you will take? You will take indexation of 2019. Be very careful. 2019 indexation was what? 289 and divide by indexation of 209. And there is also 30,000 rupees transfer expenses. Why you will take indexation of 2019? Because you have to take indexation of the year in which the asset was transferred. So indexation of 2019 divided by indexation of 2003, that will come to plus 30,000 rupees. You have to also take expenses of transfer. You come with a loss of 12 lakh 11,000. Then in the next year, you also get 18 lakh rupees enhanced compensation. So that I'm writing over here. To earn that enhanced compensation, you have incurred an expense of what? 1 lakh rupees. So that you can take as a deduction. Legal expenses incurred to earn the enhanced compensation, that is allowed as an expenditure. Plus whatever loss is over here, you can claim that loss as a set off against your enhanced compensation capital gains. Okay. The next one is a very, very good question over here. Very beautiful question. This question is on transactional net margin method. You have to do this question before exam. It's a very, very good question, and this question has not come earlier. Now, there are two companies over here. One is Alpha Limited, which is in India, and Alpha INC, which is outside India. Okay. And if I compare both of them, the assets of Alpha Limited is 120 lakhs. And out of that, how much is given as a finance by Alpha INC? 82.5 lakhs. How I got 82.5 lakhs? $1,50,000 into what is the rate of the dollar into 55. I will get what? 82.5 lakhs. Now, if I take that this comes to 68.75%. It means my book value of assets, 68.75% is financed by Alpha and C. Therefore, both of them are deemed to be associated. Now, we are supposed to find out the arm's length price as per the transactional net margin method. Now, what happens in transactional net margin method? First of all, step 1. We are supposed to find out the net margin with the associate enterprise. While taking the net margin, numerator will be net profit, but the denominator will be either sales or cost. Now, what to take? What to take as a denominator? That I have told you. If you are doing export, it means if you are selling to someone, then take the denominator as cost. Or if you are purchasing from someone, then you take the denominator as sale. Now, in this question, what are we doing? We are selling. We are giving services. Therefore, I am taking the denominator as cost. Okay. So, first of all, you are supposed to find out the arm's length margin, that is net profit margin with associate entity. Now, with associate entity, what is my cost? The cost is 80 rupees over here. What is my profit margin? 85 is my billing and 80 rupees is the cost. The profit margin is 5 rupees. Therefore, with associate entity, my profit margin is 6.25%. Now, what is my profit margin with my uncontrolled transaction? With my controlled transaction, the profit is 100 rupees. So, I am taking 100 rupees in the numerator. And what is my cost in case of uncontrolled? Why I am taking cost in the denominator? Because denominator has to be untainted. And in case of sale, the cost will be untainted. And in case of purchase, the sale will be untainted. And in this question, what are we doing? We are selling. Therefore, the sale price will be tainted. Therefore, take in the denominator untainted item, that is cost. And in case of unrelated party, the cost is 500 plus 100, that is 600. You get the arm's length margin as 16.67%. Once you get that margin you will apply on what? On your cost. And therefore that you will get what? Your arm's length price. Okay. There's nothing great after that. You can do the question at your end after that. Okay. Most important thing over here was to compute the margin. That's it. Once you get that margin, then you will apply that margin on what? On your cost. So your cost is what? 80 into what? 30,000 hours into what? Into 55 rupees per, and then on that you will apply what? 16.67 margin. You will get your arm's length price. Okay. Now coming to the next question. The next question is on what? So this is on exit tax. Exit tax means accredited income. Now let's see. There are some important points over here. The very first thing is the trust was formed in 2006 and the trust got registered in 2010. Therefore, whatever activity trust would have done from 2006 to 2010 would be taxable, and on that activity accredited income cannot be charged. Be very careful. Accredited income cannot be charged on activity which is done before the trust was registered. Okay. Now we need to compute what? For accredited income, we need to compute the all the assets and all the liabilities as per Rule 17 CB. Now for land, what are we going to take? The total value, book value of the land is 12 lakhs and the market value of the land is what? Is 50 lakhs. So whichever is higher we are supposed to take. Generally we are supposed to take the stamp duty value or market value, whichever is higher. Your stamp duty value is not given, so take the market value only. So market value, how much should I take? I will take only 3/4 of the market value. Why? Because there is some very important adjustment. Now a lot of students have asked this doubt to me. I am clearing this doubt here itself. This doubt should not come to you henceforth. Okay. Now be very careful. There is one adjustment number 4, which says that land and building is acquired out of agriculture income. Now your land and building is costing 12 lakhs. Now you have taken a loan of 9 lakhs. Obviously, for to buy an asset of 12 lakhs, if you have taken a loan of 9 lakhs, it means the agriculture income is used only to the extent of 3 lakh rupees. Now, because out of 12 lakh asset, 9 lakh is loan only. Loan is not from agriculture income, that is from bank. Now, so out of the total asset of 12 lakh, only 3 lakh is bought from agriculture income. Therefore, only 1/4 of the land is bought from agriculture income. So, if any asset is bought from agriculture income, that should not form part of accredited income. It is very clearly written in the law in 115 TD. Therefore, 1/4 of the asset is bought from agriculture income. Therefore, out of 50 lakhs, I am not taking 1/4 of the asset. I am only taking 3/4 of the asset. I am taking 37.5. Please check it over there. Okay. Next, for equity shares, I am going to take the market value, and the market value is given is 18 lakh rupees. You can check it over here. For what? For land, I am taking 3750. For equity shares, I am taking market value, that is 18 lakh rupees. Now, for unquoted shares, you have to make some calculations. You have some equity investments in unquoted shares of Z Limited. Now, you have to compute the unquoted, you have to compute the value of the Z Limited, and then you have to find out how much stake you have in that particular company. Be very careful. Now, for that, you have to take the total book value of what? Z Limited. Total book value of the Z Limited is 60 lakh rupees. Then the market value of jewelry is 30 lakh rupees. And the liabilities, now you are computing the value of the shares of Z Limited first. Okay, because we need to find out how much value we have in that particular company. So 60 plus 30, 90. 90 minus 30 is how much? 35 lakhs. Minus 35, how much? It comes to 55 lakhs. Now, out of 55 lakhs, that is the total worth of Z Limited. How much we have in that company? See, we have investment of 1,50,000 and the total value of Z Limited is 10 lakh. Therefore, if the total value of the total equity capital of Z Limited is 10 lakh and we have 1,50,000 investment, it means we have 15% investment in that. And therefore, what is the total net worth of Z Limited? It is 55 lakhs, out of which how much we have? We have 15% of that. But Out of that also, 50% of the unquoted shares were acquired before the firm was registered, before the trust was registered. Therefore, while computing the accreted income, you will only take the 50% of the value of your investment. Therefore, total value of Z Limited is 55 lakhs, out of which 15% we own. Out of that also 50% was purchased before the trust was registered. So during that period, if whatever is purchased, that is not subject to what? That is not subject to what? Accreted income. Therefore, only that much will come, and therefore the answer will come to 4,12,500. Be very careful. Very, very good question. Cash you will take directly, bank you will take directly, and this 9 lakh rupees loan you will take what? This 9 lakh rupees loan which you have taken for the purpose of building, that also you will take directly. Okay, you will take directly. What about this unquoted shares? Unquoted shares you will not take, because this loan was also taken in 2007-8. If this loan would have taken in 2010-11, 12-13, then I would have taken this loan also, because 2007-8 the trust was not registered. You are not supposed to take the assets also of that particular period and not the liability of that particular period. Once you do all these things, you will get your accreted income. No. One more thing you are supposed to do. When is the trust getting dissolved? The trust is getting dissolved on 29th of December 2021. Do remember there is one provision. If the trust is dissolved and within 12 months, if you transfer the assets to another trust registered under the income tax law, then that much can be reduced. So you are transferring within 12 months C to another trust, and therefore if you are transferring within 12 months to another trust, and therefore you can reduce that much 8 lakh rupees also from what? From your accreted income. So I'm reducing this 8 lakh rupees also from my accreted income, and on the balance income I'm paying 40, whatever is the tax rate, 34.944%. I hope it is clear to all of you. The next question is a very simple DTAA question. There is a resident assessee whose age is 62 years. He is following what? He is opting for 115 BSc. Be very careful. If he is opting for 115 BSc, you need to be careful with few things. First of all, you are not going to get the deduction of standard deduction. Okay. Now, the second thing, you are also not going to get the deduction of what? House property SOP interest. House property SOP interest is not allowed for 115 BSc assessee. Thirdly, you are not going to get the deduction of ATC and ATD also. So these are the few things which they will test as far as 115 BSc is considered. I don't think so anything apart from that can be tested by ICI. Next question. Question number 4 is a very good question. There are a lot of small points over here. The first question in question number 4A, subpart 1, they are asking on 194O. There is one website by the name called as abc.com, which is an e-commerce operator, and there is one seller, Mr. Z, who is a resident seller. Now he gives a valid PAN to the e-commerce operator. So e-commerce operator is nothing but Amazon, and Mr. Z is nothing but a seller on the Amazon, who is a listed seller on Amazon, and he is a resident. Now he is selling goods worth rupees 60 lakhs. Now is the Amazon liable to deduct TDS? Yes, at the time of payment or at the time of credit, whichever is earlier. Now, how much TDS he will deduct? He will deduct 1% because the seller is giving PAN. If the seller would have not given the PAN, then I would have deducted 5%. That I have told you earlier also. Now, for the very first time, they have credited in the books of accounts on 31st December. So, Amazon will deduct TDS at the rate of 1% on 20 lakhs. Then he will deduct 1% at the rate of 1% on 15 lakhs on 28th of Feb. Okay. Now, there is one more thing. The total sale is 60 lakhs. Now, how much is completed till year? Till year 35 lakhs is completed. The TDS on 35 lakhs is completed. Now, 10 lakhs goods are directly sold, directly paid by the customer to Amazon. So, if customer directly paid to the seller, if the customer directly paid to the seller, then is that also subject to TDS? Yes, this 10 lakh is also subject to TDS, and this 10 lakh is also covered in what? 60 lakhs. Therefore, how much is over now? 30 plus 10, 45 is over. Now, the balance money is received on 31st of March. So, what is the balance left now? The balance left is 15 lakhs, and on that 15 lakhs, also Amazon is liable to deduct TDS. So, there are 4 steps in which Amazon will deduct TDS. First on 20 lakhs, because Amazon is crediting, then again 15 lakhs, then again Amazon is crediting. This is directly credited by customer to what? To the seller. This will also be subject to TDS, and it is included in 60 lakhs. Okay, so it is not over and above 60 lakhs, and the balancing figure over here will come to how much? It will come to 15 lakhs. Next one is a very good question over here. Mr. Raghav is a dealer in car. Okay, and Mr. Raghav's last year's turnover is 9.8 crore from sale of car, and from sale of spare parts and service station it is 60 lakhs. In short, Mr. Raghav's last year turnover is more than 10 crore rupees. That is sufficient for us to understand that there are some implications of certain important provisions over here. Now, Mr. Raghav is manufacturing car and selling cars. Okay, now Mr. Raghav is selling cars. So if Mr. Raghav is selling cars to customers, then and if the value of the car is more than 10 lakh rupees, then it is liable to deduct TDS under 206C1F. Okay, and if it is less than 10 lakhs, then 206C1H might be applicable. So first of all, we need to give priority to 1F first, because Mr. Raghav is a dealer of car, manufacturer of car. His first duty is to sell the car. 206(1)F will be at priority. Therefore, if the sale consideration is more than 10 lakhs, he has to collect TCS under 206C1F. So for the first car, for the second car, and for the fourth car, he will collect TCS under 206C1F because the consideration is more than 10 lakhs. But what about the third car? For third car, Institute has given two views. First view is he will not collect TCS under 206C1H. He will not collect TCS under, it is wrong, it is 1H. Here it is 1F. For the third car, he will not collect TCS under 206C1H. Why? Because the threshold of 206C1H is 50 lakhs. He is not selling cars of more than 50 lakhs. He's only selling cars of what? 8 lakhs. Therefore, he will not collect TCS. This is one of the view. You can write this. It is correct. The second view which is taken by institute is because all the cars, including 1F and 1H, is excluding 50 lakhs. Is it excluding or not? If I take the total of all the cars, is it exceeding 50 lakhs? It is exceeding 50 lakhs definitely. So because the aggregate of all the cars is exceeding 50 lakhs and the last year turnover is also greater than 10 crore of the assessee, therefore on this 8 lakh rupees, you can collect TCS at the rate of 0.01%. This is the provision which the assessee has applied over here. Okay. Which institute has applied over here. The next question is also a beautiful question and a very important question. Be very careful with this question. There are a lot of small things in this question. I am trying to address you all of them one by one. The first thing is the assessee is an individual. He is a non-resident and he is a person of Indian origin. Therefore, he is an NRI. And if he is an NRI, he has an option to opt for chapter 12A. He has an option, but the question is saying that forget about option, he has to opt. Compute the question as per compute tax payable, tax refund as per what? The special provisions only. It means you have to follow chapter 12A only. Now what happens in chapter 12A? In chapter 12A, it's very simple. The long-term capital gains from specified assets and interest and dividend income will be subject to concessional tax rate. Now what is specified asset? Long-term capital gains from transfer of specified foreign exchange assets will be subject to what? Tax at 10% only. So this 8,50,000 will be subject to 10% tax. Plus you have also incurred the expenses. You can reduce that expenses on transfer also. 8,20,000. Now. There is one section under chapter 12A which says that after transferring the specified foreign exchange asset, if you purchase another specified asset within 6 months, then you will get the exemption under 115F. But there the problem is you are transferring the asset on 31st of May 2022 and you are purchasing another specified asset. Public limited shares are specified assets as per 115C. It is specified asset. But the problem is not this. The problem, the asset is correct, but the problem is you are buying late. Therefore, you are not going to get the deduction of, you are not going to get what? The exemption over here of what? 1,80,000. 1,80,000 exemption you cannot ask for. Therefore, the ultimate conclusion will be what? This long-term capital gains will be subject to this 30,000 deduction of expenses and this 8,20,000 will be subject to 10% tax, and this 1,80,000 is not allowed. If the asset would have been purchased within 6 months, we would have allowed. Okay. Next is interest on deposits with private limited company. Private limited companies deposits are not covered. Only public limited companies deposits are covered in 115C2I. In chapter 12A, private limited deposits are not covered. Therefore, this will be taxed at slab rate. Okay. Interest on government securities. Interest on government securities is covered provided we have to assume that it is purchased in foreign currency. So we have to make two assumptions. Therefore, ICAI has given two answers. First assumption they are making that this will be subject to what? This is assumed to be a forex. It is purchased in foreign currency. Therefore, chapter 12A is applicable. Therefore, this interest will be subject to 20% tax. But if we assume that this is not in forex, then this will be taxed at what? This 1 lakh is also taxed at slab rates along with this 2,93,000. Both the answers are given by ICAI. You can check. Then this short-term capital gains will be charged at what? 111A. And last but not least, whichever assumption you take, whether you assume this in forex or you do not assume this in forex, you will get a deduction of chapter 6A of 1,50,000 rupees over here. And therefore, there are two solutions over here. In first solution, they are assuming that this interest on security is purchased in foreign currency, and second assumptions, they are assuming that this interest on security is not purchased in foreign currency. Accordingly, the answers will change to some extent. Okay. Now coming to question number 5, which are based on some important case laws. The first question is, can CIT revise an intimation under 143(1) under 264? See, by default, it is very clearly written in the law in section 264 that CIT can revise any order other than the order mentioned in 263. He can revise any order other than the order mentioned in 263. But he cannot revise intimation. It is very clear. He cannot revise intimation. That is not written. But what is written in the law, he can revise any order. Now, is an intimation an order? Practically speaking, intimation is not an order. Practically speaking, it should not be revised. But this case law has said that, yes, CIT can revise the intimation also as per section 264. So there is a case law. There is one of the case law which is giving this benefit to the assessee. So forget about it. If it is giving, we are no one to stop that. We are not beyond the judiciary system. Okay. Now there is one assessee. There is an assessee firm and there is a transporter over here. This assessee firm has given some contract to the transporter for transporting certain things. Now this transporter has done what? They have taken service of some other person. They are not owning the vehicle. They are taking services of some other person. Now if you are making the payment to such transporter who is not owning the vehicle, he is giving outsourcing the service to somebody else. Are you supposed to deduct TDS under 194C? Yes, you are supposed to deduct TDS under 194C. If you do not deduct TDS, then it will be subject to 30% disallowance, because in 194C, it is not necessary that the other person should own a vehicle. It is not necessary. It is not necessary that the other person should have his own vehicle. He can outsource that particular thing to some other person and you can take the services in that manner also. In that case also, it will be subject to what? TDS under 194C. Okay. The next one is very simple. There is an assessee who has bought back some shares from the shareholder. Now we all know that when you buy back the shares from the shareholders, you are liable to pay tax under section 115 QA. Now the assessee paid the tax, and then the assessing officer passed some order. Now the assessee agreed with that order. Assessee did not like that order. So the question is, the AO has passed an order and the assessee do not like the order. Can assessee directly go to High Court and file a writ petition? The question is that, can assessee escape the route given under the income tax law and can file a writ petition under the income tax law? And the answer is no, no, and no. Why? Because writ petition is available if there is no remedy in the law. Now, if there is a remedy in the law to file an appeal to CIT appeal, why the hell you are going for writ petition? It is not allowed to go. Therefore, the contention of the assessee is wrong. Next one is a very simple question. There is a company which is there outside India. It's an e-commerce operator. They do not have any permanent establishment in India, and they do not bill more than 1 lakh also to the customer. They are providing some online advertisement services, and if they do not bill more than 1 lakh, then 2020 equalization levy will be applicable, and if they bill more than 1 lakh, then 2016 equalization levy will be applicable. So now it's a very, very simple question. You are providing services of 1.2, you are selling goods of 1.2 crore to Indian residents, and to other Indian residents, you are selling goods of 70 lakhs, and to other customers, to non-residents who target Indian customers, that is also covered in 2020 equalization levy, you are selling 20 lakhs. So total you are selling how much? 2.1 crore, which is greater than 2 crore. So you are satisfying all the conditions of 2020 equalization levy. Therefore, the xyz.com is liable for what? Equalization levy at the rate of 2% or 2.1 crore. Okay. Now, the next question, not next paper. The next question is based on whether GAR will be applicable in the following cases or not. There is a company by the name called as Highway Drive Limited, which is a wholly owned subsidiary of Mrs. Highway Limited. Now, its main business is what? To develop infrastructure and they take deduction under ATIA. Now, what are they doing? They are deriving some income which is other than infrastructure. They are not doing infrastructure work. They are doing some other work, but they are showing that as an infrastructure and enjoying benefit under ATIA. Whether GAR will be applicable? GAR will not be applicable because this is a clear case of tax evasion. GAR is applicable in case of tax avoidance. Okay. It is not a tax avoidance. It's a clear case of tax evasion. Therefore, GAR will not be applicable. Second case. Highway Roads Limited purchases the supply at a price lesser than FMV. Now, this company and its wholly owned subsidiary, one is there in what? One is eligible to claim deduction under ATIA. Another is not eligible to claim deduction under ATIA. Now they are selling and buying something for what? Selling and buying something for less than the fair market value. So in that case, specified domestic transaction, transfer pricing is applicable, 92BA is applicable. So again, there is a specific anti-avoidance rule. Therefore, the GAR cannot be made applicable in this case. Check it, please. Now the next question is a very important question. It's a theory question, but very important question. The first question in this is, does the assessing officer has the power to what? Revoke the provisional attachment. Does he has the power to revoke provisional attachment? That is the first question. If yes, from whom and to what extent? And the third question, does he have the power to invoke such bank guarantee? So on and so forth. Now please pay attention. First of all, does he have the power to revoke the provisional attachment? Once he has done the provisional attachment, can he revoke it? Yes. By an order in writing, he can revoke a provisional attachment. When he can revoke? If the assessee furnishes a guarantee. Guarantee from where? Guarantee from a scheduled bank. Of how much? Of an amount not less than the value, fair market value of the property attached, or that much amount which is necessary to protect the interest of the revenue. At least that much guarantee has to be given by the assessee, which is necessary to protect the interest of the revenue. He will what? He will revoke the bank guarantee. Now, can he invoke the bank guarantee? Invoke means, can he realize the bank guarantee? Yes. If there is a notice of demand on the assessee, which is served on the assessee, and assessee fails to pay the demand on time, he can invoke the bank guarantee. He can go and tell to the bank, please pay me the money. Or if the assessee fails to what? Renew the bank guarantee. Or if he fails to what? Furnish a new bank guarantee within 15 days from the expiry of the old bank guarantee. If he does not do these things, then he will be liable for what? The AO has the power to invoke bank guarantee. Invoke means he can go to the bank and tell that I want the money. Okay. The next are few theory questions which you can go through at your end. First is, what is thin capitalization? You have to write the version of 94B, which we have done it in class. Is any threshold limited? Yes, 1 crore is applicable. Applicability of different entity. To whom 194B is applicable? 94B is applicable to Indian companies or permanent establishment of foreign company. Is there any exclusion? Yes, banks and insurance companies are excluded. Next question is also a very theoretical question. What are the two types of DTAA? Limited, comprehensive. Limited DTAA means DTAA where we do not expose ourselves to all the types of incomes. We only consider few incomes with the other country like India, Pakistan. DTAA, limited DTAA. Comprehensive DTAA means where we expose all the incomes. We discuss, we have articles of all the incomes in our DTAA. That DTAAs are called as comprehensive DTAA. Go through it once if you want. So let's move on to the next paper, that is May 2022 exam paper. The first question over here is on manufacturing company. This assessee is eligible for, they are opting for 115BAA. Now the very first adjustment is depreciation, you have to add it back. The next one is employer contribution is paid till the due date of filing of return, therefore allowed. But employee's contribution cannot be paid till the due date of filing of return. That is not allowed. It has to be paid by 15th of the following month, and therefore that is disallowed. Okay. Next one is penalty on GST is not allowed as because it is penal in nature, but interest on GST is allowed because it is compensatory in nature. Next one, when you are making payment for certain notified skill development project which are covered under 80 CCD, that is not allowed. under 115BAA not allowed. Now next one is a very good adjustment. There is an old machinery which got destroyed because of fire and there is a loss of 20 lakhs. So first of all, add back this loss. This loss is not allowed as deduction. Now you are also receiving some scrap on that machinery. That scrap also reduced from PGBP income. That is also not your income. You have to adjust that scrap in what? In the WDV of the block of asset. So loss has to be added back and the scrap which you have received, which you have credited to the P&L, that has to be reduced, and you have to adjust this 5 lakh from the WDV of the block of asset. In this question, WDV of the block of asset is not given. Next question is, you are receiving some dividend from foreign company of 15 lakhs. So first of all, reduce this dividend from PGBP, show under IFOS. Okay, and you are incurring some expenses of 50,000 on that dividend. Assume that this expense is interest. If you assume this expense as interest, it is allowed as deduction because against the dividend, only interest expense is allowed to the extent of 20% of gross dividend. Apart from that, no other expense will be allowed as deduction. Okay, next one is, you are earning some same adjustment which we have been doing again and again. You are earning some profit from sale of land to your 100% subsidiary. Subsidiary is an Indian company, then it is exempt under section 47. Same adjustment is coming again and again. Next one is, you have purchased some new plant and machinery in the last year. In the last year, you have purchased some new plant and machinery. So in the last year, you have purchased and put to use on 10th of Jan. So in the last year, you would have got additional depreciation half only. Okay, now you want the additional depreciation balance half in the current year, but in the current year you cannot take. Why? Because in the current year you are opting for 115BAA, therefore you cannot take the balance depreciation in the current year. Okay. Similarly, in the last year you have paid some amount to the contractor for repair of factory of around 7 lakh rupees, but you did not deduct the TDS and paid the TDS on time in the last year. So in the current year you are making the payment on time, so you will get the deduction in the current year. So in the current year, in the last year, 30% of 7 lakh would have been disallowed, but in the current year 30% of 7 lakh will be allowed to you in the current year. So you have to reduce this much amount, that is 30% of 7 lakh will come to 2.1 lakhs. You have to reduce from your net profit. Okay, and last but not least, whatever dividend you have earned over here of 15 lakhs minus 50,000, that is 14 lakh 50,000, that will be subject to what? Deduction under ATM, and you have made the payment of dividend declared and distributed within 1 month before the due date of filing of return. So whatever dividend you earn, if you make the payment of that dividend to your shareholder, if you declare and distribute that dividend to the shareholders within 1 month prior to the due date of filing of return, you will get the deduction of that dividend. So you can take the deduction of this 20 lakhs or 14 lakh 50,000, whichever is lower. After doing that, you will compute the total income and then you will compute the tax. Tax will be very simple, 22% tax, 10% surcharge and 4% cess will be applicable as per 115BAA. Okay. The next question is on real estate investment trust. There is a REIT and there is HATS Limited, which is an SPV of the REIT, and there is an investor, Mr. Vijay, who holds 70% of the units. 70% investment in the REIT is of 1% only, that is Mr. Vijay. Now we need to tell what is the treatment of each and every item. Okay, first, the interest which is earned from SPV is exempt in the hands of REIT, but it is taxable in the hands of the investor. How much will be taxable? 70% will be taxable. And Mr. Vijay is also opting for what? 115BAC. So you have to compute the tax of Mr. Vijay as per 115BAC. Second thing is, you are earning some dividend. You are earning some dividend from SPV. So it is always exempt in the hands of the REIT, but in the hands of investor, it depends. If the SPV has opted for 115BAA, then it is taxable. Your SPV has opted for 115BAA. That is the reason it is taxable. If SPV would have not opted for 115BAA, then it would have exempt in the hands of investor also. Next, short-term capital gain on sale of property is taxable in the hands of REIT at 42.744% MMR, exempt in the hands of investor. Similarly, interest on unlisted debentures is taxable in the hands of the REIT at 42.744%, exempt in the hands of investor. And rental income from properties is exempt in the hands of REIT, but taxable in the hands of investor, and investor has to pay tax. Okay. Now, this is what this question is all about, nothing great. Whenever investor is paying tax, you have to take 70% of that amount in the income of Mr. Vijay, because Mr. Vijay only holds what? Only holds 70%. Now, in the hands of REIT, there are only two incomes which are taxable, that is point number 3 and 4, that will be taxable at 42.744, and in the hands of investor, you have to apply 115BAC, and then you check whether surcharge is applicable. Yes, it is applicable, because if you compute the total income of the assessee, it is going beyond 10 lakhs, beyond 10 crore, sorry. Therefore, you have to apply what? Surcharge also of 37% in this particular question. The next question is also a very good question. What is happening in this question? There is a non-resident and a foreign company, Mr. X, who is appointing one agent in India. And what is the duty of that agent? That agent is habitually maintaining stock in India, is delivering the stock on behalf of the non-resident. The foreign company does not have a P in India. They don't have any branch office factory in India, but they have an agent in India who is habitually maintaining what? He is habitually doing contracts on behalf of that particular entity, who is habitually maintaining, stocks in India, who is delivering stocks in India. That amounts to business connection. Therefore, whatever delivery he has made in India will be subject to business connection. Okay. So we need to answer one by one. Income from delivery of goods done by Mr. Lal Singh. So Lal Singh is what? An agent. he is deemed to, the income of the company, the non-resident, will be deemed to accrue or rise in India as per 911. Okay. Now, second thing, Mr. This black and brown company is also earning from technical services of 55 lakh rupees after deducting 6 lakh spent on earning the income. Now, here there are two views which are taken by SSE. First view which is taken by the institute is, the first view which institute is taking is, it is assumed to be a normal technical service. It is not 115A service. Therefore, if it is normal service, then 40% tax will be chargeable on 55 lakh rupees. That is the net profit. But if we assume this to be a 115A, which is no, it doesn't make sense to assume, but institute has assumed that. The institute has assumed that. Why it doesn't make sense? Because there is no information in the question which says that there is an agreement, the agreement is approved. But still, if we assume that there is an agreement, it is approved, then you will not get the deduction of this 6 lakhs. Then your income will be 55 plus 6, that is 61 lakhs, and 61 lakhs will be subject to what? 10% tax. That is what the institute has made as an assumption. Then unlisted debentures, that long-term capital gains will be subject to 10% tax under section 112. Plus, there is some 50% tax which is paid by BNB in country X. Will it get the benefit of tax credit in India? Obviously no. The tax credit is given to residents. BNB is not resident in India. BNB cannot get the credit of the tax which is paid in foreign country. It is not resident in India. Therefore, BNB will not get the benefit over here. Okay. So this is what this question is all about. We are supposed to follow what? We are supposed to compute tax payable also. So tax payable will be very simple. 2 crore 75 lakhs. We want this long-term capital gains 10%, FTS 10%, and in some case we can also assume that FTS is what? FTS is 40%. We can assume that also. Though either of the way, the tax liability will change in both the cases. Okay. Now coming to the next question, question number 3, part A, which is on trust. There is one trust, charitable trust, which is registered under 12AB. It is receiving a donation of 5 lakh rupees. Now it is after receiving the donation of 5 lakh rupees, it says that because it is a corpus donation, it is exempt. No. It's not like that. A corpus donation is not by default exempt. It will be exempt only if you invest in the mode specified in 11.5. Therefore, they have to invest that in the mode specified in 11.5. They cannot directly claim exemption on corpus donation. So if they do not invest, it is taxable. Okay. The second question, what does it say? In this question only, there is a second question. They have taken a loan of 20 lakh rupees and they have incurred that loan. They have used that loan to construct a building. Now they are asking the deduction of this 18 lakhs. Not allowed, not allowed, not allowed. The loan which you have taken for construction, it will be not allowed when you use for construction. In fact, it will be allowed on the day on which you will use that loan to repay. You will repay the loan to the bank. Whenever you will repay the loan to the bank, at that time we are going to give you the deduction. Till that time we are not going to give you the deduction. Next question is, there is some not-for-profit institutions which are receiving donation from public also and which are receiving donation from government grant also. So they are receiving, there is some non-for-profit organization like school etc. which is there. Some Smile Foundation which is a kind of school which is receiving donation from public also, donation from government also. Now, if it is substantially financed by government, then the income is exempt. Okay. Now we need to find out how much the government has financed. What do I mean by substantially financed? As per section 1023C, substantially financed means the government should finance more than 50%. Here, out of the total donation of 30 lakhs, 16 lakhs is given by government grant and 14 lakhs is given by public. Therefore, it is substantially financed by the government and therefore the income is exempt. They need not take any approval over here. Okay. Next question. Once one assessee is there who is registered under 12AB. Now, an assessee who is registered under 12AB, that assessee wants to enjoy 1023 also. Can the assessee take the benefit of both the sections? No. As per section 11 subsection 7, the assessee has to take the benefit of either 12AB or 1023C or 1046, either of the two. It cannot take the benefit of both the sections at the same time. Okay. The next question is a very good question. Mr. Chetan is there whose age is 51 years. Now, in 2019, he left India. He left India to settle in country Y. So before 2019, he was in India only. So in 2019, he left because of some unavoidable reason. Now he came back to India permanently in 2022. He is not coming to India for a visit. He is coming permanently in India in 2022. So now, if he is coming in June 2022, so from June 2022 to March 2023, his number of days stay in India come to 304. So he is definitely a resident. Second thing, is he ordinary resident? Yes, he is also ordinary resident. Why you are saying so confidently, sir? Because in 2019 only he left. So if I take the last 10 years data, he will be definitely resident in 2 years. If I take the last 7 years data, he will definitely be staying in India for 730 days. Therefore, he is resident and ordinary resident. Now for resident and ordinary resident, world income is taxable. Now he is earning some property rent from country Y. From country Y is earning how much rent? 25,000 rent is earning. So for that 25,000 rent, we are supposed to do what? We are supposed to compute that 25,000 rent over here into 75. How am I taking 75? 75 I am taking, that is to convert the income from house property, I have to apply rule 115, and as per rule 115, income from house property, if I want to convert from foreign currency to Indian currency, I have to take TTBR as on the last day of the financial year. So to convert this $25,000 rental income, I have to take TTBR as on the last day of the financial year, which is 75. So therefore, this is $25,000 into 75, 1875, out of which I will get 30% standard deduction in India. I will take that. Okay. Now, apart from that, he is also earning some business income from India, that is of 5 lakh rupees. So if the business income is earned from India, that will be directly taxable. Apart from that, he is also receiving some dividend of 1,25,000 from an Indian company. So if an Indian company is giving you dividend and you are receiving a dividend from Indian company, then Indian company would have deducted TDS. So you have to gross it up. This has to be gross it up because this is received 138,889. And income from saving bank account, which is 11,500, which you are earning on that 10th, on that you will get a deduction of 10,000 rupees as standard deduction also on 80 TTA. Now this will be your total income. On that you will apply your tax as per the normal regime. We are not following 115 BSc and all. 115 BSc and all they have said not to follow. Now this is the tax which I am going to compute on my 19,52,000. Be very careful. Here the real journey starts of this question. On that you will apply 4% cess, and this is the tax liability which you are going to get. Now this divided by your total income, you will get what? You will get your average rate in India. Now what is the average rate in foreign country? Now the average rate in foreign country, if you directly see, it is 20%, but that is wrong. That is not the average rate in foreign country. The reason is because 25,000 is your income in the foreign country. You do not pay tax on 25,000 in foreign country. You pay tax on minus 8,000 in foreign country. So you pay tax on only 17,000 in the foreign country. So 20% is not charged on 25,000 because in foreign country you pay tax on after taking exemption of $8,000. So after taking exemption of $8,000, it comes to $17,000. So you pay tax of only $3,400. So $3,400 divided by your house property income, which is 25,000, it comes to 13.6% is your average rate. Your average rate is not 20%. This is a very, very important point. This is not your average rate. This 20% is not your average rate. 13.6 is your average rate. Okay, because you are not paying 20% of 25,000. You are paying only 3,400 out of 25,000. Therefore, your average rate is tax divided by your total income. Your total income is how much? 25,000. Therefore, it comes to 13.6%. Therefore, you will take doubly tax income is how much? Doubly tax income is house property income is your doubly tax income. Rest of the incomes are earned in India. 13,12,500 is your doubly tax income. On that, you will take 13.6%. That will come to 1,78,000, and that will be the relief under what? Under section 91. You can check it once if you want. Okay. Now, the next question is on TDS, which is a very, very simple question. Nothing great as such. Okay. There is one person, that is Mr. Rajat, who is aged 79 years and he is resident also, and he is earning only saving bank interest, FD interest and pension income. Okay. Now, he does not offer 115 BSc also. So, for him, section 194P will be applicable because he is a specified senior citizen. Who is a specified senior citizen? Whose age is 75 years or more, who is resident and who earns interest from bank and pension from the same bank. So, what will you do? Interest and this interest will be subject to 50,000 rupees. Both the interest taking together, you will get 80 TTB 50,000. And from pension, you will get what? 50,000 rupees standard deduction, and then compute the tax. That much tax the company has to, what? The bank has to deduct on your behalf. And once the bank deduct that much tax, then the assessee is not liable to file the income tax returns also. Next, there is an assessee who is giving his property to some builder, and the builder is making some payment. So if I'm giving my property to the builder and in return the builder is giving me two things. He is giving me money also. He is going to give me flats also in future. He is going to give me a new house also in future in the new building. So he will deduct TDS on what portion? As per section 194 IC, if I am seller, if I am giving the property, and if I am resident, then he will deduct TDS at the rate of 10% only on the cash portion. He will not deduct TDS on what? The property which he is giving me. He will deduct TDS only on the money which he is giving me. How much money he is giving me? He is giving me 6 crore rupees. So on 6 crore rupees, he will deduct TDS at the rate of 10% on credit or payment, whichever is earlier. Okay. Next question. Mr. Aryan, he is a domestic company whose turnover of last year is what? Whose turnover of last year is more than 10 crore rupees. Okay. Now, his turnover of last year is more than 10 crore and he is purchasing goods of 85 lakhs rupees. Okay. From Mr. Varun. So now, on 25th of Jan, now the solution of this question is to be considered to be wrong because it is updated. This question was asked when this section came for the very first time. So accordingly, there was some issue of dates. The section was applicable from 1st of July. So accordingly, don't see the solution of this question. See the solution which I am showing you, which I am telling you that is the correct answer. Okay. Now, on 30 lakhs, I will not deduct TDS under 194Q. Why? Because TDS under 194Q is deducted when when the payment exceeds 50 lakh rupees. So first 30 lakhs, you will not deduct TDS. On the next 25 lakhs, yes, now the payment exceeds 50 lakhs. So now how much it is exceeding? 5 lakhs it is exceeding. So on 5 lakhs, you will deduct 1%. Now on 20 lakhs, you will deduct again 1%. But later on, what happened? You returned 5 lakh rupees to the 5 lakh rupees goods to the seller, and you took the refund also. So there is a CBDT circular on that. As of now, I will deduct on 20 lakhs because when I am paying the amount, I did not know that I will return that particular goods later on because of some reason. So now I will deduct TDS on 20 lakhs at the rate of 0.1%. It is not 1%, it is 0.1% everyone. Sorry. So I will deduct TDS on 0.1% on 20 lakhs. Now later on, I have taken the refund. So I can adjust this 5 lakh rupees purchase against my future purchase. So later on, when I'm purchasing goods of 10 lakh rupees, I will adjust that 5 lakh rupees ka purchase against this purchase. So this 10 lakhs rupees will be subject to TDS at the rate of only 5 lakhs at the rate of 5% because the earlier TDS which I have paid on purchase return, that can be adjusted against the same seller. Okay, so that I can do now. The next question is, there are 2 points in the next question. The state government of Telangana is giving you coal mine on lease. So if somebody is giving you coal mine on lease, then the person who is giving on lease the coal mine or a parking lot or toll, etc., then the person has to collect TCS at the rate of 2% under section 206C1C. Now, the other transaction over here is the company to whom the coal mine is given, the company is extracting the coal mine and selling the coals. So if somebody is selling the coals, then that company is liable to take what? TCS at the rate of 1% on 206C subsection 1. Now, this question is exactly same what we have done in the previous paper also. It is ICA's favorite question. Every time they are asking same question only of that cost plus method here. I am not interested in doing that cost plus method again and again. Next question is, there is a Indian company SMT Limited and there is a foreign company Shine Inc. Now that company is giving us some online advertisement services and that company does not have a permanent establishment, and the Indian company has made a payment of 5 lakh rupees to the foreign company on 15th of March 2023 and they have deducted the equalization levy also. This is which equalization levy? This is 2016 equalization levy, that Facebook wala equalization levy. Now if you have deducted the equalization levy on 15th of March, you should have paid by 7th of April. Now if you do not pay by 7th of April, you will be liable for interest at the rate of 1% for per month. So you are making a delay for how many months? You are making a delay for part of the month. Part of the month is considered to be a complete month. So you will be liable for interest at the rate of 1% for 1 month. On how much amount? The payment which you are making is 5 lakhs. On that 6% comes to 30,000. 30,000 is the equalization levy. On that 1%, that will come to 300 rupees. Okay. Now the AO will also impose penalty on you. AO will also impose penalty on you. Yes. So what are the circumstances under which the penalty cannot be imposed? If you prove to the AO that there was a reasonable cause for the delay. If you go and prove to the AO that there was a reasonable cause for the delay in making the payment, he will waive your penalty. Okay. Now, if he does not waive your penalty and if you are aggrieved by the order of AO, what is the remedy available with you? You can go and file what? A CIT appeal within 30 days of the date of order of the assessing officer. You can go and file what? An appeal with the CIT appeal. So this is what this question is all about. And one last question over here is about what? It is about whether GAR will be, whether it is a tax planning or tax management or tax evasion. Let's see. There is an assessee who is making some payment of 10,000 rupees in Sukanya Samriddhi scheme, 80C deduction. So it is tax planning. Okay. Now there is an assessee who is a company and it is obtaining form 60 from the customers who does not have PAN. So all the customers who do not have PAN, they are obtaining form 16. So form 60. So this is the kind of compliance done by the company. So it is a tax management. Third one, the company is purchasing some refrigerator and it is installed in the residence of the partners, and but they are showing what? They are showing that it is in the office. So they are making a clear tax evasion case. You are buying a refrigerator in the name of the company and you are showing it in the books of the company, but you are using at the home of the partner. It is not allowed. Similarly, last case, a company is making payment to Mrs. D, a wife of director. Why? Without any reason. She is just a housewife, but you are making payment to the wife of director and you are claiming that expenditure. So it is again a case of what? Tax evasion. The last question is a theory question. You can go it once at your end if you want. So let's move on to this last paper, that is of November 2022, and the next paper will be yours, that is May 23 and November 23. Okay. So let's start with the first question over here. The first question is a company which is a resident in India, but it is a closely held company in which public are not substantially interested. Because it is a closely held company, section 79 might apply, section 68 might apply, section 56(2)(7)(b) might apply, section 222(e) might apply. These are the provisions where closely held company provisions are there. I have given a complete summary also in our color book. You can go and check after set of chapter. Okay. I have given a complete summary in which all provisions closely held company sections are applicable. See, the same thing is tested by ICI over here. The first point is debatable over here. You are doing the same adjustment which we have been doing again and again in the last 18 papers. So now, but here the ICI has assumed some vague assumptions over here. You are purchasing some one-time franchise fees. What we have been doing so far, that is absolutely correct. You can reduce that much. You can add back 12 lakhs to your income statement, PGBP, and reduce 25% depreciation. calculation. But here ICI has made an alternate assumption. What is that alternate assumption? Listen please. They have added 12 lakhs, but they have said that we are not reducing 25% because we are assuming that the depreciation which is given below now, this 14,50,000 might include the depreciation of one-time franchise fee also. Then why you have not made this assumption in earlier questions also? So don't forget about this assumption which is made by ICI. Follow the same thing which we have been doing so far. Even in this question, they have done both the things. First thing which we have done is add 12 lakhs less 25%. Second thing which they have done is add 12 lakhs, ignore. Do not reduce 25%. Next is you are incurring some expenses on convertible debentures issue. That is allowed as a deduction, nothing wrong. If you incur expenses for issue of equity shares, then that is not allowed. That is considered to be a capital expenditure. That is not allowed. Now, the third adjustment is a very, very, very intelligent adjustment. Now, in third adjustment also, they have taken two views. Now, you are making some payment to share broker first, and then you are making some payment to commodity broker. Now, they are made and you are not deducting the TDS. Okay. Now, the two assumptions which they have made, let me tell you one by one. The first assumption they are made is assume that these are business expenses. Assume that the assessee is engaged in the trading of shares and trading of commodity. Assume that. Now, if I assume that, then this 2,25,000 will be allowed as deduction. But you will ask that, you will say that, sir, why TDS is not deducted? TDS is not required to be deducted on commission, etc. paid to broker. Share broker, TDS is not required. But if you make the payment to commodity broker, TDS is required. Go and check 194H. So what is the first assumption we are making? We are making an assumption that assessee is engaged in the business of trading in shares and trading in commodity. Therefore, these are business expenses. Now, if business expenses are there, it will be allowed. So in case of share broker, it will be allowed without deduction of TDS because TDS is not required in case of share broker. But in case of commodity broker, TDS is required. Therefore, 30% will be disallowed over here. Now, the second assumption will be that we assume that it is not a part of business. The trading is not a part of business. Assessee is neither trading in share nor trading in commodity. In that case, you have to add back both the things. The question of TDS does not arise only. Okay. The next question is also very, very good question. You are making some payment to contribution to approved pension scheme. How much deduction is allowed to employer? Only 10% of salary. Salary means how much? 10% of salary means which salary? 10% of basic plus DA in terms. Now, how much is actually contributed by the employer? Actually, the employer is contributing 15% of the basic salary. Therefore, the 15% of basic salary comes to 90,000. But that is not allowed. How much is allowed? Only 10% of basic plus DA in terms. Now, how much is basic? Basic is 6 lakhs. How much is DA in terms? The total DA is 30% of basic. So, DA will come to 30% of 6 lakhs. That will come to 1.8 lakhs. Now, out of that, the DA in terms is only 50% of that. So, 50% of that will come to 90K. Therefore, DA in terms is only 90K. Therefore, basic plus DA in terms is 6 lakhs 90,000. 10% of that will come to 69,000. And therefore, 90,000 is the actual contribution. Allowed is 69,000. Therefore, 21,000 will be disallowed under the income tax law. I hope it is clear to everyone. Okay. Next. You are making some payment, you are a pharma company, and therefore you are making some payment as freebie to medical practitioners. Not allowed, not allowed, not allowed, not allowed. Even Finance Act 2022 has clarified that it is not allowed as a deduction. Then you are incurring some expenses as feasibility study on your existing business without creating any asset. You are not creating any asset. Therefore, it will be allowed as an expenditure because it is not a capital expenditure. Depreciation will be added back. Employees Provident Fund, which is paid after 15 days, will be disallowed. And employer contribution, which is paid till the due date of filing of return, will be allowed. Okay, there is no harm in that. Swachh Bharat Abhiyan, you are making the payment to 2 lakh rupees. Add back in PGBP, you can claim deduction under chapter 6A, 100% is allowed, but you have to assume that it is other than cash. If you assume that it is in cash, it will not be allowed in chapter 6A. Next, you are receiving some concession from what? The central government or state government, then that is considered as income under section 222, 224, 18. That also we have done a lot of time in the earlier questions. Okay. Now, in the opening stock and in the closing stock, you are having some unnecessary interest. So in the opening stock, you are having an interest of 6,85,000 unnecessarily. So add back that because it is on the debit side. In the closing stock, you are having some unnecessary interest and borrowing cost of 5,65,000. So it is on the credit side. So reduce that. Remove that from what? From your PGBP income. Okay. Net profit from what? The profit from warehousing business. You have some warehouse of storage of sugar. You have purchased some warehouse for storage of sugar, and you are earning some profit of 10 lakh rupees from that. And how much you have made an investment? You have made an investment in the last adjustment. You can see 35 lakhs, out of which 20 lakhs is land. So land will not be allowed as deduction, but 15 lakhs will be allowed as deduction. So how much is your profit? Profit is 10 lakhs. And how much is your deduction? 15 lakhs is your deduction. So 5 lakh rupees loss cannot set off against your existing business because 3580 loss will be set off only against 3580 business till infinity. You cannot set off as per section 73A. The next adjustment is something which you have done earlier, copy paste adjustment it is. So see how the things are repeated from your past RTPs and mock test papers. Lot of things gets repeated. Yeah, 50% paper is repeated only. First of all, you have collected 14 lakhs as GST from customer and you have paid the GST before time. So you collected 14 lakhs, you paid 14 lakhs, deduction will be allowed. Then you filed a case in the Honorable High Court. The High Court directed to the government that refund 5 lakhs to the assessee. So you got 5 lakhs. So now when you got the 5 lakhs, you should give that back to the customers because GST money belongs to customer. So you got 5 lakhs, you give 3 lakh to the customers. Okay, so 3 lakh deduction will be allowed, but 2 lakhs is still not given to the customer. So you have to add back 2 lakhs. Similar adjustment we have done earlier, don't worry. Now the next two adjustments are the reason why we are doing this question. These are absolutely new adjustments. So this is a closely held company. As you can see in the very first line, and if a closely held company is issuing shares at 22 rupees and if the fair market value is 19 rupees. So if the closely held company is issuing shares at more than face value and more than fair market value of the shares, then the difference between the actual sale price, the actual issue price, which is 22, and the fair market value, which is 19, will be considered as income from other sources for the company. Therefore, the other source for the company will come to how much? 3 rupees per share. The difference between the FMV and the actual issue price is 3 rupees into 2 lakh shares. 6 lakhs rupees will be added to income from other source. This is very, very, very important adjustment. It has never ever come earlier. Okay, it is not that we have not done in class. We have done everything in class. Not a single adjustment will come from something which we have not done in class. Next one is you have some brought forward losses. Now, because it is a closely held company, do you remember that if you have a loss in 1920 and if more than 51% of the shares are held by Mr. X, then Mr. X should be the shareholder today also. Now, Mr. X sold all his shares in the 2021. Now, because the year in which the loss was incurred and the year in which you want to set off the loss, 51% of the shareholders are not same. Therefore, you are not going to get the deduction of loss under this particular year as per section 79. Because section 79 clearly says in case of a closely held company, the 51% of the shareholders in the year in which the loss was made and the year in which the loss you want to set off, it has to be same. On which date we are supposed to compare? On the last day of both the years. If it is not there, then you will not be allowed to carry forward and set off the loss. Then 14,50,000 you can reduce and then you will compute the total income. This is what this question is all about. It's a beautiful, beautiful question. Go through it once. Okay. So let's move on to this next question. This next question is on LLP and this is also on 10AA and there are multiple implications in this. So always remember whenever there is a question on partnership form and NLP, first thing which you have to find out is the book profit. Okay. Now this LLP is having a net profit of 65 lakhs. First of all, we'll compute the book profit of the firm. What is book profit? Book profit as per 40B. Book profit is nothing but PGBP income only, but just add the remuneration which is debited to PNL. So first of all, let's compute book profit. The book profit first of all is profit on sale of import license. This is the part of PGBP, section 28, it is chargeable. Therefore, ignore this. Okay. Then remuneration paid to working partners, add back. We need to compute book profit. Then interest of 20 lakhs, which is 16%. So add back 4%. 4% you have to add it back. Then donation to political party, 3 lakh rupees. You have to add back this donation and then you can reduce that later on what in chapter 6A while computing the total income. Assume that it is other than cash. Then you add back depreciation of 17 lakh rupees, you can add back. Okay. Now, after you do all these things, whether while computing the book profit, you will adjust brought forward loss. No. Brought forward loss does not come under section 28 to 43. Whatever comes under section 28 to 43, you have to adjust that. So you will adjust this later on while computing the total income, not now. Next. Unabsorbed depreciation, whether you will compute the unabsorbed depreciation while computing what? While computing the book profit? Yes, unabsorbed depreciation will be reduced while computing the book profit because it comes under section 28 to 43. Once you do that, you will get what? You will get your book profit. Once you get the book profit, you will compute your remuneration, which is up to 3 lakhs, 90%. Above 3 lakhs, it is what? 60% of book profit. And then you will compare with your actual remuneration. Check it, please. And then whichever is lower will be allowed as remuneration to you as per the provisions of 40B. Now, once this is computed, what you will do? After that, the real challenge will start. After that, you will reduce what? Once your book profit is computed, your remuneration is computed, then you will reduce what? Your brought forward loss also will be reduced because we need to also compute our total income. Once total income is computed, now we are supposed to compute the deduction under what? Under the provisions of 10AA. So how the deduction will be allowed under 10AA? How much deduction is allowed under 10AA? It is the profit from export multiplied by export turnover divided by total turnover. So first of all, let me speak about the export turnover. How to compute the export turnover? Now, export turnover will only include that turnover which is brought to India. So how much is brought to India? 38 crore is brought to India. In that also, there are some charges which are included. That should not be included in export turnover. Export turnover only includes what? Only includes FOB price. It does not include insurance, freight and other charges. Therefore, export turnover will come to how much? The amount which is realized, that is 38 lakhs. Out of that, these charges also should be removed. Therefore, the export turnover will come to how much? Only 36 crores. What is the total turnover? Total turnover is 45 crore. Now, out of 45 crores, in that 45 crore also, in total turnover also, you should not take some other charges like insurance, freight and other charges. That also should be removed. Therefore, the total turnover is how much? 40 crore. Now, what is your profit? Now, for profit, Institute has taken two views. Now, the first view, which is taken by Institute for computing profit, be very careful now. Your gross total income is 29,90,000. Okay. Now, out of this, you are supposed to first of all remove what? You are supposed to remove first of all what? 9 lakh rupees profit on sale of import entitlement license. Because profit on sale of import entitlement license are not eligible for 10AA deductions. Therefore, remove that. Remove that much from 29,90,000. So, if I remove 29,90,000 minus what? minus 9 lakhs, it comes to what? It comes to 20,90,000 rupees. So that is the one way in which I can solve the question. Institute has done another way of solving the question. Institute has said what? You should not take the profit after loss, because we should take the profit before loss over here. Why you are taking the profit after deducting the loss? So if you take the profit before loss, then you have to remove 9 lakh from 3390, and if you remove 9 lakh from 3390, then it will become 24,90,000. So 24,90,000 is also correct, and 20,90,000 is also correct. How I got? In one case you are going to remove 9 lakh from after the loss wala profit, and in another case you are going to remove 9 lakh from before the loss wala profit. In either of the case the answers will change definitely, but your answers will be what? These are the two different opinions which the ICAI has given over here. You can check over here. Okay, now after you are done with all these things, you are going to compute the AMT. Now AMT is very simple. Whatever is your total income, you have to add back. In the total income, you have to add back the deduction, and once you take the deduction, after that you will compute the alternate minimum tax, 18.5%, 4% cess, etc, etc. Surcharge is not applicable, and therefore you will compute the tax in a normal way. It's a very simple part. So the most important part of this question was that how to compute the profit, and to compute the profit there are two views which are taken by the institute over here. You can check it once. Okay. So let's move on to the next question. This is also a beautiful question. Mr. Robert is there, who is a non-resident, and he is a citizen of Germany. Mr. Robert, a non-resident citizen of Germany, is working for a German company. Now that company has a P in India, and that company has sent Robert to India for some work, some official work in India, and he is staying in India for 85 days, and he is earning 28 lakh rupees, and which is borne by Indian P. The first question is whether this income will be exempt or taxable in the hands of Mr. Robert. Okay. Now Mr. Robert is staying in India for only what? For only 85 days. Therefore, he is definitely non-resident. Okay. But his income cannot be exempt under Section 10(6). Why? 10(6) is applicable if the non-resident employee comes to India for up to 90 days. So he is staying for up to 90 days. He is not crossing the 90 days barrier. But the second thing is that company which is there outside India, that should not have any trade or business in India. Now that company, German company, is having a P in India, and they are doing a business in India. Therefore, he will not get the benefit of exemption. The employee will not get the benefit of exemption under Section 10(6). Therefore, this 28 lakhs will be subject to tax. 50,000 standard deduction also he can claim. There is no harm in that. Okay. Second thing, second income which Mr. Robert is doing over here is Robert is also purchasing some shares of private limited company in 2015. He has purchased by remitting foreign currency. So here, if a non-resident purchases shares of Indian company in foreign currency, then first provision to 48 will apply. Accordingly, you will convert the all the prices into dollars first, and then you will reconvert into rupees. At what rate? The sale consideration will be converted as per TTBR on the date of sale. So the TTBR on the date of sale is this. The purchase consideration, the cost will be converted as per the TTBR on the date of purchase. Average. You have to take average at both the cases. So the date of purchase is this. So you will convert cost of acquisition as per this rate. Once you convert the sale and cost, expenses on transfer is not given in the question. So forget about that. You will get the capital gains in foreign currency. So you have to reconvert that capital gains into INR. When you reconvert, you will take only TTBR, only TTBR, only TTBR on the date of purchase. Okay, on the date of sale, sorry, TTBR on the date of sale, you will get your capital gains. You can make the calculation. Okay, now the third income which is earned by him is a very, very intelligent income. He has purchased some shares of some company by the name called as AG Limited. AG is having a total assets of 15 lakhs, and the AG is having an assets in India of 8 crore rupees. Okay, 15 crore, 8 crore. Now, the income of the shares of AG does not derive its value substantially from asset located in India. Why? Because if you want to say that any foreign company shares like CGP, Vodafone case law, this question is on. If any foreign company shares derive its value substantially from asset located in India, then that foreign company's assets in India should be at least of 10 crore rupees. If the assets is of 10 crore rupees, and if it is having at least 50% of total assets in India, then only they are going to get the tag of what? The shares of foreign company derive its value from asset located in India. Now, the shares of this company, in the assets of this company in India is only of how much rupees? Is only of 8 crore rupees. Now, because it is only 8 crore, it is less than 10 crore, the shares of the foreign company does not derive its value from India. Therefore, it is what? Therefore, it is not taxable in India. This particular transaction is not taxable in India. With the shares which he is selling of what? AG Limited to another non-resident Mr. David will not be taxable in India, because the shares of AG does not derive its value substantially from asset located in India. To understand this provision, go and read the provision of what? Capital gains properly. Sorry, the provisions of Vodafone case law properly. You have to see that particular chapter properly. Last but not least, he has also received some dividend in India. So if a non-resident receives something in India, then it is definitely taxable in India, and that will be subject to tax in India. You can check the solution over here. Okay. Now let me move on to the next question. The next question is on charitable purpose. The Asasi is a charitable foundation which is engaged in promotion of yoga. So now we all know that yoga is what? Yoga is covered in one of the charitable purpose definition under section 2 clause 15. Okay. Now this Asasi is doing two things. This Asasi is receiving some corpus donation of 125 lakhs. Okay. Now corpus donation should be invested in the mode specified in 11.5. Now this Asasi is investing in a shares of private company. So if you receive corpus donation and invest in the shares of private company, it is not a specified specified mode. Therefore, you will not get the exemption. This will be subject to tax. Okay. Now, this trust is also receiving what? It is also receiving some amount from what? As a voluntary donation. Now, this voluntary donation will be subject to 15% exemption. It is also receiving some fee from the students for teaching yoga. So, if you are teaching yoga, you are receiving some fees. That is also subject to exemptions under what? Section 11(1). You can claim 15% exemption because promotion of yoga is considered to be a charitable purpose. Okay. Now, the next one, the answer will change because of Finance Act 2022 amendment. There was a person who was a founder of a trust. Now, his son became ill. So, the father admitted his son in the hospital of the trust. Okay. Now, the total fee which was charged to him was 3 lakhs. Otherwise, it should have been charged at the rate of 5 lakhs. So, you are giving unintended benefits to what? To the related party, to the specified persons under section 13 subsection 3. Sir, is the son of a trustee a specified person? Yes, go and check. Section 13 subsection 3, son of a trustee, relative of a trustee is a specified person. So in that case, the trust will be liable for lot of new provisions which are brought by Finance Act 2022. The trust will be liable for a penalty of what? Penalty under section 271 AAE of 100% in the first case, and in subsequent case it is 200%. The trust will also be liable for tax at the rate of 30% for giving unintended benefits to the specified person. The receiver will also be liable for what? Gift taxation under the income tax provision 56(2)(10). So the answer will drastically change. Don't see the answer given over here because this is as per Finance Act 2021, because this is the latest paper and I did not get the time to change the entire solution over here. Okay, I have directly put the ICI booklet over here. So don't see this. Okay, so whatever answer which I have told you, that is the correct answer. Now the next question. This is also a very, very intelligent question. Mr. Ritesh, who is an individual whose age is 42 years. Okay, now he is an individual, he is resident, his age is 42 years. Now there are a lot of small things over here. He is earning some business from India, so that will be taxable. He is liable to pay tax on that particular income. Now he is not opting for 115 BSc, so compute tax as per the normal provision. Second, Mr. Ritesh is also earning some royalty from country N. Now from country N, whatever royalty is earning now, that will not be taxable in India because it is written between DTAA between India and country N, that royalty will be taxable in the source state. Now which is source state? Is India source state? No, the source state is country N, therefore it is taxable in country N. So this particular amount 7,80,000 is not taxable in India. Now the third one is, it is written that for interest in from country Y, for that it is written in DTAA that it is taxable in both the countries and India will give credit to that particular person. Okay, now for in that case over here we have to suppose to compute this particular thing in India because this is taxable in India and it is taxable in foreign country also, and then DTAA relief can be given to the assessee, but it is taxable in India in the first hand. This above point was not taxable only in India. Now how to compute this income? Let us assume that it is interest other than security. If it is interest other than security now, then you have to take TTBR as on the last day. But if it is interest on security now, then you have to take TTBR as on the preceding last day of the preceding month. So this is the difference between taking the TTBR. When you want to convert an interest other than security into INR, you have to take the TTBR of the last day. TTBR of the last day is 80 rupees. TTBR of the last day is what? It is 80 rupees. You have to take that 80 rupees as TTBR of the last day. But when you want to convert the interest on security, you have to take the TTBR of the last month of the last day of the preceding month. So we are assuming that it is an interest other than security. So we'll take TTBR on the last day. Okay. Once we do that, after that agriculture income in country M, that will be taxable because agriculture income is taxable in both the countries. Okay. Country M, whatever you are doing, that will be taxable in India, and in country M it is exempt. Not in India. In country M it is exempt. Okay. Now therefore 4,85,000 rupees is the business income. Royalty, because in country N it is taxable, you will not take, and this you will convert 9,500 as per TTBR as of the last date as per rule 115, and after doing all these things, and you will take agriculture income from country M. Okay, after doing all these things, you will apply the normal tax rate 115 BSc should not be followed. Now let us come to relief. Am I going to get the relief on agriculture income? No, because agriculture income is exempt in country M, because if something is exempt in foreign country, that income is not doubly taxed now, and if that income is not doubly taxed, how can you ask you relief on that particular income? Yes, you will get relief on interest. So how much relief you will get on interest? First of all, find out the average rate in India. The average rate in India is very simple. It is nothing but 227 divided by 1354. That will be the average rate in India. That is 16.78. Now we need to find out the average rate in the foreign country. What is the average rate in the foreign country? How much tax you have paid in the foreign country? You have paid $950 in the foreign country on 21st of Feb 2022. It was deducted. So how to convert the tax? There are two different rules. 115 is to convert foreign income into Indian income, and 128 is to convert foreign tax into Indian tax. So how to convert this tax? This tax has to be converted as per TTBR as on the last day of the preceding month. So what is the TTBR as the last day of the preceding month? This was deducted in February. Therefore, the last day of the preceding month comes to which month? It comes to February. It comes to January 31st. So you have to convert this 950 as per Jan 31st. Okay. So that's what it is done over here. 950 into 78, and this is 74,100. Okay. Now we need to compute whichever is lower. How much is the doubly taxed income? 7,60,000 is the doubly taxed income. And what is the average rate in India? 16.798. So according to that, the tax in India on the foreign income comes to how much? 127,665. I'm again saying the tax in India on foreign income comes to how much? 127,665. And the tax in foreign country on foreign income comes to how much? 74,100. And you can take the relief of 74,100 over here. It's a beautiful question. Just go through it once. It's a very, very, very good and important question for your exam. Okay. Now the next one. Now the next question is on TDS, whether TDS will be deducted or not in the following cases. Now this assessee is purchasing some computer software for the purpose of reselling and to the users in India. So if you purchase any software for reselling as a distributor, you are purchasing and then reselling, then the TDS is not applicable because it is not a royalty only. It is not considered to be a royalty as per the Supreme Court judgment of Analysis Engineering Excellence. There's a long judgment. It is not a royalty, and if it is not royalty, TDS provisions will not be applicable. Okay. Second one, there's a public sector company who is making some payment to the bank as commission for facilitating ATM cards or debit cards. Whether TDS is applicable, the court has said that, even CBDT has said that TDS will not be applicable in such transaction. Neither 194H will be applicable because the relationship between both of them is not of principal and agent relationship. The relationship between both of them is principal and principal relationship. Therefore, 194H commission will not be applicable. Even 194J will not be applicable, because then there is no manual or human intervention. For 194J to applicable, to be calling anything as a professional service, there need to be some kind of manual or human intervention. Otherwise 194J cannot be made applicable. Therefore TDS is not applicable in this case. Now there is one person PQR who has given a contract to Mr. Payee, to Mr. A who is a payee. Okay, to Mr. A who is a payee, he has given a contract to make some shirts. Now Mr. A has asked for it. Mr. A has asked to PQR that who is going to give me the cloth. So Mr. PQR says that my related party is going to give you cloth. So related party is going to give you the cloth. So if a cloth is received from the assessee, that is from the customer, or from its related party, both of them are covered, from its associate entity, then in that case TDS provisions will be applicable. Now that depends upon whether the other person. Now it's very simple. I am telling you to make a shirt. Now you will ask me who will give me the cloth. Cloth can be given by either me, or it can be given by related party, or it can be given by third party also. If it is purchased from third party, then it is a pure sale. But if it is purchased from me, or it is purchased from my related party, then I am liable to deduct TDS. Now it depends upon, because in that case we are giving you the cloth. If I am giving you the cloth or my related party is giving you cloth, it is one and the same thing only. Okay, so in that case you are not giving me sale. You are not doing sale to me. You are giving only services to me. So I will deduct TDS. But in this case, you have to be very remember. You have to remember one thing, that you cannot issue an invoice on a consolidated basis. If you issue invoice on a consolidated basis, which you are doing over here, I will deduct TDS on the entire amount. If you give a breakup that this is for service, this much is for product, is for goods, then I will deduct TDS only on the service portion. But you are making a mistake. You are giving me a consolidated invoice. Therefore, I will deduct TDS on the entire portion. Okay. Next one, there is a non-resident who is not a citizen of India. So if a non-resident who is not a citizen of India and who comes to India to participate in matches, etc., then 20.8% TDS will be deducted under 194E. Similarly, if they write any article in a sports magazine, that will also be subject to TDS at the rate of what? 20.8%. Okay. So that is the provisions of 115 ABA. Read with section 194E. Okay. Now the next question is a very, very, very good question on cost plus method. Give a 5-star to this question. It's a different kind of question, different kind of question. You have not seen such kind of question ever so far. So there is one company, MNO Limited, and there is one company, MNO INC. Both of them are holding subsidiary. Therefore, MNO and MNO are deemed to be associate enterprise. Both of them are associate enterprise. Now we are supposed to follow cost plus method, and we are supposed to find out the arm's length price. Now what happens in cost plus method? In cost plus method, so first of all you need to find out the cost of that service which you are providing, direct and indirect cost, all the costs which you are providing to your associate enterprise. Then you are supposed to find out the GP margin of third party. But unfortunately in this question, GP margin of third party is not given. So what we are going to do? We are going to solve the question step by step. First of all, what are we going to do? We are going to find out the GP margin of unrelated party. Okay, for that we need what? We need the cost of unrelated party, which is given. Direct cost is 120 into 8 hours into for 18 days, and indirect cost is 210 hours, 8 hours, 210 USD into 8 hours for 18 days. Okay, I'm computing in USD, then we can convert into rupees later on. Okay, that this is the billing per month. This is the direct and indirect cost. Okay, now there is a mistake done by ICI. They should not have computed this. There is one more cost which is involved over here, which is warranty, which we are giving to third party. We are giving 1.5% of the direct cost as warranty. So 1.5% direct cost as warranty, which is 17,280. So that should also be added to the cost. So my total cost comes to 47,779, and my billing to HYT comes to how much? It is 92,000, which is given in the question. You can see over here how much is the billing to HYT unrelated party. It is 92,000. Be very careful. So the differential between the two is 44,000. Therefore, what is my cost? GP to cost? My GP is 44,000. My cost is 47,000. My GP to cost is 92.5%. Okay. Now I will go to my associate entity. My associate entity, I charge them 120 rupees, $120. I give them service for 9 hours for 18 days, and indirect cost $210, 9 hours for 18 days. Okay. Apart from that,
I also take some loan from my associate entity. So if I take some loan from my associate entity, then I'm also liable for some interest payment that also I have to add in the cost. So $1,20,000 into 4% into 1/12, because all this billing is only for a month. It's a monthly calculation, and this is my total cost. And now on that total cost, I will apply my arm's length margin, and I will get what? I will get my arm's length price. Check please. This is what you're supposed to do. First compute the arm's length price. First find out the GP margin of third party, and then apply that GP margin on your cost. You will get what? Your arm's length price. Okay. The next question is based on case law. The very first case law is on Pepsi Foods Limited, which says that ITAT has the power to give you a stay, but can it be extended beyond 365 days? Yes, it can be extended beyond 365 days, but the income tax department says that it cannot be extended beyond 365 days, even if the delay is not because of assessee, even if the delay is because of tribunal. Beyond 365 days, it cannot be extended. So the Supreme Court came for the favor of the assessee. For the favor of the assessee, Supreme Court gave this judgment and said that up to 365 days, the ITAT can extend the stay. But if beyond 365 days, it is not the mistake of the assessee, but it is the mistake of the ITAT. They are not able to close the matter. Then they can also extend the stay beyond 365 days. It can be extended beyond 365 days if the delay is attributable to the ITAT. Yes, if the delay is attributable to the assessee, then it cannot be extended beyond what? Beyond 365 days. Now, the next question is also a good question, which is on search and seizure. Now, on 31st of December, a search conducted on the assessee, and there was some gold bars which was seized from the assessee's locker. Now, assessee after that voluntarily disclosed 12.5 crores in the course of search. Okay. Now, later on, what the assessee is saying, later on, assessee is filing an application and saying that whatever my tax liability might come in future, please adjust that much amount from from my gold bar and give me the remaining gold bar. Can department do so? Suppose, for example, again I am saying today's search is happening. They are searching. They are seizing something from you, and can you tell to the department that give me whatever future liability will come, reduce that much amount from my gold bar and give me the remaining gold bar? That cannot be done. That can be done only under certain circumstances which are given under proviso to section 132B, which says that if search is happening in this month, then the assessee can go within 30 days from the end of this month and tell the department that this is the nature and the source of the assets, from this is the place from where I've got the gold bar, this is the place from where I've got the gold bar, this is the source of the gold bar, this is the nature of gold bar, and it can be adjusted against the existing liability. It cannot be adjusted against the future liability. It cannot be adjusted before what the assessment is completed. The assessee is insisting that complete that, automatic tax liability might come now. If you are doing assessment, some tax liability might come in future. So adjust that again against that and give me that money. Department said that not possible. It can only be adjusted against the existing liability of the income tax law, which was it cannot be adjusted against the future liability which might come in future on completion of assessment. Okay, once the assessment is completed, and if there is something left after that, we will definitely return you. Don't worry. Now the next question is what is an irrelevant question in today's time. Sir, why it is irrelevant? Let me tell you. Do you remember that if there is an outstanding interest in my balance sheet and I convert that outstanding interest into a new loan, that is not allowed as a deduction. Okay, that is not allowed as a deduction. But if there is an outstanding interest and if I convert that into a new debenture, that was allowed as deduction as per the Supreme Court judgment. That is what it is written over here. And that is what is an amendment made by Finance Act 2022, if you remember. Conversion of outstanding interest into a new debenture or any other security shall also not be amounting to deemed payment. It cannot be called as a deemed payment. It cannot be called as a deemed payment. So this is what this case law was all about. Now this case law is overridden, so it doesn't make any sense now to talk about this case law. Now the next question is, if there is an order which is passed by Board of Advance Ruling, can you file an appeal against that? Yes, you can file an appeal against that to High Court within 16 days. Within 60 days. If there is an Indian public sector company, it wants to go to Advance Ruling, Board for Advance Ruling, but it has a concern that their case is already pending before ITAT. Can they go to Advance Ruling? Yes, they can go. If there is a public sector company, they can go to Advance Ruling even if their case is pending before ITAT and Income Tax Authority, they can go for Advance Ruling. Yes. But if their case is pending in front of what? High Court and Supreme Court, then they are not allowed to go to what? Then they are not allowed to go to the advance ruling. The case should not be pending in front of High Court and Supreme Court. It can be pending in front of ITAT. The next question is a very simple question on equalization levy. You can see we have seen a lot of times such questions in the past exam papers. Okay. And one last question is there. That's it from my side. I will complete all the discussion which I was supposed to be doing with you all in South India for South India students in English. Now, whether GAR will be applicable in the following cases. First case, there is a company which is making losses. It is acquired by another company so that the loss can be set off. Whether GAR can be made applicable. Why GAR will be applicable in this case? It is allowed to do amalgamation here. There is nothing wrong in this. Amalgamation is allowed by the Income Tax Act. Amalgamation is also approved by the court. Therefore, there is no need to apply what? GAR in this case. Second case, this company has purchased some listed shares in 2016 and then it got some bonus shares in 2021. Whether GAR will be applicable? They were doing this all with an intention to evade some tax. Whether GAR will be applicable? No. Why? Because the GAR is applicable from 1/4/2017. So if any transaction is done if impermissible avoidance arrangement is done on or after 1/4/2017, then GAR is applicable. Because this is done before 1/4/2017, GAR is not applicable. Now, because GAR is not applicable on original shares, GAR cannot be made applicable on bonus shares also. Okay, next one. There is one Indian company which wanted to give loan to another Indian company, but rather than doing that, they are forming a company in a low tax jurisdiction, and they are purchasing equity shares of that company, and then the third company is giving loan to the second company. So whether GAR will be applicable? Yes, it's a classic case of impermissible avoidance arrangement to evade tax. GAR will be applicable in this case. And the fourth company is what? It is setting up some unit in SEZ. Whether GAR will be applicable? No, it is allowed. It's tax planning. It's not even tax evasion. Forget about tax avoidance. It's a tax planning case. It will be allowed as a deduction. And one last question over here is, there is one person who is a non-resident, Mr. Albert, wants to treat the following person as his agent. Now, who can be called as an agent? First of all, you need to understand who can be called as an agent in India. An agent in India can be any person who is employed in India on behalf of non-resident is an agent. Second, any person who has acquired a capital asset, any person, whether resident or non-resident, who has acquired a capital asset by transfer from non-resident. So in first case, Mr. Albert, who is owning a house in India, is selling his house to another non-resident. So and that Mr. D'Souza can be called as what? As an agent. Because any person who has acquired a capital asset in India can be called as an agent. Whether that person who is acquiring is resident, non-resident, doesn't matter. Check the solution. Second case, Mr. Albert has employed Mr. Rakesh. Can Mr. Rakesh be called as an agent? No, no, no. Why no? Because Mr. Rakesh is not in India in the current year. For you to be employed in India, then you need to be also in India. An employee also need to be in India to become what? An agent. So Mr. Rakesh cannot be called as what? An agent in India. That's it. The next three questions are theory question. You can go through it once if you want. All of them are theory question based on last few topics which we have done in our CA final syllabus. So that's it from my side. Whatever I could have done from my side, I have successfully revised with you all 19 papers. 6 RTPs, 8 mock test papers and 5 exam papers, that too in English. I cannot imagine I have done that. It was easy for me to do it in Hindi, but it was absolutely painful for me to do it in English, that too in such a short span of time. In an average of around 15 minutes, I have tried to complete one paper, whereby if you sit at your end, you will give at least 30 minutes to solve even one PGPP question at your end. Forget about entire paper. If you sit at your end, you will not be able to solve one PGPP question also in 30 minutes. We have tried to complete entire one paper in 15 minutes. Like that, we have completed 19 papers. Whatever was there on ICI's website, we have done everything. Now let ICI ask whatever they want to. Believe me, if you are thorough with these 19 papers now, nobody can touch your hand. Indirect tax papers. Everything will be some or the other way related to these concepts. I'm not saying exactly it will be same, but some or the other way. And your mind is open like anything. Your mind is now started to thinking now. If this has come, this is going to be the effect. If this comes, this is going to be the effect. Now, I just request you all to share this lecture to as many people as you can in the entire South India, because I know that in South India, there is nobody's recording all these things. I don't think so anybody has recorded these things in North India also for CFR and direct tax. But I'm requesting you all to South India because on your request, I'm recording all these things. Otherwise, till last year, I used to not do anything for English students. But now, I try to do everything parallelly for you all also. So if you have liked the lecture, share it with your friends. Maximum people you should share it. And if you have liked the lecture, you can have a view on the comment box below that what is your opinion and what is your view on these beautiful sessions which I have tried to do from my side. So take care all of you. God bless you all the best for your exams. And whenever you will clear your exam, just remember this person for a second and just message me. I don't want anything from you. I just want a message from you that, sir, I have cleared my exams. That's it. I don't want anything from you. Okay. So take care all of you. Bye. Hope to see you soon. Bye.